So, good morning, everyone.
And welcome at the Österreichische Nationalbank.
My name is Martin Kocher.
And I am Jennifer Gredler.
Let us start by saying that we are very happy to have so many of you here on behalf, of course, of the Board of Directors of the Austrian National Bank and on behalf of the entire staff.
Yes, it is a true pleasure to have you all here live at the OeNB. But we would also like to give a shout out to our online participants who are joining us via WebEx. Welcome.
Now for those of you who have not met me before, my name is Martin Kocher, as I said, and I'm the new governor of the Austrian National Bank.
And I work in communications, and it is my job today to guide you through the program, have a bit of an eye on time management, and make sure that our online participants are heard if they have any questions or comments. But enough about me for now. I'll hand over to our governor now so he can give you the official welcoming remarks, and he will then also introduce our first keynote speaker.
So, esteemed guests, dear colleagues, dear participants, once more it's a great pleasure to welcome you to this year's conference on European economic integration on the topic of the Central, Eastern and Southeastern European financial futures, funding growth and innovation. I'm very pleased to see that so many distinguished experts and scholars have come to Vienna and are joining us online to discuss how we can foster growth, innovation and convergence in Central, Eastern and Southeastern Europe, for short CESEE or CESEE countries. I want to especially welcome, of course, all the governors, the deputy governors, former governors, and experts that join us today. Today's conference is dedicated to the financial future of the CESEE region. Functioning capital markets are an important part of this future, both in the region, but also in the European Union. Capital markets or stock markets developed very quickly in the 13th and 14th century. In the late 13th century in Bruges, traders gathered at a market square near an inn owned by a family called Van der Beurs, providing a later German or Dutch name to stock exchange. The idea spread in Flanders, and other commodity trading places emerged. Concurrently, or even a bit earlier, Venetian bankers started to trade government securities. And only a few centuries later, Dutch adventurers sold shares in ship expeditions already before departure, obviously with a very certain prospect of physical and financial return. Austria's contribution to capital markets at this time were limited. At least many centuries later, Austria and Vienna can lay claim to the founding scholar of capital theory, Eugenböhm Ritter von Bamberg. His contributions to capital theory and interests were very influential. And I quote one of his books: "Interest is not an accidental historical-legal category which makes its appearance only in our individualistic and capitalist society and will vanish with it, but an economic category which springs from elementary economic causes and therefore, without distinction of social organization and legislation, makes its appearance wherever there is an exchange between present and future goods." End of quote. Nowadays, we know very well, functioning capital markets are an essential element of an economic system. Often they are seen as technical aspects of the economy. But they are much more. They are the catalysts that transform ideas of individuals or firms into better lives for everybody in an economy. They help realize entrepreneurs' innovative dreams, and they allow many people to participate in economic growth. They sort investments into the most productive use, and they incentivize the development of new technologies. Capital markets bring together companies demanding capital for investment with households willing to supply capital, transforming their savings into financial investments. In order to facilitate this exchange, there is a need for a well-designed marketplace. Such a marketplace produces valuable information and must have the necessary trading and payment infrastructure. To function smoothly, capital markets require clear rules, including appropriate regulation, transparency, and legal stability. Well-functioning, deep and liquid capital markets, and thus broadening current participation in capital markets, may provide benefits to both the households and the entire economy. On the one hand, they can improve the access to finance for companies. This is particularly relevant for startups and for small companies that aim at scaling up, as these companies usually do not have the track record or the collateral to receive sufficient bank lending. On the other hand, liquid capital markets can improve the asset allocation of households, obviously, offering an alternative to regular bank savings for their pension plans, for saving plans, or for similar purposes. While this may be particularly interesting in times of nominal deposit interest rates below the rate of inflation, it is more relevant on the long investment horizon. Further, in order to ensure a smooth transmission of monetary policy, some monetary policy measures also target capital markets directly. Therefore, well-functioning capital markets have become increasingly important also for monetary policy today, in particular for some of the tools in the monetary policy toolbox. Having said that, I would like to add that arguing in favor of a bigger role for capital markets does not mean that I'm arguing in favor of a market-based instead of a bank-based financial system. Rather, capital markets could play a significant complementary role to financial intermediation by banks. We know that capital markets may provide substantial benefits, but also entail their own specific risks for both financial investors and capital-raising companies. However, a financial system that rests on both pillars, banks and capital markets, could be seen as a portfolio that allows better diversification and better sharing of risks that arise. It would allow established companies to diversify their funding sources and households to build a financial wealth pyramid with bank deposits as the foundation. Furthermore, it's important for me to underline that from the perspective of the European Union and the euro area, capital markets may provide further specific benefits. They could form an additional pillar of deeper integration within the single market, allowing for a funding pool and risk sharing across the European Union and the euro area. Over the last few years, we have seen a recession in the wake of the pandemic and sharply rising geopolitical risks. It's now clearer than ever. All European countries need to first stand together, second, reduce dependencies, and third, leverage growth potentials within the European single market. The creation of the single market has contributed considerably to more economic growth and higher living standards in the European Union in recent decades. Going forward, the deepening of this single market could and should provide an important source for further economic growth in the European Union and, of course, in the vicinity of the European Union. Especially so if this deepening is pursued in all dimensions, that is, with respect to goods, services, labor, and, of course, capital. At the same time, it will be essential for the European Union and the euro area to maintain its openness towards partners outside the EU as far as possible in trade, in the mobility of skilled labor, and in capital flows. Deep and liquid capital markets would be beneficial for the EU, even if only EU companies and financial investors participated in them. However, beyond that, they offer opportunities for financial investors from outside the European Union and outside of Europe. Given demographic change, with aging accelerating in many parts of the world, saving rates might go up outside the European Union as well. Thus, deep and liquid capital markets in the EU are also conducive to a stronger international role of the euro. In this spirit, Jean-Claude Juncker, then President of the European Commission, announced the project of a capital markets union in his first speech to the European Parliament in the year 2014. It was envisaged as a project of financial integration. This project followed the adoption of legislation for the main pillars of the banking union, achieved just before. It built upon the economic and monetary union, which had mastered formidable challenges supported by the active role of the ECB in the years before 2014. Now, I can almost see some of you pondering, this was more than 10 years ago, actually. And where is the Capital Markets Union today? What progress did we make with the Capital Markets Union, the CMU? Granted, building and strengthening the CMU has consisted of many bits and pieces, a substantial number of smaller and, in some cases, large advances, and it is quite easy to lose track of what has been achieved so far. For my taste, progress has been too slow. Progress has been sketchy, and progress has not been following a consistent and logical path. Nonetheless, I would like to give you a few examples of what has been achieved so far, but I will also list what is still in the making. Several CMU-related initiatives were directed in improving the market infrastructure. One of these resulted in new EU regulation at the end of February 2024, which has already been implemented. Indeed, it may have already been used by many of you. I speak of the instant payment options without additional charges when making money transfers within the EU. In a similar vein, again in the field of market infrastructure, within only 4 months after the European Commission's proposal, the Council and the European Parliament reached an agreement in June this year to shorten the settlement cycle for trading shares and bonds from no later than 2 business days to no later than 1 business day after the trading date. That is from T+2 to T+1. This should enter into force towards the end of 2027. Another initiative has concerned market transparency. In 2023, a regulation was adopted to establish a European single access point. The ESAP initiative will provide easy, centralized electronic access to publicly available information about entities, mainly companies, and financial products that are of relevance for capital markets and sustainability. Collection of information will start at mid-2026, and access will be open from about mid-2027 onward. So what is still in the making? Under the rebranding as Savings and Investment Union, the SIU, the European Commission presented proposals to revitalize the securitization market in June. As the securitization of loan portfolios transforms bank loans into capital market instruments and gives banks leeway for new lending, this is also an example how fostering capital markets may support bank lending. At the same time, it is also an example for the need to strike a well-considered balance between fostering capital markets and preserving financial stability. We all remember the worrying experience with securitization during the US subprime crisis that led to the great financial crisis. Further, in the context of the Savings and Investments Union, the European Commission put forward a financial literacy strategy in September this year to empower citizens to make informed decisions regarding their personal finances. And of course, many of the central banks support this financial literacy strategy. In response to the pandemic-induced recession, the issuance of European Union bonds was started by the European Commission on behalf of the European Union member states under the Next Generation EU program in 2021. The launch of these EU bonds was successful, and markets accepted them as a common safe asset. This instrument was born in crisis time, and it is still in a quite nascent state. There have been and still are heated debates around the instrument, and I'm not taking any sides here. But I'm convinced that a more widespread use of the instrument would require a lot of prerequisites in order to have a chance of being successful. Politicians have the responsibility to decide, and academics have the responsibility to provide as much evidence as possible on those prerequisites and potential consequences. Such a discussion goes far beyond economics. It concerns, of course, the institutional framework in the EU, the international role of the euro, and the geopolitical ambition of the EU. Coming back to capital markets. Deep and liquid capital markets in the European Union cannot be achieved exclusively via harmonized policies and measures at the EU level. In addition to this top-down approach, bottom-up initiatives of regional cooperation are highly welcome and supportive too. One recent example of such regional cooperation to foster a joint development of national capital markets is the signing of a memorandum of understanding by 8 countries in the CESEE region. It's Bulgaria, Croatia, Hungary, Poland, Romania, Slovenia, Slovakia, and North Macedonia. At the end of August this year, the MOU builds upon a strategic agreement concluded in November 2024 among the stock exchanges of these countries alongside the EBRD, which continues to support this initiative. The cooperation aims at improving liquidity, aligning the rules, and increasing the visibility of these markets. In a collaborative manner, it will complement EU plans and also efforts by the Vienna Stock Exchange and the Prague Stock Exchange, linked to the Vienna Stock Exchange, to create a trading hub and facilitate access for international investors to Central and Eastern and Southeastern European markets. Moreover, it's clearly a task also for individual EU members to reflect upon possible unnecessary barriers and consider conducive national measures. In this context, the exchange of best practice is always helpful. The design of pension systems, and especially the design of pension provisioning, is an issue that falls into the category of potentially relevant and related measures on the national level. The obvious questions are how and to what extent capital markets can play a complementary role to a well-designed pay-as-you-go system. In this context, the setup of the tax system should be considered. How can long-term investments that support both precautionary savings for individuals and necessary infrastructure investments for the necessary energy transition and for decarbonization be incentivized in the best way? Dear ladies and gentlemen, let me conclude my opening remarks by briefly highlighting some aspects of the recent development and current state of capital markets in the EU. The size of the EU capital markets relative to GDP has risen by more than a quarter in the past 10 years. Thus, one may argue that the efforts to foster capital markets here in Europe have borne some fruits. In contrast, however, despite this increase, the European Union's share in global capital markets has declined more strongly than its share in global GDP. At the same time, the share of corporate bonds issuance in total corporate gross borrowing has not risen, has remained at about 1/4. On a positive note, venture capital investments relative to GDP have risen strongly in the European Union. However, the resulting ratio is still less than 1/8 of the corresponding ratio in the US, and given the innovation potential of Europe, this is still not sufficient. At present, EU households hold over 11 trillion euros in cash and bank deposits, while their holdings of financial market instruments relative to GDP are far smaller than in the UK, Japan, and especially, of course, in the US. Focusing on the capital markets of European member states in the CESEE region, two things are striking. One, the outstanding volume of corporate debt securities relative to GDP is far below the corresponding EU average ratio. And second, more than 2/3 of corporate debt securities are held by non-residents. Esteemed guests, dear colleagues and participants of the conference, let me conclude. I'm quite sure that deeper and more liquid capital markets in Europe, a less fragmented capital market in Europe, and innovation-supportive capital markets in Europe are the prerequisite for creating a sustainable, decarbonized and productive European economy that serves the interests of European citizens. Such a less fragmented capital market needs to include the Central, Eastern and Southeastern European region as soon as possible if they are not already included. In times of fiscal strain, the conclusion on the relevance of capital markets is more important than ever. Public investments have to be complemented by private investments. I quote, "If everything seems under control, you're not going fast enough." This is Mario Andretti, the race car driver, once said. I would add, if you're going too slow, you also risk losing control, because then clearly there's a need for speed in advancing our capital markets in the CESEE region and in the European Union. Thanks a lot for your attention. And now we move on to the first highlight of today's conference. Let me introduce our first keynote speaker, Nicolas Véron. It's a great pleasure to have you here, Nicolas. He's the co-founder of the famous Bruegel Institute in Brussels, or Bruegel Institute in Brussels. He specializes in financial systems and financial reform, and is a leading voice for the European Banking Union. He was included in the global 50 most influential list by Bloomberg in 2022. sorry, 2012 already. Nicola is a seasoned economist and has authored and co-authored a vast number of policy papers on financial stability, supervision, financial reporting, and regulation. He is actually, at the moment, senior fellow at Bruegel and the Peterson Institute for International Economics, and a board member of the Depository Trust and Clearing Corporation, a non-profit financial infrastructure company. Nicola will share with us his current thoughts on capital market regulation. We are very honored to have you today, Nicola. You have 25 minutes, and then we have time for questions and answers. Nicola, the stage is yours. Thanks for coming.
Thank you so much, Governor. It's a great honor to participate in this event. I have to start with a bit of an apology because my presentation will be very much focused on European Union policies. I'm a policy guy. The policy setting environment in the EU, of course, is very broad, but that means I will not speak specifically of the challenges and opportunities for countries in Southeastern Europe in particular, which are currently outside of the EU. Hopefully they will be in the EU soon enough, so that will be a correction to my omission. Indeed, the governor has insisted on the fact that the Capital Markets Union has been a theme for now more than 10 years, and actually much longer than that if you go beyond the label. So it's a bit tired. Many conferences have been held on this theme. I will argue there is life on that planet, that it's actually a topical moment to talk about these issues, and that there is hope and opportunity in the air at this point for some progress to be made, maybe not on all fronts, but on some important ones. I also have to insist on one point that the governor has kindly mentioned. I'm currently a board member, not at DTCC, parent company, but at the trade repository arm of DTCC, which includes an entity which is supervised by ESMA. I will talk a lot about ESMA in my presentation. Let me make it very clear that I'm not making this presentation in that capacity as a board member. I try to maintain the Chinese wall. So this is a disclosure, but not the perspective I'm speaking from. Okay, so there's a big promise of Capital Markets Union for the EU. I will basically repeat points that Governor Kocher has made in his introduction. The promise is more efficient capital allocation, that of course contributes to better productivity. Larger EU-wide asset classes in securities, equity securities, fixed income securities, that of course participates also in the transmission of monetary policy. Governor, you mentioned that. And I insist on the fact that in principle with a well-designed capital markets union, not only will these asset classes be larger, but particularly in the case of equities, they will be more trusted because the quality of enforcement of the equity framework, I think, is a first order factor that often gets neglected. You would have larger institutional investors. We'll come back to that in the context, for example, of pension funds. Better returns for everybody. Everybody basically gets happier in the capital markets union. Better funding for investment and innovation. Probably that's the most important thing at this point. I think it's very much in the news that the EU is dependent on the US for too many things. So if we want strategic autonomy, we also need a capital markets union. And now, it's part of a broader project, which in principle also includes banking, and that's been supported by the reports last year. So nothing new here, but it's a very important framing background. Now, the point I want to insist on is that the countries in the Central, Eastern, and Southeastern European region are actually not only going to benefit from a capital markets union if it were to happen, but they would benefit disproportionately. And I think this is an important point to make because often there is an impression that the discussion on capital markets union is led from Western Europe, maybe because Brussels is on the western part of the continent, but actually the ones who would gain most from it economically are the countries in this region. And I think this needs emphasizing because it goes against a number of misperceptions. Obviously, a number of those countries in the region are comparatively disadvantaged by the fragmentation of markets, and especially by the investment home bias. There is a lot of investment need and good ideas in this region, lots of entrepreneurial energy, projects that need funding, but the savings base is not the same as in Western Europe. So basically you need Western European savings to meet Eastern European entrepreneurs. And I think this is where the promise, the disproportionately large promise of capital markets union is for this part of Europe. There's a very interesting paper that was published last year by two researchers at the Bank of France. I apologize for the home bias. I'm French, they're at the Bank of France, but one of them is not French, I think. They did a state-of-the-art modeling of how portfolio allocation would work in a complete capital markets union, and they have some hypotheses about that in terms of the development of capital markets in the different geographies, etc. But the results they find are absolutely striking. Currently, you have 3% of equities from Central and Eastern Europe in optimized portfolios for investors in the EU. And the share is 0.5%, actually less, 0.3, 0.4% in optimized portfolios in Germany and France. If you had a full capital markets union, that share of Central and Eastern European equities would rise to 21%. You can see the tremendous potential impact that a true capital markets union could have. Now, there's a long way from here to there, but the magnitude of the impact, I think, is just worth underlining, because I think this often gets lost. When we have discussions about capital markets union, we talk a lot about infrastructure, we talk about stock exchanges, we talk about, arcane things like central securities depositories. The real promise is this. It's an equities market, and it's a pan-European asset class. Another way to look at it is the way market observers, some of the most influential of which are index providers, look at capital markets in the EU. All the index providers look at it country by country. So I take S&P just as one example. They categorize member states of the EU into frontier, emerging, or developed markets. And actually, more than half of the EU is not developed. It's frontier or emerging. Malta is unrated. And most of the countries in the Central Eastern and Southeastern regions are considered frontier markets. Why? Not really because they're too unpredictable, but because they're too small. And it would be, in a way, the same story as the Bank of France paper I was mentioning. The promise of moving those markets from one-by-one frontier to altogether developed is extraordinarily attractive. Now, of course, the question is what it would take for the entire EU to be considered by those guys as one category, and that's in their methodologies, not in the choices of policymakers. But it is obvious that things like integrated supervision, to name only one example to which I will come back, would play a big role in changing the way these markets are looked at. So what's the policy path for that? There's a long-term vision. I think we can agree in which we would have a fully fledged capital markets union with the promise that I outlined fully delivered upon. That would mean a uniform investor protection. Again, I insist very much on this element of trust and enforcement. I think it gets lost in too many European discussions that look at kind of the narrow angle of things like financial infrastructure. In the long-term vision, you would have financial conditions, including credit conditions, essentially decorrelated from our intra-EU borders, and including, of course, currency risk, but I'm not dwelling into that. But the point is the end of the bank sovereign nexus in the Eurozone, which, of course, was at the center of the Eurozone crisis and is the core promise of the still unfinished banking union. And then, as a bedrock for that, a safe asset of reference in some form of fiscal union. Governor Kocher also referred to that in passing. I agree with him that this requires deep changes in our policy framework, which probably have to go as far as a treaty change. So this is a long-term aspiration, not a short-term prospect in my view, unless that's the last line of my slide, events intrude in a way that change the context. But in the current policy cycle, in the current term of the European Parliament and Commission, so the von der Leyen II Commission ending in 29, it is possible to make progress and to make, frankly, more progress than has been made in the previous 10 years. There is a big element of national reforms. I think all the elements I put in that line, pension finance, housing finance, investment taxation, insolvency law, all these very important matters belong to what you could call in a bit of a stylized way, national social models. In other words, I think it is not the moment now for EU legislation to be the leading driver of change in those spaces, because the political consensus is simply not there for that. I come from a country which has spent a lot of energy recently to thinking about pension reform. I don't see the reform of pension finance in most of our countries in the EU being plausibly driven by EU legislation. And I think if you look at what the Commission has endeavored in recent years in terms of the pension, pan-European pension product, the abject failure of that project illustrates my point. Where the EU can make a difference and where EU legislation can make a difference is in this a bit arcane but very important matter of supervisory integration. And here, you know, there's some people a bit, in a bit of a facile way, always quote Jean Monnet, you know, Europe will be built in crisis, it will be the addition of solutions to the crisis. It's a great quote. It describes European dynamics very well. But sometimes it's taken as a kind of somewhat lazy, I would say, or an ambitious way to say, well, in capital markets, we don't have a crisis, so nothing will happen. We won't have reform. I don't believe that's true. And I think the reason why that's not true is that we had that crisis in the Eurozone crisis, and that created the single supervisory mechanism, European banking supervision, which is not a full banking union, but as a supervisory piece of banking union, is quite complete, up and running. There are people who grumble about it. Generally, it's a big success. And I think it has opened the space for other cases of supervisory integration to be implemented without needing a crisis for that. And my exhibit A for this line of reasoning is indeed the Anti-Money Laundering Authority, which is now up and running in Frankfurt, well, still preparing for the big transitions they will have in 28 when they will assume direct supervisory authority about a number of entities. Nobody talks about it. It hasn't been a crisis. It happened last year with legislation. It's actually good legislation, and that gives me hope that when we talk about capital market supervisory integration, we can achieve something quite transformational without needing too much drama. So the promise of capital market supervisory integration, and this slide is only about capital markets, so basically the securities space, not the full scope of the FMA next door, only the securities stuff. It's the promises of having catalytic impact, not just on market integration, which is kind of the obvious piece that, you know, you would lift border controls in capital markets if you have integrated enforcement and the same rules not only everywhere, but the same enforcement of the same rules everywhere, which is where the difference really lies. But there is also a promise of market development, and that often gets neglected again in the debate. The promise of market development is that in a well-designed framework of integrated capital market supervision, I would say unified capital market supervision, a single capital market supervisor, what Christine Lagarde has called the European SEC. In that framework, you would have better supervision. And by better supervision, I mean supervisory effectiveness that would provide more trust in EU equities and a uniform level of trust in EU equities across the EU. What do I have in mind? Wirecard is what I have in mind. In the biggest country of the EU, we had dismally ineffective supervision, including capital market supervision, oversight of the audit profession, enforcement of accounting rules, enforcement of rules against accounting fraud, in the biggest country in the European Union. And then people say, oh, Europeans don't invest enough in equities. Well, there is maybe a reason for that. And there is fraud in the United States. We can see that every day, but there wouldn't have been the Wirecard kind of fraud. It was so basic, lack of enforcement of the rules, that even under a weak US administration, the SEC would presumably have prevented that. Enron happened in the United States. It was much more sophisticated fraud than Wirecard. So it requires more effort. And this bears insistence. The promise of capital markets union is not that you will have a merger between this CCP and that CCP. The promise of capital markets union is that Europeans can invest in European equities without having too much to think about, is the enforcement of rules good enough that I can trust what is in the prospectus? And of course, there would be, and this is the necessary conditions at the political level, particularly a level playing field between competing financial centers. Governor Kocher alluded to the importance of Vienna and Prague in this region. There's a lot of competition among financial centers throughout Europe. This competition is good. It's a feature, it's not a bug. I think it was, frankly, a mistake, with all due respect, in the Draghi report to hint at the fact that there should be a single financial infrastructure in the EU. That shouldn't be the driving motivation of reform. The driving motivation of reform should be an integrated market where competition is fair and infrastructures, like other market participants, can compete on the quality of their services and not on this or that supervisory privilege that they get as national champions. So basically, we need to remove supervisory arbitrage. We need to take supervision out of the competitive field. Countries should not compete on capital market supervision. That's wrong. But with a uniform supervision, countries should compete for financial centers. And that's, again, a feature of the European Union that should not be erased from the way we live by our motto of united in diversity. So how do you do that? I think you need a comprehensive approach. I have recommended a kind of supercharged ESMA, which would be a single supervisor, but with a distributed geographical footprint, so national offices. There would be big ESMA office in Vienna, maybe next door. Possible allocation of lead roles in supervisory mandates. What does that mean? That means that the Vienna office, for example, could be the lead in terms of this or that market segment. You know that the capital market supervisory space is, depending on how you count, between 20 and 40 different market segments that each have their own supervisory framework. So you can distribute the lead teams for these different market segments across the European geography. Which is something you cannot do to the same extent, for example, in banking supervision, which is basically about one supervisory mandate, the banking license. That also means that the existing national competent authorities in their capital market supervisory, so securities market, basically, capacity would be phased out at the end of a long decade. It is very complicated. It requires a lot of legislative work. I know this kind of thing may appear radical to some of you. They're not radical at all. This is just common sense organization if you want a single market. Now, there are a lot of ways to think of incremental approaches. They're less compelling for two main reasons. One is they're more complex. And I think when we think of the single supervisory mechanism, there is a bit of realization now that it was probably the best possible arrangement for banking, which again is different from capital markets, but it's also a very complex arrangement. And maybe for capital markets, we can achieve something simpler that will reduce the frictions. But probably more important even than the simplicity is the alignment of incentives. And I won't have time to expand too much into this right now, but I've written a piece for Bruegel that goes into a lot of detail about that. When you have this division of labor between the European authority and national authorities in the field of capital markets, which again is very different for that matter from banking for reasons I can expand maybe in the Q&A, at your initiative, the division of labor can create some problematic misalignment of incentives. So here I show the Warsaw skyline. And the reason I show the Warsaw skyline is that Warsaw is a big success story in terms of financial center and financial sector jobs. Mind you, the success story, a lot of these brand new towers are filled with financial jobs. The success is not a success of Polish capital markets regulation or banking regulation for that matter, because that's not what has driven this job creation. Most of these jobs are in unregulated part of mostly banking services, and essentially they're a success of the European single market and of Polish comparative advantage in terms of skills, education, infrastructure, cost competitiveness, not capital market or banking supervision. I insist on this because there is often a misunderstanding. For example, policymakers could say, we have the Warsaw Stock Exchange and we have those, which is a state-owned entity, by the way, and we have all these skyscrapers with finance jobs. This is not a causal inference. A causal inference is the macro competitiveness of Poland and its ability to compete fairly in a single market where regulation and supervision don't play a fragmentation role, which is what most of these jobs are about. For example, risk management in banking, in large banking groups. So the concerns, what goes against reform is that some countries with comparatively well-developed markets, typically in Western and Northern Europe, are relatively indifferent to that matter. As I said, they don't have the motivations that people in Southeastern Europe should have and have to a large extent, which is that they would gain disproportionately. There are also a few countries, of course, Luxembourg, Ireland, to a lesser extent the Netherlands come to mind, where concerns about supervisory quality are very salient because they have a specific comparative advantage there. I mean, everybody knows that Luxembourg has tailored supervision for a number of market segments where they have been very successful. And some would say there might be an element of supervisory arbitrage there. I'm not making that judgment. What I'm saying is that there is a legitimate concern of the Luxembourg authorities that if you replace their supervision with ESMA supervision without reform of ESMA, that could result in less good supervision for the purposes of the Luxembourg economy. And that's a completely legitimate concern, so it should be addressed by reform. But you don't have that concern, again, in most of the regions we're talking about here in Central and Eastern and Southeastern Europe. So I repeat, in a rational world, this region should be the driver of the debate on capital market supervisory integration, and I hope that's what it will be. Thank you very much for your attention, and I look forward to a little bit of time for the Q&A.
So thank you very much, Nicolas Véron. We have time. Thanks also for being sharp on time. We have time for a couple of questions and remarks. I ask you to keep them short. Who wants to start first? Do we have a microphone? Oh, yeah, we have a microphone. It's coming. Perfect. Just a second.
Yeah, Mr. Governor, Mr. Véron, my question is capital market union is very good, but we have many problems in Europe, especially with the lack of enlargement of the Eurozone. My question is it not necessary for capital market union first to extend the Eurozone further and faster, because we have Bulgaria, but we have not really made major inroads, and still Sweden and other countries like Poland, Hungary reject to join the Eurozone, and that would be one of the preconditions to have a real united capital market. The other thing is about Eurobonds. Where do you stand here? The governor said he is at least positive about the idea, and we need also something to invest into. And when we have a capital market union, and I think something, especially when it comes to the securitization of the Ukraine war costs, it's absolutely vital to have Eurobonds, and then also the security market of Europe would be much better. So that's my questions. Thanks a lot.
So on Ukraine, we may have a very tailor-made Eurobond in the form of a loan from Euroclear to the EU, but that's a work in progress. We can discuss that, but it's not my main theme. It's a very interesting and important discussion. So on your second question, I think Governor Kocher and I agree that Eurobonds is a good thing would be a good thing to have, but it will be, there's a long way from here to there. And it should not and cannot be put as a prerequisite for making progress on other avenues for capital markets union, including supervisory integration. I included Eurobonds under the label fiscal union, safe asset, in what I presented as a long-term vision for capital markets union. I think they will happen, but they will not happen anytime soon unless they are precipitated by events. And there is absolutely no reason other than possibly bad faith for saying this is a precondition, for example, for supervisory integration. Now, on your question about Eurozone and capital markets union, the answer is, for those of us old enough to remember pre-Brexit times, the City of London. Before Brexit, we had the City of London as the natural hub of your EU capital markets. It's no longer the case now because of Brexit, but when they were in the EU, they were the hub without having adopted the Eurozone. So if you have without having entered the Eurozone, sorry. So if you have a single market, you can have effects of clustering and capital markets integration, even in the absence of fully implemented monetary union. And London in the olden days was proof of that.
Thank you. Please, here in the first row, second row, sorry. The microphone is coming.
Thank you. Thank you, Nicola, for the excellent presentation. And very good to hear that actually this region, Central Eastern Europe, would disproportionately benefit from a European initiative. It's wonderful. My question relates to more the macro context, how to incentivize accelerate capital markets union. And I'd like to hear your view about what has been now discussed about the potential for an export tax on capital outflows, which actually was quite on the agenda in circles in Washington, for example.
You mean in the US, not in the EU?
For the EU to introduce export tax, not the US, the EU, in order to keep until all the necessary conditions long-term are in place for a capital market, to keep European savings in Europe. That would be the way. What is your view, and whether that would help the capital market union?
No, it wouldn't. It would harm European capital markets, and the reason is that you won't, a bit like in the US, by the way, you won't promote the dollar as an international currency by coercion, and this is where Stephen Miran is completely wrong. And similarly, you won't promote EU integration by coercing EU savers to keep their savings in the EU. So the fact that we have freedom of movement of capital, how is it called? I don't remember the Latin expression, you will help me. Ultraomnes or something like that, that you have freedom of movement of capital, not only inside the European Union, but vis-à-vis all the rest of the world, is a strength of the EU. It was gained after much suffering in the late 80s, and it paves the way for monetary integration in the Eurozone. It would be a big mistake to question that. And I would note, particularly at the moment where we're talking about the international role of the euro, which capital controls, what you're referring to would be a form of capital control, of course. Capital controls would just kill that. And we have an opportunity right now, which I think is very significant, and Christine Lagarde has been quite explicit about that, which is frankly that if the Trump administration keeps destroying the foundations for the centrality of the dollar, that's bad news for the US, but it could be good news for Europe, because by comparison, the euro would become a safer store of wealth for the world, including in terms of offshore use of the euro. And one of the biggest policy shifts of the last few years, and accelerated in recent months, is the increasingly explicit, now I think completely explicit, recognition by the ECB that they have nothing against offshore use of the euro and providing swap lines to reputable jurisdictions that would request them. So I think there is no better way, except possibly confiscating Russian reserves, to undermine that promise than to move towards capital controls, and that's a really bad idea.
So you are, Nicola, you are a bit too confident about my Latin knowledge. So I'm passing here, but we have a question here by Governor Müller.
Erga omnes was what I was looking for. Now I remember. We're in Vienna, we can speak Latin, right?
French, actually, for historical reasons.
On the monuments, it's all Latin. My grandfather was born in the Austro-Hungarian Empire, in Nitra, and next door. And his birth certificate is bilingual in Latin. So.
Okay. Maris, please.
So I will still ask my question in English. Thank you very much for the good overview of the Capital Markets Union and where we stand and what could be done better. I was actually intrigued by the way you explained why it's more important to have a single supervisor and not that important to have a single infrastructure. So I thought I'd maybe try to probe you a little bit more. So when you bring the example of Wirecard, so I'm just wondering, Wirecard also had a banking license, so maybe it was a banking supervision problem as much as a market supervision. And I wonder, would it not be better to have more consolidated stock exchanges providing more liquidity, more trading, as opposed to just having a single supervisor? Since beyond this Wirecard example, I haven't really read about studies about investors claiming that the lack of quality of supervision is something that holds them back from investing in European equities. So maybe you can still comment on that a bit more. Thank you.
Well, basically the underlying reasoning is that typically the most important infrastructures are those that get the least attention. And as a central banker, you're well aware of that. And I think trust in financial disclosures is one of those. And you have more of that in the US than in Europe. And it's been a long journey. The formative moment of US capital markets as we know them was the stock market crisis that started in October 1929. It was then expanded by Kreditanstalt, but that's a different story. And the stock market crash of 29 was a crisis of course, boom and bust, but in policy terms was read by the US as a crisis of financial transparency and financial disclosure. And that's how the SEC was born in the early 30s. But more importantly, that's how the current defining features of the US stock market were born, including the generalization of the model of listed companies with dispersed ownership and the widespread dispersion of equity ownership in the US market. It really started from that moment when the government could tell the US public that US listed securities were not a fraud. And it gets indeed forgotten. Nobody talks about that, and that's a big mistake because this is the foundation of a solid, attractive equity market. And I will repeat, we don't have that in Europe. I've worked a lot on accounting and auditing in my limited experience as a policy analyst. And the contrast between the US and Europe is very striking in that area, much more than if you talk about financial infrastructure or banking supervision. So if you think of what's the US comparative advantage, the quality of financial transparency is a key element that gets very neglected, and that's a pity. Wirecard, of course, was a fraud across all segments of supervision. I mentioned auditor oversight, I mentioned accounting enforcement, you mentioned banking supervision, you could also mention as a payments services entity, it was a different authorization that they had and shouldn't have had. But the core of the scandal was misrepresentation of their financial position. And from that perspective, the core failure, it was multiple failures, many of them by BaFin, sadly. But the core failure was a failure to enforce the financial reporting framework, because that was how, $2 billion or whatever it was said to be in the balance sheet when they weren't. And that's what got Wirecard moving from solvency to insolvency in one day. So I think there's a lot of space for reflection here. Now, I'm all in favor of consolidation of market infrastructure. I don't think it can happen by fiat from the EU, if only because, especially when you look at this region, Central and Eastern and Southeastern Europe, a lot of the financial infrastructures are state-owned. So they will consolidate if the governments want them to consolidate, full stop. It's not purely market-driven. And so I think the insistence on financial infrastructure consolidation really mistakes the tree for the forest. The forest is trust in equities. Financial infrastructure consolidation would help. I don't think it's really the binding constraint at this point. Of course, we would need a longer full-day seminar to debate that complicated, multifaceted problem. But I think the insistence on quality of financial reporting, quality of transparency, trust in the market is something that we need to get this debate right. It is natural that central bankers, and Draghi is a former central banker, would insist on financial infrastructure because that's on their turf. They have oversight of the payment infrastructure. There are lots of connections between the payment system, CCPs and CSDs. And therefore, when you look at this issue from a central banking perspective, it is completely natural to focus on the infrastructure piece, also for transmission of monetary policy, crisis scenarios, financial stability concerns, etc. But to my mind, it's not the core of the debate.
I have one final question by former Governor Holtzmann that gives me the opportunity to welcome you, Robert. Good that you're here today, actually.
Thank you. Thank you for the welcome. Nicola, great speech, and I like particularly optimism that good regulation and supervision has this market-creating forces. My question is, and problem, that in order to create a capital market, my firm conviction is it requires pension funds. It's a necessary but not sufficient condition. And given where we are with the aging process in Europe, I don't see this going to happen, that you will have the size of pension funds involving anymore. And everything what is tried with regards to simply providing financial incentive or fiscal safety don't work. The second thing is, which is closer home, this one is a macro part of it. The second closer home to your expertise of institutions is that it's not a sufficient condition, because we can see it, Australia, perhaps the quite highest capitalized pension fund capitalized country in the world. Do they have a capital market? No. What's the reason? The banking system preventing it. And my sense is that the banking system will also not allow, even if the first condition was fulfilled, to allow a capital market. And I'm sure you would like to answer on the last question. Thank you.
So great questions, and I want to pay tribute to now Emeritus Governor Holtzmann for his support to Bruegel, particularly, but also for great insights on this theme of pension finance. I was privileged to watch his presentation recently at a big conference in Shanghai, and that was very enlightening. So thank you for that and for your questions. Pensions is a big piece. I'm perhaps a bit less pessimistic than you are on a structural level, because I think people increasingly recognize that those EU countries that have developed pension fund infrastructure, like the Netherlands, Scandinavians, Ireland, are getting a lot of benefits from that. And I think there is increasingly some thinking about benchmarking and taking inspiration from best practice. And you see that, I think, very much in the current German debate. So I think if Germany was to reform its pension system, creating bigger pension funds, that would have a tremendous effect on other EU countries in terms of, again, inspiration, and I wouldn't rule that out. So not to say I'm super optimistic, but I think we have actually made progress in terms of creating EU institutional investors more generally, also in terms of the governance of some pieces of the asset management landscape. Another disclosure I should make is that my brother is a venture capital investor. I have most of my savings in his funds, which is very bad diversification, but I'm very happy. So that gives me a bit of a perspective on this world of institutional investing and asset management. And I think there has been some steps forward in the developments of the last 20 years in Europe, even so it's not enough. Now, your broader question was about the role of the banking sector in the political economy of reform and the comparison with Australia. I think we have two things that differentiate us from Australia. One is that I think in a way, and sorry if that sounds a bit provocative, the key authority here is the ECB, of course, in the EU context, in terms of the main financial stability authority. I think of the ECB at this point as less captured by the banking industries than most central banks are. And partly that's because their banking supervisory mandate is recent, partly for other reasons, partly because they are so existentially committed to creating an effective transmission mechanism, which Governor Kocher has alluded to, and for that they need more capital markets. I think we don't have the exact same political economy as Australia, basically, and therefore that would make me a little bit more optimistic on the political side. But I think the biggest difference, frankly, is size. Australia, with all due respect, is about, what, between a tenth and a 20th of the EU, depending on what metric you look at. And I think there's a quality in quantity, as somebody said, and that creates for the European Union the possibility of having a world-class capital market that has attractiveness at a global level, which Australia cannot have. And I think that promise is part of the difference in the respective conditions.
So thanks a lot. Let's please join me and give a hand to Nicolas Véron for his excellent presentation. Thank you. And this concludes the first session, and I hand over to Jennifer again. Thank you very much.
Thank you very much. It's already time for our first panel, which will be chaired by our own Vice Governor Edeltraud Stiftinger. Welcome. Could I ask you and your panelists to start entering the stage, please? Thank you. The topic of panel 1 is promoting diverse financing sources in CESEE. And I can see I can almost already stop talking because unlike the Capital Markets Union, our Vice Governor is a high-speed happening. So I think they're almost quite ready. Welcome, thank you, and please get us started. Edeltraud, and tell us more about your panel and your panelists.
Thank you very much, and good morning again, esteemed guests, and welcome to our first panel discussion of today's conference. Well, we will now take you from a very impressive keynote speech of Nicolas to financing challenges in Central, Eastern and Southeastern Europe. In particular, with regard to financing innovation of growth, of course, because these are the issues which are most important. So I may say originally Nicolas would have joined us here on the panel, however, at very short notice, he stepped in as a keynote speaker to replace Andrea Sironi, who unfortunately could not attend today because he has fallen ill. So thank you very much for stepping in. It is, of course, a pity, on one hand, Nicolas, that you are missing from our panel discussion today. But on the other hand, and at the same time, we are truly grateful for your inspiring keynote contributions. Thanks again. Well, it was already mentioned, my name is Edeltraud Stiftinger. I'm the Vice Governor of the Central Bank of Austria, and I'm really happy to chair this first panel discussion today, simply because there is much to talk about. Simply because EU countries, including Central, Eastern and Southeastern Europe countries, are lagging behind, as we know. Lagging behind in terms of financing, in particular for innovative companies. And this is reflected, for example, in low productivity growth. And that in turn jeopardizes our competitiveness, and it jeopardizes our standard of living, as we are well aware of as well. So the question is, what financial systems are needed to support future growth, to support innovation? And to be more specific, the question is, how can we move from bank-based financing to more diverse sources of financing, like private equity or venture capital, just to name two of them? Actually, we know, of course, that this is also very closely linked to the European culture, which is simply more risk-averse than the culture in North America, for example. And there is one exception, and that is the United Kingdom, where a functioning venture capital market and the private equity market has existed for many years now, and they are very, very successful. And that's not only true for the startup phase, but it's also true for growth and innovation-oriented, medium-sized companies as well. And our former governor, Robert Holzmann, he always was, and he still is, a strong supporter of an Austrian business growth fund modeled by the British system. And he knows, of course, what cultural hurdles we still have to overcome in the year 2025. So thanks a lot, Robert, for all your efforts in this topic. But in our culture, we always have to keep in mind, entrepreneurial failure is still stigmatized as defeat and is by no means viewed positively as a kind of learning experience. That is one cultural aspect, in my view. And there is another cultural aspect we always have to consider too, namely that traditional family businesses, and we know that they have a strong influence in our economic structure in Europe, and these traditional family businesses do not want to sell shares, simply. They do not want to sell shares of their companies. However, this is, of course, a prerequisite when it comes to equity financing. I mean, we have cultural barriers to overcome, and this is always a huge challenge, as we know, but we also have political barriers to overcome when it comes to issues of different kinds of alternative financing beyond bank financing. But we need to improve, because it's about nothing less than our competitiveness, and it's about nothing less than our standard of living. And we know it from the also mentioned Draghi report that significant investment is needed to strengthen the EU's competitiveness. And innovation, of course, is the best way to safeguard our standard of living and that of our children and our grandchildren. That's really a truism today, I might say. Already, the Capital Markets Union, or what is now more or less called the Savings and Investment Union, is seen by many as one of the vehicles, as already stated at least 2 times today, to enable the financing of competitiveness, the financing of innovation or green technologies or digitalization. And we have already been talking about more than 10 years now, as we already heard today, and we know that not really much has changed since then. And that is precisely what we will be looking at in more detail within the next hour. We will address some questions like how can we ensure access to diverse sources of financing across Central, Eastern, and Southeastern Europe. The second question we want to address is what needs to happen to ensure that the Savings and Investment Union does not suffer the same fate as the Capital Markets Union, to be a little provocative. And the third question is about speed. So what do we need to do to speed things up? And to answer these questions, we have assembled a panel with enormous expertise. Please join me in welcoming our distinguished panelists. Well, here on my left, Alejandra Medina. She is head of financial economics, head of the financial economics unit at the OECD. Her work covers capital markets and corporate governance. She draws on her experience in academia, policy advice, and international finance. Thank you very much for coming. And next to her, Professor Dora Piroška. She is professor at the Central University in Vienna, and her research focuses on the international policy economy of banking and finance, as well as development finance, and she has a particular interest in the region of Central Eastern Europe. It's a pleasure to have you here, Professor Piroška. And joining us virtually is Larissa Dragomir. She is expert to Commissioner Maria Albuquerque. Larissa brings deep expertise in prudential regulation, asset management, and the Savings and Investment Union. Larissa, thank you very much for joining us, and please feel free to jump in at any moment. We want to make sure your voice is fully part of our discussion. So as you can see, esteemed guests, our panelists have a wide range of experience and expertise, and together, in my view, they can really provide exciting insights. Finally, very briefly, what is the procedure of this discussion? There will be 2 rounds of questions for the panelists, and then we will ask you to join in the discussion. And I will begin with a question I would like to ask each and every one of you, as it is so pressing for us in our field. And my question is, what do we need to do to significantly speed up access to various sources of financing in the EU in general and in the Central, Eastern and Southeastern Europe countries in particular? And I may ask you to consider 2 sides, the political side and the business side as well. So what must politicians do and what must businesses do to remove their respective obstacles when it comes to non-banking financing? And I may ask you to provide a pointed answer. We will go much more in detail in our second round. So, Alejandra, would you like to start?
Yes, happy to be here. Many thanks for the invitation. Perhaps one thing that I would like to start with by mentioning is that whenever we think about how to broaden the financing options for corporations, is that we need to think about basically 3 pillars. I mean, this is the way we thought about it at the OECD, is that we need to focus on, of course, issuers. And this is something that is sometimes forget in the EU discussion. I mean, we tend to focus too much on the second I, which is intermediaries and regulation, with what's happening in the marketplace, how do we build the rules. This is something that is very well discussed at the EU level, but we talk about very little about the issuers. How do we make their life easier? How do we make sure and ensure that in each country there is sufficient innovation, that corporations have access to cooperation with universities, that, I mean, a corporation builds from like a very small business that needs like different type of financing throughout the life cycle. And this is something that we need to ensure that a corporation an SME or a little business can have the financing they need at each stage. And this is something that in the EU, it doesn't happen in every single country, in the CESEE countries in particular. I mean, in some EU countries, there is not even bank financing available for many of these like smaller ventures. So, and the third E is investors. I mean, we also need to focus a lot more in the EU and in CESEE countries in developing an investor base. I mean, we need to focus on not only households, but we need to put certain emphasis on developing like large investors, institutional investors. I mean, nowadays, institutional investors at the global level, they hold, for example, 47% of the equity, the listed equity. Nowadays, really, households do not invest directly. They invest through like a mutual fund, through their savings, through pension funds. So these are for if you ask me, the 3 pillars that each country, each region the EU entirely need to focus on, not only discuss how do we frame regulation, what are the rules that we need. I mean, this is not the only thing that we need to focus on. We need to focus on the three elements to actually work cohesively to get more sources of financing beyond the bank lending.
Yeah.
But I'll stop there.
Thank you very much. That's really a valid argument. With your background, Professor Piroshka, do you have a different assessment or is it quite similar?
No, actually it's somewhat similar. So I'm focusing on the Central and Eastern European region. And with regards to capital market integration, the observation is that these markets do not exist in Central and Eastern Europe. On the demand side, so who is issuing securities, we find incredibly small, undercapitalized, small and medium-sized enterprises. The banks in Central and Eastern Europe do not securitize their assets and liabilities. And finally, firms, larger firms, either multinational corporations which exercise intra-firm finance, or if they are larger domestic firms, they go to stock exchanges in New York or London to raise capital. So clearly there is very little interest in funding through capital markets. On the supply, on the demand side, who would buy these securities, we also find the lack of investors in terms of no major investment funds, no hedge funds, no pension funds in most of these countries. So these markets are clearly very underdeveloped. However, there is definitely, I agree with the observation that diversified finance is needed. So what to do? The market is not delivering. And clearly in Eastern Europe, it's not a matter of regulators' reluctance to open up their market as investor markets for market integration by relinquishing national supervision, because there is very little to supervise. So what to do? In my research, what comes out clearly as the best strategy is to use national development banks to incentivize the offerings, the investors into these markets. And how they do that? Well, I find it in three particular ways. First of all, they are the ones who can create venture capital funds with a little bit of seed financing from the state that can incentivize commercial banks also from these countries, which are very reluctant to enter into equity financing, but within a state-provided, a development bank manufactured, brokered institutions, they might be actually more willing to enter these uncharted waters. In addition, development banks work right now with small and medium-sized enterprises. They finance at least 20% of small and medium-sized enterprises' needs. So they have a working relation with them. If development banks would be in a position of advancing advocacy and business consulting, small and medium-sized enterprises in Eastern Europe could be made capable of issuing securities on their own and tap benefits of capital markets. Finally, development banks are also in the position to finance larger infrastructural investments, which are necessary, as we just heard, to upgrade the macroeconomic conditions within which domestic infrastructure, domestic businesses work in Central and Eastern Europe. So this is why I think in this desperate situation, we really cannot just wait for the market to deliver. We need publicly owned development banks to step in and help with diversifying finance.
Thank you for your first insights. And Larissa, how do you view the issue of increasing speed?
Thank you very much for calling me today in, and I regret really a lot not being there with you to be able to chat also around this panel, but I try to make the best out of this panel to convey my views, which very much actually would support what the fellow panelists have already said. From the Brussels perspective, I would like to highlight also like the political part of it. What can politicians do? I think there is a political momentum that is signaled already for more than 1 year since the Draghi and Letta reports came out, which were very much endorsed by the whole political community in Brussels and in the member states. I think the challenge is to keep that political momentum very much alive until things start to get done. And I think what that needs on top is probably a change in policy-making approach, a bit away from regulation and legislative processes as the only way to make things done, and have a more cooperative approach, a shared responsibility-based approach where everyone does his part. Regulation can bring solutions. Policy actions promoted at European level can make things work, but shared responsibility is more important than ever to really speed up access and get things done.
Thank you very much. So let us now move on to what I would describe our long-term issue, namely the Capital Markets Union, which we are really finding so difficult to tackle, as we already heard today many times. Of course, let's have a closer look to the background then. And Larissa, again, you are our expert in the Capital Markets Union or the Savings and Investment Union. So the Capital Market Union has really faced persistent challenges. And the aim was a truly integrated and accessible financing landscape across the European Union, particularly for SMEs and startups in less developed markets. And the success so far is limited, as we know. The Savings and Investment Union now has emerged with somehow fresh ambition, to put it this way. So can you describe the key differences between the Savings and Investment Union and the Capital Markets Union in terms of scope, in terms of governance, in terms of implementation? And at least as interesting is the question, of course, is there a reason to be more optimistic about the Savings and Investment Union's potential to unlock really the diverse financing resources, especially in Central, Eastern and Southeastern Europe?
Yes, I think it is, because it is showing not just a change in name from long-lasting efforts to build a capital markets union towards a savings and investment union. It's showing a change in mindset. It's, as I said already, it's showing the willingness to do things not only from the top, but also bottom up, to basically look at who is best placed to do what, and guide and offer tools when this is a competence that is in member states or even the industry's hands, and fix the pipelines through legislation only where needed or only where this legislation was excessive. So the Savings and Investments Union is not an end in itself. It's really a tool, conceived as a tool that can help us finance the EU strategic priorities, which are the green transition, the innovation, the security and defense. And European citizens are clear that on their priorities. We have figures from June 2025 that say that 84% of the people support boosting competitiveness in clean technologies, that 78% are concerned about EU defense and security, that 89% believe Europe must strengthen digital technologies through research and innovation. And there is an awareness as well that things have not gone as they should have in the past, and the single market has still a lot of potential, and this is particularly important for the countries in Central, Eastern and Southeastern Europe, where innovation, ideas, entrepreneurial enthusiasm is out there, and where the sources of financing are much less developed. The need to access a bigger pool of liquidity, of capital, is one of the key drivers of what we are doing on the Savings and Investments Union. And the focus is not on Brussels changing a law. The focus is on where are the institutional investors who can actually beef up the supply side of finance. Pensions is one of the pension providers are one of the institutional investors that we were looking at yesterday. We came up with a package basically that contains the tools that would enable member states to beef up their supplementary pensions through dashboards, through tracking systems, through auto-enrollment. We also provide a bit of improvements to our current legislative framework so that the occupational pension framework is more functional, that the PEP that was indicated as a big failure maybe becomes a new tool through which people can save for long-term retirement. We are looking at retail investors as a central part of the SIU as opposed to the CMU. And we have done also in September, we have come out with a lot of measures that boost, on one hand, financial literacy, support member states in their own financial literacy strategies, and bring added value. And here I would like to say that the Central and Eastern European regions are showing maybe lower score in financial literacy, but also on the higher side, there's a lot of potential. They are above the average. So there is a lot of potential out there. We are providing for new tools such as savings and investments accounts, but to inspire member states to create these tools together with the tax incentives that could boost them and could make the retail investors take up much more investment in the capital markets, start getting trust, start supporting asset managers. And last but not least, we are looking really at the financial pipelines. We are recognizing the fact that legislation under the CMU, as it evolved, it has led still to a lot of additional gold plating by member states, to fragmentation that is not coming necessarily through rules, but also sometimes through practices, especially supervisory practices. And we're willing to basically look at these additional obstacles that have been created on top of what was supposed to create a single market, and discuss with member states and address those obstacles by removing them, by compensating legitimate with harmonized rules where they are needed, and by ensuring that everyone's legitimate interests are taken on board. So it's a different approach, shared responsibilities there. Initiative by the member states is also very much promoted through the SIU. We have the so-called competitiveness labs, where we encourage member states to get together and do maybe more regional, local initiatives with a view to support development of regional financial markets to the extent that this is compatible with single financial market that we are trying to create. And I will probably stop here, ready to answer any specific questions on this.
So thank you very much, Larissa. So I hear somehow a positive outlook for the future of the Savings and Investment Union, which is good to hear. Let us now turn to the macroeconomic perspective, and if the assumption is quite the same. Alejandra, do you want to respond immediately to what Larissa just said, or I want to add a question anyway? Yeah, okay. So my question is, what are the consequences of a deeper capital market integration within the EU from a macroeconomic perspective? And more specifically, what is the impact of increased cross-border investment and financial intermediation, also in terms of productivity growth, in terms of economic resilience, and in terms of convergence? And how should policymakers balance integration with safeguards? I think you also brought some slides.
Yes, I would like to use the slide. Not that I have a presentation, but I think that sometimes a figure makes a lot more impact than what I can say, you know. I mean, I'm not native, so probably it will be much better if I show you a figure. So basically, I would say that the main question that drives this panel is this figure. So where do we stand here? So basically here, what I'm showing you is like bank-based financing to a non-financial sector over GDP, versus on the x-axis, market-based financing measured by the, yes, I mean the right one. Market-based financing that is measured by the market capitalization and the outstanding amount of corporate bonds for non-financial companies. So where do we land here when we look at our countries in the EU and the CESEE region? I mean, unfortunately, most of the countries rely heavily on bank financing. And I'm not saying here, as I think it was mentioned in the keynote speech, these should not be seen as competitors. And this is, of course, I mean, in an ideal world, we would like every single corporation to have access to the the more the merrier. I mean, the more options we give them, the better. And we see that even when companies are listed, and even the largest one, they keep relationships with 10 banks, 8 banks. So it's not about like, oh, when I become large, I just go to a capital market and I forgot about banks. No, they need it. They still need it. But the main key issue here for policymakers is when all the countries here that we see, that they land in the bottom left corner of the graph. So this is the big issue. I mean, if I have a sufficiently large banking system that is able to finance the non-financial sector, the real sector, well, happy if that works, you know, or if the entire economy is financed by capital market and you're like on the very right-hand side of the equation, of the graph, I mean, that's perfectly fine. The problem is like when none of them is developed. When none of them is well developed and you are like in that little corner over there, this is the key. This is where the worries for a policymaker should come from. And this is why it is clearly important to also like diversify financing option. The second reason, I mean, this is the sort of more or less like the reason of the problem. But why we need also more or alternative sources of financing beyond bank loans. We all know, and I think I apologize because this graph was done for an Asia capital market report and I haven't prepared for the entire world or for Europe. But as you can see, I mean, equity and market and corporate bond markets, they're much more well suited to finance long-term investment, innovation. I mean, they're risk-sharing tools. I mean, equity is a risk-sharing tool. I'm not gonna give a class here, but that's the main reason why we need that. I mean, the problem in the EU, mainly, I would say, I have been doing like some surveys with companies at the EU level, and the biggest issue is that many companies that do not use capital market, neither bonds, neither equity, they don't want to share their ownership. As you were mentioning, they don't want to issue equity because they don't want to lose control. Then you say, okay, but let's do like a market where you can issue shares with different voting classes, but they don't refer about voting classes. What they mean is that they want to keep control over the basically mixing the accounts of the owners with the accounts of the company. They want to have discretion on like, well, my entire family, their cars are basically under the name of the company, and this is an expense. So this is what they meant by keeping control, not by being outvoted in a shareholder meeting. So this needs like a cultural change, you know? I mean, just to change that mindsetting of some entrepreneurs, I don't know, we maybe need like some campaigns. I mean, we sometimes recommend to countries, do a campaign and educate your companies. Like educate them about the benefits, you know? I mean, what are the benefits? More innovation. We talk about plenty, about like the productivity gap that we have in Europe and in the CESEE countries. So this is one tool to address that. I mean, this is one of the benefits. The second benefit that this will bring for sure, I mean, to have like more developed capital markets, and when I say capital market, I also mean private equity, private debt, venture capital, is that companies will have more options, companies will become more resilient. We need to add equity to their balance sheet. Unfortunately, I know that many owners of businesses, they like debt because this is leverage. I get my returns, my returns are higher. Why would I share my company, my venture with externals if I'm the one who knows the business? Yeah, but like when things go sour, that will help you. That will make you be more resilient. So this is also a second benefit, like not only like closing the productivity gap, but the second one will be like actually to increase the resilience of cooperation. If we add other sources of financing, balance sheets will be more resilient, and that will be better for the entire economy, for the entire region. And the third one is like, of course, we would like the CESEE region to converge with the EU, with Europe, and this is something that for now we don't see it. While I think that the GDP share of like the CESEE region in the world is like over 2%, their share in terms of like market cap is 0.3%. So there is plenty of room to actually continue growing, and if we put it as share of the EU, it's exactly the same case. That there is like, I mean, what the way that it suggests your GDP and there's plenty of room to continue growing in terms of the capital market. I mean, unfortunately, one thing that happens with capital market or with sources of financing beyond banks is that sometimes we need scale. These markets work when there are more issues, more securities, and more investors. And this, from the political side, we may need to accept that some exchanges will not exist anymore, or that some platforms will have to die in the process. This is the cost, and this is what is very hard to give up, and this is what many politicians and many currently owners are they don't want to let it go. And it's normal, it's completely understandable, but this is the cost. I mean, for having, if we want to have a developed capital market, I mean, yeah, we can, but we cannot have these many platforms where we trade, these many exchanges. And the other advice, perhaps, to CESEE countries and also to EU is that we tend to look only at the US. We look at the US as the biggest example. But nowadays, half of the listed companies list in Asia. Like Asian markets, and I'm not talking only about China, I mean Vietnam, you should see, I mean, they have more listed companies than in France. I mean, Vietnam has they also have, for example, they have come up with other type of markets, second-tier market, third-tier market, so like the MTFs in Europe, but with a little bit more flexible regulation, but I will stop there.
Thank you very much. I couldn't agree more. Professor Piroshka, from a political economy perspective, where do you see the biggest obstacles to significant progress? And to add another question, why is it so difficult for us to implement the integration of EU capital markets to introduce the Savings and Investment Union? And is it a matter, in your point of view, of national interests that are holding us back? Or is it about regulatory fragmentation? Or is it a combination of everything? What is your assumption?
Okay, thank you for the question. Yeah, I'd like to talk about Eastern markets, Eastern European markets in my response, and it was very, very insightful what's happening in Asian market, but in Eastern markets, the 2008 financial crisis clearly made East European regulators to learn a very important lesson. And that lesson is that capital has a nationality. During the liquidity crisis of 2008, Eastern regulator learns that the stability of their domestic financial market may not be a priority for Western regulators, for foreign banks headquarters, or for the ECB for that matter. So financial nationalism is something that underlines many of their financial and banking policies. This we see in the reluctance of Poland, Hungary, Czech Republic, Romania to join the Eurozone and to join the banking union. Now with capital markets, I mentioned already, the situation is very different. Here, structural differences in Eastern markets creates a dilemma for Eastern regulators, and they would like to see more diversified findings, but the structural obstacles and the European Union's reluctance to consider the structural obstacles in its policy initiatives, how actually to bring more finance to Eastern market, is something which is inciting more activism in their financial and banking strategies. So as the European Union, through its failed effort of the Capital Markets Union and Savings and Investment Union, is not bringing more finance to this region, what do we see? In my research, I find 3 different strategies how activist Eastern regulators are trying to bring in more financing for their economy. The first one is quite interestingly based on blockchain technology. This we see clearly in the Baltic states. They have reduced regulatory requirements for crypto investors, created investment and sandbox hubs for fintech corporations in order to create their market, liberalize their market for more crypto and fintech innovations. Also in Poland, I just learned, there is a very innovative payment system developed by commercial banks that is now a competitor to Visa and MasterCard on the Polish market. However, blockchain technologies-based financial activism has brought very mixed results in the Eastern markets. We've seen some important improvement in Latvia and Lithuania being able to both invite investors, such as Revolut, relocating in these countries, also homegrown fintech innovators, such as Wise, which is also a bit controversial. And so this is the second side of the issue. Crypto and fintech so far has not developed use cases in the Baltic states or elsewhere to actually channel savings to investment in these economies. So in addition, there is also secrecy-seeking capital, which are using these blockchain technologies for their own purposes, which are very different from the intentions of these regulators. Now, the second strategy that I see that East European countries are doing in order to channel savings to investment is financial nationalist strategies. Here, what I see in Poland, Hungary, but also to some extent in Czech Republic and Slovakia, is that they promote domestic or state-owned bank ownership. There is a number of preferential credit lines developed for small and medium-sized enterprises, and they also see increased taxation on banks to better distribute the revenues from finance across a larger set of members of the society. Now, the result of this strategy is again, a bit questionable in a sense that we haven't seen any banks changing their neither state-owned nor domestic-owned in Poland and Hungary to actually shift away from household finance, mortgages, and primarily this retail sector into actually financing small and medium-sized enterprises. Also, we see that the small and medium-sized enterprises that during COVID in Slovakia and Czech Republic has been receiving subsidized credit, those subsidized credits are vanishing from the market. So the financial nationalist strategy has not necessarily brought the fruits that the Eastern regulator hoped it would, not to mention that in Hungary, which is pursuing an illiberal version of these financial nationalist strategies, the banks are not only providing subsidized credit to the larger segments of the market, but specifically to Orban-related businesses, undermining rule of law and other democratic values of the European Union. And finally, the last strategy that I see in Eastern market, and this is what I already said in my expose, is development banking. Development banks' capitals have increased dramatically, at least in some countries, in Poland, but also in Hungary, and in the Baltics over the last couple of years. And development banks have been very active in creating not only conditions for diversified financing, but also to create such ecosystems of economic actors that are capable of innovation, growth promotion, and export promotion also outside of these countries. So development banks have been pursuing a number of strategies that I find very interesting. One of them is they provide alternative financing when the governments in these countries, and my research is primarily on Poland in this regard because BGK is by far the star of development banking in Eastern Europe. So the Polish government have been facing the problem that the Commission and the EIB, the European Investment Bank, was reluctant to fund coal mining, right? It's against commercial bank ECG requirements as well. But coal mining is a very important sector in Poland. You cannot leave that sector for political but also for social reasons without any financing. So this is where BGK stepped in and provided funding for coal mining. BGK is also providing 20% of financing for small and medium-sized enterprises, right? That's huge. That shouldn't be. I talked to these development bankers. They say they have a robot to do that for them because there is such demand for small and medium-sized enterprises, guarantees, soft loans that are not provided by the commercial banks. And here is where BGK steps in. BGK also steps in providing ecosystem financing when large multinational corporations invest. For example, Google is about to invest in a large data center in Poland. For that, it doesn't need any financing needs. However, it requires clean energy to run that data center. And this is where BGK steps in, providing offshore wind and solar panel development, but also financing electric grids that no commercial interest exists in financing those kind of infrastructures, right? And BGK steps in, and Google can go ahead with developing the data center, right? So I find that there is a lot of potential in development financing in Eastern Europe. BGK is also has grown enormously, not only in terms of capital, but also the personnel. It has hired commercial bankers and people from advocacy, business consultancy. These people are in absolute good position to provide business advising for small and medium-sized enterprises, as only BGK had the license. So this is something for the Polish regulator to please enable BGK to do more for the Polish economy. So this would be my 2 cents on this issue.
So thank you very much. And we've heard different approaches so far. Thank you very much for your contributions. I would like to bring in other voices from the audience now. Who would like to go first? I see here over there, there's the microphone. Okay. And may I ask you to please share your name and the institution?
Yes, I'm Sunčica from Central European University. I have background in economics and data science. Thank you for the panel. I found it very insightful. I have a question about the graph Alejandra shared, but any of you can elaborate. So you had investment score on the y-axis, and then you had capital markets financing as a share of GDP on the x-axis. And it seems that countries, like larger economies that have larger GDPs, also have larger investment scores, and they're more kind of likely to leverage capital markets financing. So my first question is if you could briefly share how is investment score calculated? And the second question is, how can these smaller economies that were closer to the origin leverage policy space in order to increase their investment score? Thank you.
Thank you very much. Who?
Yeah, thank you for the question. I mean, the investment score is actually based on a mix of, for example, number of patents, numbers of new inventions. So it's literally measuring like innovation. It's not prepared by us. We take it from an external institution. And the way that many economies have moved, I mean, and what we have in the x-axis is actually the size of capital markets to GDP. So it's basically scaled by GDP. So the way you move, like, I mean, there are many different, from the policymaker's perspective, what do you do to actually get to the top of the graph, right? You would like to be in the top corner, right-hand side corner. So the role here, first of all, sometimes it is important to put this discussion into the politicians' speeches. I mean, in many of our economies, it's not politically correct to give incentive to capital market development, for example. I would give you the example of Sweden. In Sweden, they have a very successful capital market under the same rules that many other European markets. And one of the issues, the key discussions is they discuss this, politicians, they put this on the table. I mean, they are not afraid to say we would like to put like a tax incentive, we would like to generate like different tax incentive for, let's say, an IPO, for expenses on this. This is not an issue for them. I mean, and the public liked these discussions, they probably vote on this as well. But in other economies, this is completely, no, we cannot talk about this, you know. We cannot think about giving like an incentive in a, for example, in a tax saving account, because this will go only to rich people, and then the poor people will not get actually any benefit from this, so we will not do it, we will not implement. This is completely like against different governments, and the politics of it is clearly like a problem. But there are several incentives, for example, like as my colleague here was mentioning, like, I mean, development banks have a bigger role to play in actually matching or coordinating with the private sector in actually pooling financing to fund all these areas. You know, I mean, sometimes you need to decide on, I mean, why sometimes Asia is so successful in financing these sectors, because they pick on. I mean, they have a policy to say, okay, we have an industrial policy, we would like to be the leaders in AI. So let's 100 flowers bloom, and then 1 or 2 will become like, I mean, bigger in the market, and this is what we would like. So they put money on it. I mean, they put resources. I mean, there are like, you could have like, I mean, VC funds, you can have seed funds that they probably like, I mean, not every single venture will be successful, but some of them there will be. The other thing that they normally do as well is supporting like smaller ventures by having different platforms. I mean, in the world nowadays, there are 16,000 listed companies in MTF, second-tier market, third-tier markets. I mean, this is like a wonderful example. These markets list more technology companies and more healthcare companies than the main markets do, but you lower the requirements. So you have to have like a political willingness or a regulatory willingness to actually say, okay, I will lower the barriers, I will not ask for a prospectus, the corporate governance requirements will be lower, disclosure will be less frequent, something, I need to give up something. Some others, they put incentive for research on these very smaller firms to actually make them more liquid, make them more attractive for investors, but I will stop here, sorry.
Do you want to add something?
No, I think.
No? Larissa?
Maybe the only thing I want to add is not just to look only at the financing part. I mean, we are trying to bring more financing in. We're trying to convince member states to change their mindset and speak about tax incentives for capital market financing. But I think we have to keep in mind that this needs also a broader ecosystem that goes beyond finance. And that's also why so many successful startups and scale-ups are actually leaving Europe, not only because of financing, but because of the rest of the ecosystem that is much more available. So my call would be also not to forget that part and focus only on finance. A business case needs to be built through many other tools.
Yes, I think you're completely right. Are there more questions? Yes. Here in the front, maybe we start here.
My name is Günther Fehling. I'm a development economist and expert for Central and Eastern Europe with 20 years of work experience, especially in the sector of SMEs. And Professor, the question was, you made a very good speech, actually, congratulations, about development banks and the problems of access to finance for SMEs. And my question is about cross-border mortgage financing. I give you some examples of my clients and friends, for example. Tetovo and a family from Macedonia is very successful in tourism and in bakery, for example, in Macedonia, in Croatia, in Rovinj. They are very successful. They have a lot of money, revenues. They come to Vienna as well, very successful in the sector of tourism, bakery, restaurants, and they have many assets. But their access to loans is almost impossible because of a renationalization and a very nationalistic regard of every business case by the national banks and by the commercial banks in Austria and all EU member states. Yeah? So cross-border mortgaging is almost impossible for families, especially when they have a migrant background. And this is a huge problem because we force them into informality, which we don't want as public policy. We don't want them to transport cash in cars back to Kosovo or to Macedonia, but that's what they do. And because we force them, they are getting rich, they have a lot of assets again, they could be formalized, they could be really growing much better with access to bank finance, but they cannot because of our policy restraints and because of our risk complaints and all these other things. What's your ask and what's your call, what's your experience in that sector?
Thank you. I will collect 2 more questions. Okay, here and in the first row.
Piroska Nagymohácsi, LSE. Thank you for the panel. One thing that I like to go back to Alejandra's initial introduction is you said the importance of institutional investors. Maybe we should not forget that actually there were a lot of private pension funds in emerging Europe in the 1990s, but they were actually confiscated in the context of weak public finances. But it was not only emerging Europe. Portugal raided private pension funds. Ireland put a tax on private pension funds. So there's a lot that has to be said about that institutional asset class not to be developed because of macro policies. That's one small comment. The other is for Piroska Dora, almost my namesake in anniversary order. So you said that these Central European nationalist strategies overall, but wouldn't it be more balanced to say also that it's a mixed strategy? Because as Nicolas said, domestic savings, so to speak, in the region is really low. So you do need still, very importantly, the global, international, cross-border banks and other type of financing, cross-border, not only national strategies. And given the drawbacks of, some of the development bank-related, activities, I just want to highlight that international, multilateral international institutions, EIB, EBRD, can be used also for SME finance for more balanced approach. Thank you.
Thank you very much. Nicola.
Thank you, Nicolas Veron. My question is for Professor Dora Piroska on the benefits of development banks. So you basically highlighted the fact that they were very useful, but of course they have access to public money. So the real question is, how more useful are they than other users of public money? What is the efficiency of the use of public money here? So my question is just about the existing evidence for that. Do you know of any truly independent evaluations of the value added of those development banks? And can you cite a few examples of such evaluations if they exist? Thank you.
Thank you. So who wants to start?
I can start. So thank you for the questions from our development economist colleague about the cross-border mortgage finance. So this is indeed definitely a problem all across Europe, I would say, right? It's not a Central and Eastern European specific problem that retail banking particularly doesn't exist. This is a big difference also to the US market, right? Where cross-border, cross-state, right, retail lending is a thing, whereas in Eastern or in Europe, it doesn't really exist. So I would say it's not a particularly East European problem. The one example, again, from Poland that I saw, and it's trying to deal with it, is a collaboration between BGK and Credo Bank. Credo Bank is a subsidy of PKO Bank, a state-owned bank in Ukraine. And BGK collaborates with this Credo Bank to find business opportunities for Polish innovators and investors in Ukraine in a win-win basis, right? That would both enable market access for these Polish innovators, but also would allow Ukrainian partners to benefit from these market opportunities through local financing that is provided by Credo Bank, right? So development banks on their own obviously are not going to solve this big and underlying European structural problem, but there might be ways that they can work out that is different from commercial banks or credit markets, provided opportunities. Thank you, Piroska Mohácsi for the questions. Indeed, international financing is very important in Eastern Europe. For the kind of transformation that is needed in Eastern Europe, climate mitigation, digital transition, and to handle a very important structural problem, namely labor shortages in both skilled and unskilled labor, we need more finance. Clearly, the most important source of funding in these economies is FDI. Even though FDI has scaled back a little bit from the West, FDI from the East picked up quite a bit, coming from China, but also from other Asian countries. So that's definitely there. And I would also agree with you that multilateral lenders, such as the EIB and the EBRD, are also very important sources of funding in Eastern Europe, especially as they collaborate with national development banks. They work out joint project funding of financing, which are very good. So Nicola is not liking my expose on development banking. He needs evidence, which I will not be able to provide in the form that he would like to see. I cannot cite sources which would clearly show that development banking are superior in other form of state subsidies. The only thing I think that might warm Nicola's heart is to know that these are market-based opportunities, right? These are definitely not something that are only politically designed and delivered subsidies to certain market actors, but actually goes through a banking logic, which requires that these whatever loans or subsidies are provided will actually be paid back, right? So in that sense, I see, at least in logic, a difference, if not superiority, to development banking as opposed to other. My other evidence for why it works or why it might work and might work better in Eastern Europe, is because it works tremendously well in Western Europe. If you look at KfW, the German development bank, or BP France, or CDC in France, these are some of the most important tools of the French and the German government to deliver economic growth in certain sectors that would not necessarily grow on their own. So these are my 2 cents.
Thank you.
And so many thanks for your question on institutional investors and in particular pension fund. I agree with you, we cannot forget about history, but I think that now history should take a second place because we have a future to finance here, and pensions are a pressing issue in most of the countries that we're talking about. Many of these countries are suffering big pressure in terms of to balance their budget, and pensions is a big expense. So, and one solution to actually finance pension is to have them backed by assets, where either the government through taxes put contribute into these funds, or that people in their own accounts they contribute into these funds. The big issue here is there is of course a political decision in some of the CESEE countries that I have looked into. They have tried to develop now asset-backed pension funds, which is a very welcome development, but we're not there yet because the portfolios end up being extremely conservative for the moment. They end up investing only in government bonds. So I understand that. There is a political dimension to it. No one wants to play around with public money. No one wants to be, my first job was in a pension fund, and my CFO, he was said, I need to be so careful because I don't want to be burned in the public thing. People will kill me if I go wrong. So it takes years for them to actually increase the risk asset allocation in the portfolio, to have more equity, to have private equity, to have alternative securities. It takes time. The other side of the coin is that in some of these countries, there are not that many securities available. So they end up investing in sovereign bonds because there's nothing else, basically, unless you want to let them invest abroad. Hopefully one day we will not have these borders or with these concerns, but I understand the political dimension to it, that you should ideally, in a portfolio allocation, some of these countries are not even emerging, they are frontier markets. No one will advise you, if you ask a financial advisor to put 100% of your portfolio in a frontier market, no one will advise you that. So everyone will advise you a balanced portfolio allocation between developed emerging markets, between equities and bonds. So definitely it needs time. And hopefully one day we will see something like in Sweden, like in Japan, with big pension funds backed by assets, because it's not really sustainable over time otherwise.
Thank you very much. Larissa, do you want to come in here too?
Maybe one word also on the pension funds. Pension funds should not be, a tool to develop capital markets. They may have this effect, but they have to be primarily conceived and constructed in a way that they benefit the retirement needs of the people. So it's a secondary effect. That being said, also, I wanted to point out that the package that came out yesterday from the Commission contains a document that is about guidance on the prudent person principle, which is meant precisely to say how pension funds can actually venture a bit more in their investments and not be extremely conservative, obviously subject to professionalism, to scale as well, to the duty to balance rightly return and risks based on liquidity, diversification, and so on. And this is very much inspired by models such as the Swedish and the Dutch one.
Thank you very much. I think we could go forever, but we have to stay on schedule. So I'm very sorry that we could not answer all the questions that would still be in the room, but maybe there are some possibilities during the break. So thank you all for your concise and thought-provoking comments throughout the whole discussion. And esteemed guests in the audience and online, please join me in thanking our panelists for their insights today. So thanks again and enjoy the rest of the conference.
Welcome back. It's time for our academic session on how to enhance financial inclusion of households and SMEs. The session will be chaired by Julia Wörz, the head of our division on all things Central, Eastern and Southeastern Europe. We're happy to have her here. Please tell us more about the session you have planned and who is joining you on the stage today.
Thank you, Jennifer. So the session now will stand out a little bit. It is not a policy discussion. Instead, my colleague Elisabeth Beckmann and Julia Korosteleva will present first findings of ongoing research projects. So we will have two excellent paper presentations now, which both look at the micro level. Elizabeth will focus on individuals' access to finance, so financial inclusion in the classical sense. And Julia will present an analysis of SMEs and how new technologies alter their access to finance, but also their costs of financing, as you will show us. So you may wonder why we are talking about capital markets, and then we include two papers which actually deal very much with relationships between individuals and small firms with banks. Yet, for sure, and also this has been said often, the financial markets in this region are very, very much dominated by banks. And individuals and small firms enter financial markets first through banks. And therefore, I think it's really important that we need to understand very well what happens of this early stage of market participation. So let me very briefly introduce the two speakers. I start with Professor Julia Korosteleva from the University College of London. She's an expert in entrepreneurship, finance and innovation with a particular focus on sustainable and inclusive economic development. And she has published widely in leading international journals and has also been involved in a number of European research projects, including Horizon 2020 initiatives. So I'm really delighted that you could make it and you are here with us today to share your insights. Welcome.
Thank you.
And I'm also proud to introduce to you Elisabeth Beckmann, senior expert at the Österreichische Nationalbank and my colleague in the CESEE division. It's a real pleasure to have you here on this panel. Elisabeth is a core team member of our Eurosurvey, OeNB Eurosurvey team. She will tell more about this survey, which examines a number of questions on Euroization, financial behavior, trust and expectations of individuals in 9 CESEE countries. Elisabeth has a rich background in East European studies, Slavic languages, international finance and economics, and she also serves as the country desk economist for Bosnia and Herzegovina and North Macedonia in our team, and brings also rich research experience from her time at the World Bank and the Deutsche Bundesbank. So welcome, Elisabeth. So we will go first with the presentation by Elisabeth, immediately followed by Julia's presentation. And please do take notes or remember your comments and questions, because there will be time afterwards for a discussion of both papers together. Elisabeth, the floor is yours.
So, good afternoon or good morning, everybody, and thank you, Julia. And above all, let me take the opportunity to say a big thank you to my wonderful colleagues who've actually made sure that we can be here today on the organization and also the content. I'm going to present a paper which is joint work with Antje Hildebrandt, I'm sure you've met many of you, and Sönke Bergmann, who unfortunately is sick today, like many of us. We will look at, as Julia said, at financial inclusion and how the local banking landscape and changes in the local banking landscape influence financial inclusion. Before I start, let me say this is work in progress, so we really would welcome comments and questions, especially actually from the policy side. So where should we go in terms of policy questions? And of course, we are all central bankers. The usual disclaimer applies. So what do we mean by financial inclusion? We will follow the established definition. So we say it's not just about access, but also about regular, meaningful use. And for developing countries, research has shown that financial inclusion drives savings, investments, and entrepreneurship. This is mainly based on field experiments. However, for both advanced and developing economies, there's research that looks at how bank branching and branching into poorer areas influences inclusion. And it shows that with increased bank branching, financial inclusion also of poorer households increases. Now, more recently, this research has been complemented by studies on digitalization, and you find that yes, digitalization improves financial inclusion, so it boosts financial inclusion, but for households and also for SMEs, distance still matters. Now, looking from the supply side to the demand side, there's a literature that stresses the importance of trust, and especially for countries that are experienced financial crises, lack of trust is an issue for lack of inclusion. What I find very interesting is a paper that also shows that distance also influences trust. So the further the bank, the lower the trust. And this last finding, I think, is very interesting in the context of the developments we all experience at the moment, that bank branches close. So in the euro area over the last 10 years, about 40% of branches closed. Now for CESEE, the previous panel has actually done a very nice job so that we don't need to motivate this. If you think about the scatter plot, CESEE economies are bank-based, domestic deposit-funded financial systems. So for these economies, attracting households into the financial sector is really essential, and non-bank financial intermediation is still quite low. The CESEE economies, however, experience the same trend of a strong debranching. We show that in a paper with Jette. About 30% of branches closed over the last decade, so it's similar to the euro area. And the chart shows that this debranching happens against the background of, in several countries, still quite limited use of online banking. And what we want to do in our paper is basically sort of take these two observations. Okay, you have a decrease in branching. How does it affect financial inclusion? And what we look at in terms of financial inclusion is, on the one hand, bank account ownership, and on the other hand, cash preference savings. And if you are very busy being digitally included, the finding is that branch closures affect inclusion in terms of a higher preference for cash. Okay, so we first look at how did inclusion in terms of bank accounts develop over time. What we find is that over the past decade, inclusion has really increased substantially. So in several countries, the share of households who now, or individuals who have a bank account, is now close to universal. It's in several countries above the level of the US. I took averages across years here, so the blue bar is 2013 to 2015, the light yellow corporate design. Yellow bar is 2021 to 2024. In some countries, of course, there's still quite some substantial gaps, so quite a high share of people who don't have an account. But just looking at this chart, you could say, okay, why don't you drop like at least 3 countries from your analysis? We don't, because this chart shows that even among those who have a bank account, the preference to save in cash, so if you have a bank account, people state they still prefer to save in cash rather than at a bank account. And that's actually the majority of households we interview between 2021 and 2024 in 7 out of the 10 countries we analyze. So clearly inclusion, or how the bank branching network affects these changes over time, or the stability, is quite relevant. What we do for our paper is what's the basis for our paper? It's 2 data sources. On the one hand, the OeNB Euro survey. It's a really rich data source we collect here since 2007. It covers 6 EU member states and 4 Western Balkan countries. It's a repeated cross-sectional survey of individuals. And we have face-to-face interviews and about 1,000 respondents per country and wave. The questionnaire focuses on financial behavior. The countries we include don't have the euro as the legal tender. Croatia was included until 2023, so it's still part of the analysis. What is key for us is that we have the approximate address of the household. So that allows us to link the household with the really nice data set we have on the right, which is the universe of bank branches in 2021. And we have, that data is mainly collected manually, so web scraping exercise, but also from central banks. Thanks a lot to the colleagues who sent us the data. And we have that map for 2021 and for 2023, so 2013. So we can look on the one hand on changes in the bank branch network from 2013 to 2021, and then we can link the bank branch to the household. And after all that data collection, this is the map we get. So the blue dots say that's a household and the distance to the next bank branch increased. The red dots say it's a household and the distance to the next bank branch between 2013 and 2021 decreased. The message is, okay, blue dots are slightly more frequent. However, there's also red dots, and the distance change is not so huge. So both in 2021 and 2013, 75% of households have a bank in 5 kilometers, 90% of households have a bank in 10 kilometers. What did change is the number of branches, and that actually mirrors this 30% decrease. So for urban households, the average number of branches decreased from 12 to 8. Now, if we want to look at how does this change in branching affect financial behavior, and we define financial inclusion as having a bank account and cash preference. Those two are obviously negatively correlated, and you can basically fall into 3 categories. You can have a bank account and no cash saving preference. You can have no bank account and a cash saving preference, or you could have both. And for the microeconomists here, I'm trying to illustrate a bivariate probit. And in our analysis, in the regression analysis, we then control for effects like country, time, and socioeconomics. So you have education, labor market status, income. I think the results are what you would expect. They're pretty straightforward. What we focus on is the issue of trust and crisis experience. How does that influence which category you fall into? And then digitalization, do you have internet access? And also this local banking market and the changes in the local banking market. The results I will present are always in terms of a probability. So for example, for trust in banks, people who trust banks are 7 percentage points more likely to have an account and no cash savings compared to people who don't trust banks. And similarly, people who trust banks are 4.5 percentage points less likely to have no account and cash savings. And the same exercise you can do for remembering financial crises. So if you remember a crisis, for example, during transition from planned to market economies, you are 10 percentage points less likely to have an account and no cash savings, and 11 percentage points more likely to have an account and cash savings. So basically the message is, if you trust banks, you are more likely to shift into the banking. If you remember a crisis, you are more likely to shift into cash savings. Now, looking at this bank distance effect, I think there's 3 very interesting findings. First of all, we find it's not just the physical distance that matters, but it's also your perception. So how far is the next bank branch in terms of how easy is it for me to reach affects how I save. And you can explain that, for example, by commuting, of course, into a bigger city, then your place of residence is not the relevant point. And what we find is for banks that are perceived far, people are less likely to have an account and more likely to have cash savings. The physical distance affects mostly whether you have an account. And this is looking at one point in time, so taking a snapshot of the household and taking a snapshot of the current banking network. And for the internet access, again, taking a snapshot now of do you have access, yes, no, shows a positive correlation with bank account ownership. Moving to the changes in the bank branch network, we find that if a bank closes around your vicinity, this increases cash preference. And that's controlling for everything else, so holding everything else constant. And let's briefly try and take a moment to understand the sort of magnitude of this effect. So in our data, we have about 48% of people who say they have an account and cash savings. That increases by 4.6 percentage points, the likelihood that you fall into that category, so you increase from 48 to about 53, and that's a relative change of 10 percentage points. So it's quite substantial. It's not huge, but it's quite substantial. Now, the microeconomists in the audience will probably have been thinking, okay, what about endogeneity? Because, of course, banks choose their location where they have their branches, and also where they close their branches depends on the neighborhood. So it depends on how rich the households are that live close by. What we do to address that point is that we look for factors that sort of are not correlated between them, between the household and the bank, but we find something that influences the bank's decision from a higher level. So either the headquarter or at the level of the financial system. And there are 3 factors we identify. The first is, so if several banks decide how to change their branching network, that affects concentration. And that's not primarily driven by the household. The second factor is bank failures. It's unlikely that these are driven by the household. And the third factor, which has been shown in the literature, that if banks merge, they are more likely to close branches. And there's different statistical methods to apply this. So the third one is IV strategy. The other ones we just implement in the bivariate probit. And basically, we find our results are unchanged. So closing a branch significantly raises the probability that households prefer cash. Of course, we've done several robustness checks, and as I've said, this is work in progress. I showed the huge differences between countries. We are working on understanding these better. Also, at the moment, we use as the crow flies distance between household and bank, and of course, especially in mountainous regions, probably travel time would be more appropriate. So actual travel time. We are also looking at different sort of indicators of financial inclusion, so looking at, for example, pension funds, life insurance, other indicators. But in the interest of time, let me just summarize and conclude. So we find that account ownership has increased significantly in CESEE over the past decade. Cash preference in many countries is persistently high, and both physical and digital access correlate with inclusion. However, reduced branch presence correlates with greater cash dependence. And if we want to sort of take a step back from being researchers and think about what does this mean for policy, of course, physical access is not, the effect of physical access is not equal for all segments of society. Some might be even more hit by a branch closure, especially low-income households. And then for CESEE, one issue I think is worth considering that this finding I mentioned before, so trust also depends on distance, and trust is already quite significant for these countries. So increasing distance to the bank branches might exacerbate this effect.
Thank you. So we move from individuals and their access to finance to small and medium-sized enterprises. To Julia, please.
And where is my?
I think it will come up. Yes.
Okay. No. Yeah. Good afternoon, all. It's my great pleasure, actually, to be here today and share the results of our collaborative project. And I would like to thank organizers and those who invited me, actually, to take part in this conference. So, as I mentioned, this is a joint project with colleagues from Kazminski University, and it's basically the project which was founded by the National Science Center of Poland, and the actually principal investigators for the project were actually partners from Kazminski University. The project is led specifically by Aneta Griskevich. So what we do in this study, we focus exactly on how recent advancement and banks adopting various types of digital technologies, how this actually helps easing financing constraints for small and medium-sized businesses across European countries. And when I talk about easing financial constraints, so specifically they focus on access to funding, like bank funding, distinguishing between its maturity, like short-term, long-term. Then we also focus on the cost of intermediation, cost of credit, and since it's sort of a big project, we also extend now the focus to SMEs performance as well, to what extent basically then this easing of financial constraints affects SMEs sales growth through these various financing channels. Why focusing on SMEs is that because they appear to be the backbone of the European economy, and also in terms of contribution to the European economy, so they account for more than 50% of its GDP creation and also employment creation. And the literature vastly actually documents that SMEs are financially more constrained compared to larger size businesses, and this imposes actually a significant impediment on their growth opportunities. Theoretically, actually, when we look at this financial gap between SMEs and larger firms, it's generally explained through inherent information opaqueness of SME, which is attributed due to lack of appropriate financial statements and lack of credit history. Quite often, much weaker performance, financial performance, they demonstrate high probability of failure as well. And these all exacerbate actually risks for banks, and they demand actually for collateral, but SMEs notoriously lack basically collateral because of the lack of tangible assets. So altogether, these tend to exclude actually SMEs from sort of access to banking finance. Now, more recent advancement or developments of financial technologies across different spectrum of provision of financial services were largely driven by financial technology firms, but also big technology firms. And as you can see, like from this graph specifically, we observe this green bars shows a share of non-bank financial sector, among which we also have like other financial institutions, which are comprised also of fintech. So their share in global financial services has increased substantially over the past years, reaching like roughly about 26% vis-a-vis, say, 39% for traditional banks. In the literature, so far, the focus has been largely on fintechs and how they facilitate the provision of credit, whereas then the role of banks was pretty much neglected in this respect. And actually, what we notice also, banks tend to lose their competition in provision of some financial services to fintechs with the acceleration of the development of financial innovation tools. Now, so in this paper, we specifically just focus on banks. We don't focus on fintechs. And we look at then how then these financial technologies they adopt, like more specifically digital technologies, how they facilitate the access to credit. Drawing on the literature here, so we expect a positive effect on the augmenting of the liquidity provision to SMEs through greater information availability and data sharing. Also, like obviously credit assessment algorithm change as well, using more data, and they become more precise, drawing also on some real-time transaction data. So they reduce actually potentially risks for bankers, and so also this closely linked to the potential reduction in the need of collateral requirements from SMEs. Now, also we expect a shift from more sort of traditional banking to, once again, which is relationship-based for SMEs, to more sort of transaction-based banking with the development of financial technologies. So, and reduction on the actual reliance on physical branches. So the application process itself also becomes much faster for SMEs with a transition from this relationship-based to transaction-based banking. But obviously, there is a downside of this as well. The effect may not necessarily materialize due to perhaps sometimes growing risks for bankers, given that some automated lending procedures, for example, may push borrowers into moral hazard. But in general, also the literature shows that while we do not only expect the increase in the liquidity provision, we also expect the reduction in cost of credit due to digital solutions like helping to optimize operational and regulatory costs, reducing then effectively the cost of intermediation and improving banks' efficiency. But once again, if we provide a counter-argument, so Philippon, for example, using US data shows that this may not necessarily materialize, so they don't find any support for that banking efficiency driven by then great investment in ICT technologies would then lead to reduction in cost of credit. Now, so what data we use in this research? So we combine different data sources, starting from Amadeus data, which is provided by Bureau van Dijk, but now I think it's acquired by Moody's. So we use this data set to compile actually the sample of our SMEs, small and medium-sized firms, and this covers roughly about 179,000 firms in our sample, so which we also track actually their affiliation with banks. So in terms of bank affiliation, so we capture 54 European banks. And interestingly enough, in our data set, actually firms sometimes report the affiliation with more than one bank in this case. So 72% of
our sample actually is comprised of SMEs which have only affiliation with one bank, but there are also SMEs that have, as I said, more than one bank affiliation, and we test the robustness of our results actually to the number of such affiliations. So we clean the data set and end up with having better coverage with represented by 15 countries, including actually Central and Eastern European countries like Croatia, Estonia, Hungary, Latvia, Poland, and Slovenia. In terms of bank financial innovation, we draw more on Crunchbase database, also CB Insights, and we collect also some data through web scraping techniques, specifically using banks' financial statements and various public announcements when they perhaps introduce or adopted specific bank technologies. And in terms of technologies, we focus on automated software solution, blockchain technologies, data analytics, lending solutions, payments, personal finance, and regulatory technology. But we also then comprise the overall index of all these solutions, which is also average across all banks with which then SMEs are affiliated. So it has variation across SMEs as well, and over time. So in terms of the solutions, if you can see, like based on the data from our data set, we already observe quite substantial adoption of various technologies by banks, with the leader being here like electronic payments introduced by banks, so 83% of them already adopted electronic payments, but then second in a row would be blockchain technology, and followed by automation, followed by analytics and automation type of technologies. Methodology, in order to investigate this question empirically, so we adopt like different types of methods to address various statistical problems, and including like unobserved heterogeneity of firms, where here we use like fixed effects two-way fixed effect model, but also we account for potential indigeneity, where there could be like bidirectional causality between, say, adoption of bank technologies by banks and also SME borrowing. So as much as this can affect SME borrowing, so that SMEs may actually also increase specific demand for banks' digitalization. So for this, we adopt like a difference in difference approach. And before I move on discussing this approach specifically, so I just wanted also to highlight that we use quite a number of robustness checks for our results, including like instrumental variable approach, and using alternative also measures for bank innovation from global database, where it's like we specifically use data on a number of file patterns and granted patterns and on a number of deals. So a bank may have or involved as a venture capitalist. Here, the problem is that the sample is reduced substantially. That's why we do not use the set of the results as our primary set of the results, more as a robustness check. Now, our key dependent variables that we consider here is, as I said, like we focus on the growth of debt in total, but also we distinguish in terms of the maturity of debt, focusing on short-term debt growth and also long-term debt growth. And we consider them the cost of credit. And we have a set of quite a number of firm-level controls, but also bank-level controls and country-level controls, which I can actually, if there is any interest, I can expand more on this during Q&A session. For our difference in difference approach to address this indigeneity problem, so what we do, we have to clearly distinguish between the controlled group and the treatment group. So, and for this, actually, we distinguish treatment group by using two types of criteria. First is SMEs affiliation with highly digitalized banks, where, say, we expect then banks adopting at least 5 solutions out of 7 that we have on the list. And then we also use as a second approach, basically, of banks which achieved actually maximum digitalization, adopting all 7 solutions. For treatment year, we need like some sort of change in the policy of the European Union, which would then accelerate the whole speed of transition to digital banking. And for this, actually, we use the year of 2016. It's basically to highlight exactly the point when the European Union introduced or adopted like the second payment services directive at the end of 2015. So if you see on this graph showing the distributions and of the number of bank technology solutions over time, these are just box plots, so we can observe exactly the change in the number of adopted technologies by banks in 2016 and onwards, right? So I have quite a number of tables to report, which I shifted actually to extra slides because I think it would be less of interest to the audience, but I'm happy to go through some of these results if you are interested. But here, I just would summarize on the main findings and from our research is that first, what we find is indeed we observe quite substantial increase in credit access for SMEs driven by then this introduction or adoption of bank technologies. And this specifically has strong effect on long-term credit growth. We also find increase actually in the, unfortunately, like we didn't expect this, but we find increase also in the cost of credit for SMEs to be attributed actually to the greater adoption of technological solutions. Another interesting findings that we find actually in our research is that there is a differential impact of all these various bank technologies and more pronounced impact we observe from blockchain technology, automation technology, and data analytics. But more specifically improving credit access. And finally, when we extend actually the focus also to SMEs performance as proxied by the growth in sales of small and medium-sized businesses, so we exactly observe the positive effect happening via greater access to credit on the SMEs growth, but we observe actually that this effect is partially actually offset by an increase in the costs of credit for them. In terms of policy recommendations, and we believe that all the initiatives concerning the digitalization of financial services were quite important to increase the provision of the liquidity to SMEs and make them more financially inclusive in this case. But obviously, still, the measures are not sufficient as they do not address the impact of the rising cost of financial services for SMEs. And we also recommend that the policies should be tailored to adoption of specific technologies which are more beneficial than for SMEs access to credit. Thank you.
Thank you. Okay. So thank you to both presenters for very enlightening results and very fresh results. So this is still work in progress. If you have any comments, how to improve further, or if you see any gaps that yeah, we have a question here at the back.
Hi, thanks for the presentation. While listening, I had one question in mind. How do you see the problem of a large shadow economy in both the financing of SMEs and the cash savings? So 2 short examples. So now approaching the euro area, Bulgaria has 25% more millionaires because there's a lot of cash that comes into the banks now. And part of this is due to large-scale tax evasion, and that part of the salaries are paid in cash and you wouldn't take this to the bank. And then for SMEs, when they are looking for financing, especially in SEEs, they often come to banks and they have an official profit statement and an unofficial profit statement. But especially larger European banks, we cannot give a loan for unofficial profit statements. So this might be a reason for cash savings and also for SMEs to have worse access to financing.
Thank you, Amadea. I just add that you're from Raiffeisen, so that people know which bank. And Marco Skreb also has a question.
Hello, my name is Marko Skreb. I am a central banking consultant from Croatia. I have a question about the first presentation, which I find interesting. We all know the importance of trust in banking, in central banking as well. One thing which struck me a little bit is when you mentioned that the distance to bank decreases the trust in bank, if I got it right from you. Now, as we know, the number of bank branches will certainly continue to decrease. It has decreased 40%, you mentioned 30% in the region. Knowing what is happening in commercial banking, this can only speed up. Now, my first question, and that's a negative thing, is does it mean that the trust in banks will continue falling because of this? But I have a counter question for you. Do you have any idea about the age cohorts of those trust things? Because my suspicion, that's a speculation, is that people who lack trust is probably older. I'm older guy, so I can testify it's not a judgment. And another thing is level of education. For young people, I assume that good internet and nice app is much more important than the proximity of the bank. Thank you.
Thank you. So we take another question. So, sorry, Kasia was a little bit faster than Nicola. So.
Good afternoon. Thanks for the interesting presentation. I'm Katarzyna Rzęterska from Erste Bank, and actually I have a related, maybe a comment or question, like to what extent can you see into the data and distinguish between someone receives, I don't know, salary payment to the bank account and goes actively to the bank and to withdraw it to have a cash saving, or receives, I don't know, a pension in cash and just doesn't go to the bank because it's too far. So it's simple kind of a cost-benefit analysis. So I would wonder whether you have any insights or vision into that that probably would maybe explain the trust issue as well. Thank you.
Thank you. Nicola, if you can phrase it very briefly, then please, the micro is coming. And I'm sorry, I have to stop now.
Yeah, it's on the first presentation. I guess there are good branch closures and bad branch closures in a way. So we know that there are parts of Europe which are massively overbanked. You go on an Italian street, or actually went on an Italian street 10 or 20 years ago. Clearly there were too many bank branches. So in most cities. So how do you factor that into your analysis? The possibilities that even in Central and Eastern Europe, there may be cases of overbanking that actually are where the reduction of bank branches is good news for economic efficiency.
So thank you. A whole lot of questions. Who wants to go first? We do it in the same order.
Okay. Yeah, so thank you. Very good comments, which I think also we will look into more detail in the analysis. On the shadow economy, yes, of course, that plays a role. I think for the household survey data, firstly, we control for how, I didn't go into details on the socioeconomics, we control for age and education and also the type of employment. However, we could in addition look into a question which says, do people think that it's common to pay in cash in order to avoid taxes? So it's on a similar, the idea of the question is similar to the corruption. So you talk about someone else rather than saying, oh, I tend to keep my salary in cash. So we could look into that, and that might be very interesting to look as a heterogeneity. And also we have information on how they receive their salary, so that might be something we will look into. On the distance and the trust in banks, yes, of course. I mean, it would be a disaster if this means trust is going to fall further. I think there's two factors that are important to think about. The first one is which bank closes. So is it actually my home bank that closes? And we can distinguish that. And the other factor is, do you live in a rural or urban area? And that links into what Nicola said. And we've had a brief look at this, and basically the answer is it depends. So it depends on countries, it depends on where you live, it depends on how many other branches are close to you. So yeah, there will be some areas where trust will deteriorate, but I think not universally. And yeah.
Thank you. Julia.
All right, yeah, I think I'll answer then the question on shadow economy. Actually, our data set that we have, unfortunately, does not allow to look into this. But what we do find is more sort of indirect effect is a negative effect of online payment solutions that banks adopt, negatively affecting the SME sales. That we think that this partly to do like with SMEs moving then some of the this solution actually is and force SMEs to move to access more sort of the benefits of formal economy and come from underground operations. So this reduces actually any sort of use of cash in any of their transactions, and that's negatively, like during this at least transition period, it negatively affects their performance. But also looking at other data that we use, like Life and Transition Survey, which specifically focuses on transition economies. There we have individuals, and what we find actually that there is still a substantial number of individuals who do not seem to have like a bank account, and I mean specifically those who are actually engaged in either self-employment or creation of business with employment. And what we see here is that it's more than negatively, we see less than proportion of individuals engaging actually in creating businesses with employment creation rather than just self-employment. Exactly seeing that not accessing the benefits of the formal financial sector sort of negatively affects the size of potential businesses that they create. So for sizable businesses, you need to access actually formal financial sector. Yeah, that's the point that I wanted to make.
Then I would like to thank the presenters again very much for their nice presentations and you all for the active participation. Let's give a big hand. And I hand over to Jennifer again, who will tell us a little bit more about the next panel.
Thank you. This is our last stop before lunch, so hang in there. Next. Well, it is very interesting, but it is exhausting if you're trying to focus all the time. Anyway, next we have a panel on financing, innovation, and startups. It will be chaired by Monika Rosen. Welcome. Could I ask you and your panelists to slowly start finding your way onto the stage? In the meantime, I will tell you all a little bit about the chair of this panel. Monika Rosen specializes in capital markets. According to the Austrian online portal Newsflix, she is the finance and stock market expert in Austria, and that's "the" in all caps. She was head of research at Bank Austria for over 20 years, and she has promised that she will give our conference topic a distinct market twist. Ms. Rosen, we are very much looking forward to it. Please tell us a little bit more about your panel and your panelists.
Well, ladies and gentlemen, hello and welcome to this discussion on venture capital finance. I am delighted to be here. Thank you very much for the very nice introduction here. I must say, to my personal shame, this is my first visit to the Austrian National Bank. And when I sit in the front row, what is the first question that is being asked from the audience? It's about tax evasion. Am I in the right building? I hope so. All right. Now, so apparently, trust is an issue, and I understand that, and we'll try to work towards establishing that. And financial literacy, I think, is a major contribution in that factor. And while I'm at it, I'm going to say financial literacy for women is a special focus of mine. By way of an introductory thought, I had entertained several ideas, but then I ditched them all in favor of a headline that crossed the tape today and that, in my opinion, epitomizes what we're about to discuss. Walmart, the world's biggest retailer and the United States' biggest employer, will change its listing from the New York Stock Exchange to the Nasdaq on November 9th. In my opinion, a major deal. It's a major coup for Nasdaq. The question is it a bad omen for the US labor market? Walmart is the biggest employer in the United States. Are we looking at an advent of robotics, at a loss of jobs? Is that what they're telling us? The old economy is trying to merge or evolve towards the new economy. That's certainly nothing new, but this is a major step in that direction. What does this have to do with our discussion here? What I'm going to ask my guests in a moment is Europe. What have we done wrong? We have neither a New York Stock Exchange, not to speak that we don't have a Nasdaq, and in terms of AI, I leave that to your personal imagination. And that, I think, is at the heart of the matter, what we're about to discuss. And I want you to meet the lady and the two gentlemen on my left. And I will start, as I usually do, with the lady. Please help me welcome Gunhild Berg. She is lead financial sector specialist at the World Bank Group's Finance Competitiveness and Innovation Global Practice. Quite the title.
Yeah,
welcome.
it's a handful. I'm sorry.
Yeah, there you go. There you go.
I didn't choose it.
I didn't think. Who would? Come on, what are you talking about? Right there in the middle, Maximilian Bierbaum, Head of Research at New Financial. Welcome. Hello. And last but certainly not least, Marek Blaha. He is CEO of, pardon me if I say this in English, Affordable Housing at CESEE Sporitelna. Welcome. Thank you. So, we don't have a NUSE, we don't have a Nasdaq. We're not good in AI, we're not good in capital markets. Why? What have we done wrong? Who wants to go first? And in the second part, I'm going to ask you what are we going to do about it. Yeah, there you go. There you go. Maximilian,
I like the controversial start.
Maximilian, I think you published a paper on this. I didn't read the whole shebang. I'm going to be quite frank, but I read enough of it to find it very interesting. So tell me, we have made very little progress in the last 10 years in terms of developing our own capital markets. Why?
Yes. I mean, how much time do you have?
Less than you think is my standard answer.
Everyone is hungry.
Don't be saying that.
So what we're doing at New Financial is, over the last 10 years since Capital Markets Union was launched, we've been tracking the size and the development of capital markets in Europe. And what we're seeing with our updated figures at the end of 2024, unfortunately, we are back to where we started. Capital markets in the EU relative to GDP since 2014 have only grown by 2%. So that's certainly not something we would like to see after a decade of CMU. Capital markets in the EU are about half as deep relative to the economy as in the UK, about a third as deep as the US. And then, we've got a very wide range of depth in member states. I would say so because I don't just want to be negative. If you look behind those headline figures, in many member states, you will find very good examples of capital markets that work. And in some sectors and in some member states, they're actually deeper than the US relative to the economy.
Like in which sector, for instance?
For example, funded pension assets in Denmark.
Okay, all right.
Are bigger relative to GDP than in the US. Asset management in Sweden, bigger relative to GDP than in the US. Venture capital in Estonia. There's more investment relative to the size of the economy in Estonia than in the US. So, we often compare ourselves to the US, but we have these very good examples of what works, with our neighbors in Europe. So maybe there's something we can learn from them.
I don't want to tread on any toes, but in the case of Estonia, also, I guess it has to do with their relatively small economy. Okay, so but we're talking about relative scale. Okay, so what about unification? What about harmonization? How will we get everybody on? Everybody is a difficult concept, but let's call it that for now. How will we get all member states on board? And I would like to talk just a little bit about Brexit, because we lost the only European capital market, what can I say, worth having, the biggest one. And so what can possibly be done about that?
Sure. So first of all, yes, we lost the biggest financial center in Europe. And I'm actually going to publish a paper in 2 weeks on the interconnectedness that we still have between UK and EU.
We lost it in the EU. Of course, it is not lost entirely, but it's lost in the EU, yeah.
I would say in the UK, what they are doing right now is they are looking at Sweden, what the Swedish capital market is doing, what the Swedish government is doing to boost those capital markets. They have a sort of they have set their eyes on further developing the capital market there. In terms of getting retail investment, getting pension money into the Swedish stock market. They have a very well-functioning growth market. So yes, we have lost the UK, but Sweden is another very good example that we can learn from. I will say, I think the North Star, the long-term ambition should be a unified capital market in Europe. What I will say is right now, in many countries, there's just nothing to integrate. There is nothing to harmonize. So our position is that, yes, that should be what we all strive for. But right now, I think it's a slight distraction, because what we need right now is member states, every European country, to do what they need to do to build their own capital markets, to build pools of long-term capital, to channel that into assets. And then once we have that activity, then we can start to think about, okay, how can we unify that and create one single capital market in Europe?
That's a very interesting thought. We need to get everybody onto the bandwagon, of course, first, before we can start integrating. Or is that Marek, explain to me, is that the wrong way to do it? I mean, after all, in Africa, they ditched the landline phones and went mobile right away. So maybe these countries without any capital market culture should just join the unified European market without developing their own market? Is that a way of looking at it?
Thanks for the provocative question. I will maybe start from a different angle. I just returned from US, and we have visited our friends in San Diego, and they have small kids, like 10 years old, and they showed us their public school. And the major difference...
Your personal friends.
Yeah, personal friends, family friends. And the major difference between US and Europe, where we have failed, is the mindset. That you come into a public school in US with 10 years old kids, and I was reading what they have on the wall, and it was written, "Learn the power of yet." I was like, what is this power of yet? It's like, I haven't succeeded yet. I haven't done it yet. I haven't learned it yet.
Yeah.
And I think what is the difference is that for the Americans, with all the superficial attitude and huge debts, there's still if you are talking about innovation and startups, they grow the kids with the self-confidence. And you know what was the homework they got? Was write down what are your strong sides, what are your talents, at least 10. I said, this is a fantastic idea. I asked my 14-year-old son, can you name 10 of your talents and your strong sides?
10.
10, not 1 or 2, 10. You know, it's US, everything is big. And my son, which I believe, has a strong personality, was sitting there for 3 minutes and he told me, Dad, I'm an average. I don't have any talent. And I felt so ashamed. I say, and this is where we are failing, that's why we don't have innovation and startups. The American, they just go for it, and we say, behave like an average, don't show your talents and be a good employee, Even my parents told me, we wish you will be a great, corporate employee. That's our dream. Yeah? What do Americans tell you? I wish you will be the Jeff Bezos, yeah? Like, make your innovation, start a company, you know, go to the market, come with an idea. And I think this is where we are failing. That's why the markets are not there, because the mindset is not there.
That is true.
Yeah. As a parent, what can you do about it? I mean, you have 14 years to make up for, but I think you can still probably achieve something.
Exactly.
Yeah. All right.
I have my action plan.
I can only subscribe.
I know where I failed already.
I can only subscribe to that. As you may know, I'm vice president of the Austro-American Society. I used to live in the United States. I hold an American degree. I love the country. I will try to, in the Austro-American Society, our motto is building bridges, and I think we need that more than ever. And I will also say that the United States, I think, needs PR, and I'm happy to work towards that. And by the way, next year, we will have America 250, 250 years of the United States. So this will be a major opportunity for all of us, including myself, I hope, to promote the country a little bit. All right. Okay, so we don't have the right mindset. We don't have the markets. Okay. In terms of Gunhild, you tell me, what can be done to address the situation? Where can we perhaps find an angle to work towards a solution? Because I think defining the problem is always a strong suit in Europe. So let's start working on the solution here.
First, let me sympathize with my fellow panelists. I grew up in Germany, so I know very much the German mindset. I am German. Risk aversion is the #1. Low tolerance towards failure, #2. I think we're at the bottom in the pyramid of when you rank the countries in terms of their risk tolerance. Germany succeeds as any mark, any mistake will be negative and you will never make it in life. I moved to the US, I spent 13 years in the US, I raised 2 kids in the US, and now I'm back in Europe. And I fully agree with that. The risk aversion and the lack of tolerance for failure is just amazing here. And without that, you can never have a risk-oriented, innovation-oriented structure. But it's not, I think there are a lot of problems when it comes to capital markets development in Europe. The lack of trust and the lack of risk friendliness is certainly one of them. But there are many other preconditions that are lacking for capital markets development in this region. And this morning we heard from Nicola, we heard from many others that the lack of integration on the legal regulatory side, market infrastructure, that's certainly an inhibiting factor. I tend to disagree with, I mean, yes, every country can develop its capital market, and it should develop an institutional investor base, etc. But most of these markets are just so small. They will never make it unless you integrate them. They don't have there is no scale. You don't have the supply of issuers. Even if every corporate that is of a certain size would be willing, and they're not willing, to issue, they would not be enough. So why would an institutional investor from abroad come and invest in a small market unless you integrate and you make the market bigger and you attract the institutional investors? The other problem that I always see in these discussions here, they're so Europe-centric. When you look at institutional investors globally, we have over 100 trillion assets under management. We need to think much broader about how can that funding at least partially be attracted to this region, because it could make a fundamental difference. If you think about all the infrastructure investment needs, all the corporate financing needs, 80% of funding that corporates have come from banks. Bank funding is by definition relatively short term compared to what capital markets can offer. So we need to shift that mindset, going from the banking sector to more of a capital market angle. They can coexist, but that strong preference towards banks, both from the savings side, from the corporates, everyone wants banks, right? Everyone holds all of, again, the German mindset. All of the savings are in the bank accounts. As a company, I go to the bank to get financing, and that's how I will survive and make it through life. But the risk-reward trade-off is just not positive. As a saver, you will not have the same returns on investment that a US investor will probably have, because they're much more risk-tolerant while still being relatively stable. And as a company, if you don't have long-term financing that you raise, you will always have sort of this bottom, something on top, and you will never be able to break through, because you need long-term financing, patient capital to actually grow to a certain size. So I think there is you have the enabling environment constraints, you have supply side issues, and you have demand side issues. You have all three of them, and we need to address them in one coherent manner to actually move forward and to be able to compete internationally. Because the other fact of the matter is, you need to compete now. The EU is not going to be able to deploy much capital. Europe is not interested anymore to do so. So the European market in and of itself needs to be attractive enough for international money to come in and to actually finance everything that requires financing here.
Maybe because I represent the largest bank in Czech Republic, so I'm here with the responsibility
to argue against that.
To give you a different perspective on that. First of all, I think you feel the difference that US is, I dream of being an investor and an entrepreneur, yeah? In Europe, I dream of being an employee and I want to have savings, no debts, yeah? So we have to change this mindset. And then the second is, with the banks, we hold roughly, so on the bank accounts, we have 150 billion euro savings, yeah? So that's massive, massive. And it was really resonating with me, the closing of the branches, because from 2016 to 2021, I was leading the retail business of the bank, and we were closing 30% of the branches. So I'm sorry, I didn't have this research 10 years ago. But the difference is that you have to split two functions that people need bank for, yeah? The one is service operations, and that's what people used to come in the past to branch for, which is deposits and withdrawals and asking for a new credit card or this kind of stuff. And this should be all digitalized, because there is no innovation in that. I mean, this is just a service process, and that all got digitalized, including that when we were closing the branches, we say, okay, it's the SMEs or especially small business that needs to deposit cash every evening because they have the small shops, yeah? But we say, okay, we don't have to have a branch there because you can install a deposit ATM. So everywhere we close a branch, we install the deposit ATM. Yeah? If you wanted to now make a transfer, you don't go to bank anymore, you have your digital applications. But what you can do is that you don't fire the bankers. You can close the branch, but we say retain and retrain. Why? Because now the banks have unique data. Basically, we have data that not even the big tech American firms have. We know where you work. We know if you got a salary increase immediately after you receive your salary. We know what are your spending. We even know the structure of the spending. So we know how you're financially doing. And we have fantastic risk models, you know, strategic risk, operational risk. We are fantastic risk managers. We analyze all the data for the regulatory purposes. And the question is, can we use the same amount of money, expertise, and technology to help the clients create value of their data to do financially better? And then you come to advisory. So you can retrain the bankers not to be service bankers, but to be wealth management experts, yeah, to advise people on their budget, on their investments, and how they invest the money. And I think this is the future of both branches, the bankers and the retail banking, how we can turn the savings into productive investments.
You should come to Austria. A shout out to my Austrian colleagues in the room. I can only say in Austria, well, I don't want to say we fired the bankers, but shall we say we helped them into a retirement future. Yeah? And I'm one of them, and I'm doing fine. I'm very happy, but I'm just saying. All right. And I used to work in wealth management. Yes, Maximilian, you tell me.
I just wanted to come back to this point on comparing ourselves with the US. Because as I said, I understand why we're doing it. I don't always find it useful. Yes.
Why we're doing what? I'm sorry, I lost that.
Comparing ourselves to the US. You know,
yeah, well, okay, in terms of capital markets, with 70% of market capitalization worldwide, we should compare ourselves to the top dog.
Absolutely, but I'm talking about, for example, the attitude of Americans to investing. One of the reasons why they have that culture of investment, of risk-taking, is because they have a lack of a welfare state. So if you don't take care of yourself, no one will take care of you. Now, we can probably have another panel discussion about welfare reforms, social reforms in Europe. But the problem is if I now go to Germany or Austria or wherever and say, be more like the US, they will see that as an attack on the welfare state, and that won't fly. So you don't get that.
I agree with you there. I agree with you there.
And that is why we always try to find those comparators in Europe, Because if I go to Germany and say, you could be like Sweden or Denmark or the Netherlands, that is, much less politically contentious for these very important reforms, but very difficult reforms we need to make.
And especially in the current climate, if you say you have to be more like the US, it's not gonna go down a storm. I quite agree with you. So since we're talking about retired bankers, and I find that subject endlessly fascinating, let's talk about the pension system. The pension system in Europe is not capital markets driven. And that is one of the figures that I prepared here in advance for this discussion. Let me get my notes out here. So I hope this is still correct. In CEE, if I'm wrong, please correct me. There are 60 million people and 50 billion euros in a capital market funded pension system. Denmark has 5.5 million souls and 600 billion euros in such a capital market pension system. So that is considered always an example that we should strive towards. How can we boost acceptance of investing in capital markets for old age? I think that is also a hot button issue. If you say that in an election campaign, you're not gonna gather a lot of votes. At least I don't think you would. What can we do about that? Or should we do anything about that?
So out of the 50 billion, 20 billion are in Czech Republic.
I didn't doubt that for a moment. I didn't doubt that for a moment.
But 2/3 out of that amount is in an older version of pension funds that is now regulated in a way that the pension funds, if they lose money of the clients on the market, they have to compensate the loss with their own money, with the shareholders' money. So what do you think all this money went to? Government bonds.
Yes, of course.
So basically, we systematically lost the purchase power of nearly 2/3 of the money in the pension system. Luckily, there is the 1/3, roughly 8 billion euro, that can be already invested on the market, which is rapidly growing. What we have done is that with the growing interest rates in Czech Republic, we found out that mortgage was the #1 way how you purchase your home. Logically, 80% of Czechs own their own housing, so there's this tradition. And suddenly, with these high interest rates, mortgage became a product for private banking clients. Because with 4 or 5% interest rate and 20% of your own money to buy an apartment worth, let's say, 6,000 euro per square meter in Prague, it's only for 10 or 15% of the population. So suddenly there is a new demand that we need rental or affordable housing. So Erste has a long history in that. So we created a package of 200 million euro. And when the developers had a crisis 3 years ago, we started to purchase discounted projects. And we now rent these projects 20% below the market to healthcare personnel and teachers, so people who help other people. But then we run out of money pretty fast. 200 million euro is not much in real estate, if you need to buy buildings. And now I come to the pension funds. I was in a working group with the Ministry of Finance, and we did a research. Who are the investors that can invest with 20-year horizon, conservatively, into rental or affordable housing? And the study of OECD showed it's the pension funds. So we did a study, what are the pension funds investment class for this type of residential real estate in Sweden, in Denmark, in UK, in Finland. And we found out this is a perfect asset class for pension funds. We discussed this with the Vice Governor for Oversight of Financial Markets in Czech Nationalbank, with the Pension Fund Association, with the Ministry of Finance, and now, by the 1st of January, there will be a new regulation enabling the pension funds to invest to this asset class. I name it as a use case because we are currently in a situation where there is too much money in the private sector on the savings side, and we are running crazy debts on the government side. So if we need to build 50,000 apartments in Czech Republic that are missing, there are not much of the government money we can use. So we have to be really smart and involve capital market with the right risk appetite, with the right regulation, to be the investors in this asset class. And that's what we have enabled. And from January, now the pension funds will be able to scale the impact. The last thing, because there are many regulators in this room, what you can do is to set the right risk weight. Because when we started 3 years ago, the risk weight is 370%, which is the way how the regulator is saying, don't invest into housing. That's a bad idea. So we did a paper, and we found out a way how this can be reported with 100% risk weight, and the Czech regulator accepted it, because it's once you finish the residential building and you know the tenants, it's definitely something that is so unknown. So there is also, so what we have learned from this use case, a large collaboration is needed to move the changes. You need to organize a working group between the regulator, the Pension Fund Association, the bank, and the Ministry of Finance, and have a joint goal how to move it ahead. That's, I think, what we have learned.
But what you're saying, if I understand this correctly, it's still via the capital markets, but still investing in real estate, not really investing in stocks, yeah? So it is a blueprint, and it is stepping into the water to see if there are any sharks, but we're not really at the knee level just yet, are we?
I wanted to use this use case as a showcase of what needs to be done, because for the bond market and for the shares, the pension funds are already there. The question is, how can they be the engine of the local economy for startups, innovation, and private equity? And we just showed the way. Yeah? We need now to work with the Private Equity Association and with the Startup Association and with the regulator and with the ministry. What is the right risk weight for this asset class in the pensions? Obviously, it cannot be 10 or 20%.
But what about venture capital funding in your country? Are you going to tell me that that is working hunky-dory? I sort of doubt it. All the venture capital funds, once they get beyond the initial stage, perhaps not all of them, but venture capital companies, I should have said, move to the United States, because there they find better financing conditions. You're going to tell me that the Czech Republic is different, probably?
It's not. But the typical venture capital investors are those who sold their own startup. And now we have a couple of exits where it's 300, 500 million euros. And what did these people do with the money? Yeah, first they went to vacation for half a year. Yeah, travel the world, then they saw they are bored, they come back, and they started their own venture capital funds. Okay. So I think what we needed is just the time. It's just the time until the first generation of startups grow into such a large that they have sold and exited the startups. Now they are holding amazing amount of cash for our region. And what they are doing, now they want to mentor other ones and invest into the startups. So I don't think now the problem is the money. Now the problem is the mindset of the young people that we should grow them into start your own startup. Now I don't think the money is the #1 problem.
Gunhild, do you agree that all we need to do is wait? The problem will take care of itself?
No, it definitely won't take care of itself. I think other markets will overtake the European market. That is what is going to happen. It's not just the US, and I do agree with you, we shouldn't just compare ourselves to the US, but you see what is happening in Asia. Markets are significantly more dynamic. I think there is a lot of potential in the European market. There always has been, but there's also, because of the long history, there's also a certain degree of inhibition and fragmentation that needs to be overcome that other markets may not have as a challenge. So you need to recognize that, you need to address it, but there is huge potential in this market. But on coming back to the pension side of things, again, I come from the German system. There's a lot of debate.
Yeah, quite all right.
Yeah,
all right.
There's a lot of debate about reforming pension system. There has been a lot of debate for forever that I can remember, but it's obviously urgent. It needs to happen because eventually the system will no longer be able to fund the future pension of those that are now in the working age. And there's a lot of debate, and it's a tough debate because it again goes back to how much risk are you willing to take? How much are you expecting from the social system? And that whole debate is going to take a long time, and obviously it is very challenging and it's very cultural as well. There are cultural factors that are affecting this, and they also differ from country to country. I would not compare the German debate to a debate, for instance, in the north of Europe or the newer countries or Central Eastern Europe. The debate is very different, and also the history and the experience with the pension system is a very different one. But in addition to the pension funds not being of sufficient size, I think the other aspect, and that's related to what you were saying, is how do pension funds invest? And that again goes back to the conservative nature that I mentioned at the beginning, how individuals invest. Pension funds also invest very conservatively. They hold the majority of their funds in AAA securities. But we are working as the World Bank with some of the countries in this region to revise a little bit the regulatory framework. And for instance, in Romania, there is a trend now to see if a certain percentage, again, focusing on risk as well, risk mitigation, but a certain percentage could go to private equity venture capital funds, for instance. There is a trade-off there, and every country will look at that slightly differently, but without allowing for it, it will never happen. And if we don't allow for at least some flexibility in this risk-reward trade-off discussion, I don't think it will change, because there is this tendency to stay on the rather conservative side of the risk spectrum. And you will need to grow the pension funds, but also you need to think about how they can invest and what they can invest in, and where, not only in your own country, but in the region. Otherwise, you will never reach the scale.
Let me ask you a question, and then I'm going to throw it wide open, and I hope there will be plenty of questions from the audience. But let me ask you this, since you are German, as you've reminded me repeatedly, and we love some of our closest friends are German.
You too.
So,
there's another one.
Wonderful. Just give me a brief thought on German reunification, on the old and the new provinces. There is a difference, a special difference. Some of my closest friends are from Sachsen-Anhalt, so I am not talking about a theoretical example, about the difference in the pension schemes and in the pension benefits, and what is Germany doing to overcome that? Because I would think that Europe as a whole, in a way, if I may say that, must have the same problem. The standard of living in Eastern Europe, Central Eastern Europe, is not up to the same standard as the West. And this, for us as citizens of the West, if I may call us that, may I just share a personal experience. I first came to a new German province in the year 2000, and I was naive enough to think that they were all happy to be liberated. And I was very surprised that that was not the case. They were not really all that happy about the new paradise that they found themselves in. Yeah. So talk to me about that for just a second. Are there any thoughts you can share? Anything that you try to get your head around to address that or to mitigate that, other than a generation will grow up that will have been born in a unified Germany, but that is happening now, of course, but until they reach retirement, I'm afraid I will no longer be on this stage.
Well, no, neither of us will be. I mean, this is obviously a very difficult question, but I agree with you. It has some relevance to the discussion about the different European countries and how we can all come closer together. And the fact is, it has taken a very long time for us to get to from the level where we were, which is obviously a divided Germany, to the stage now, and it is still not that we can say that there is equal treatment between all the different provinces of Germany, that they're all at the same level. That is certainly still not the case. There is still a cultural difference. There is a difference in perceptions. There is a difference in benefits. There is also a difference in taxation. For instance, the West has been taxed to a certain extent to help on the eastern side of the reconstruction, unification, infrastructure. That still hasn't led to the same level of economic development in those parts of Germany. So there is the challenge has not been fully overcome, which tells you that it takes a long time. But partly that is also because, of course, again, history. The European region has so much history, and there are so many different cultural factors that need to be taken into account when you think about these elements. But specific to pension, I don't know if you have something to add to this.
Yeah.
I can't comment specifically on German reunification, but I think the underlying point of your question is so important in this debate. We talk about pension reforms in the context of capital markets and financing the European economy, but the starting point must always be the financial security of millions of Europeans in retirement. Mm-hmm. That is what we should focus on when we do these pension reforms. Now, we see in Denmark and the Netherlands that the replacement rates, so what people get in retirement compared to what they earned during their career, is higher than in many other OECD countries. Mm-hmm. And the share of GDP that comes out of public budgets to support the retirement system is lower. So there is a happy consequence of looking at the financial security of millions of people in retirement, in that it makes it cheaper to afford these retirements, and we can use that long-term capital, as Marek just described, to tackle many of the investment challenges that we have in Europe. Because, of course, we want to support
security being one of them.
Security, climate change, all these kinds of things. And yes, some of that will also find its way into listed equities, but we have huge infrastructure financing needs. And I don't want a retail investor to invest in social housing, but a pension fund, institutional money, with the scale, with the expertise, and with that long time horizon, is the perfect person or stakeholder to do that.
All right. On that note, you wanted to add something? Oh, please, I'm sorry.
With the pension funds, I think that it's important to frame it into two parts. The first is the voluntary pension investments. This is what is now in Czech Republic, the 20 billion roughly euro. Today, it was issued a new release that in the total asset management is 90 billion euros. Yeah, so this is a significant amount already for a 10 million people country. So people are learning how to invest. And then it's a third one, which is now, for example, in Slovakia, that you have the second pillar. How did it start? The ministry said, we are taking out of your salary 18% to fund the pensions, yeah? So they split it, the 18% to 50-50, 50%, so 9% of your salary still went to pay the pensions of the today pensioners, but the other 9%, and you had to choose which asset manager you want for free, started to go to your private account. That was roughly 20 years ago. Yeah, I see you right over here. And it's a very positive case, but it creates another gap, how to finance the pensions. And again, an IPO of some of the government-owned infrastructures can be the answer. So if you are looking what should be done for the pension system to transform, we should, for some people, for example, everybody 35 years and younger, say 50% of your, I don't know what is the name in English, of the amount of money that is now being sent to finance the today pensioners should be sent to your mandatory, to your private account, and the government should find a way how to finance the growing gap. And we have to find what are the infrastructure that the government is using that we can, for example, do IPO on a capital market, so this money can be dedicated to pay the today pensioners. And we have to find the courage to make this tough decision.
Courage is a great catchword, as is IPO. We've got 20 minutes left. I'm going to throw it wide open. The hands are going up. Do we have a mic? Is the lady coming? Is there there is a lady right here. May I give precedence to the lady? The gentlemen are next.
Thank you so much. I'm Rachel Epstein. I'm from the University of Denver. This was a fascinating panel.
Thank you.
I'm going to ask, who are the private actors in the European setting who would favor capital markets integration? And part of the reason that I ask is because when it came to the introduction of the single supervisory mechanism for banks, ultimately in the financial crisis, some of the multinational banking groups decided they would be better off with one supervisor rather than dealing with multiple. So in this conversation about how you achieve capital markets union, I don't think I've heard very much yet about who in the private sector would go for this and how can they be activated and mobilized to help move the project forward?
Great question. Thank you very much. Who feels energized to answer it?
I can attempt.
Yeah, but why don't you? Why don't you? That's an un-American answer, by the way.
I will give it a go, would be the best.
Yeah, there you go, there you go.
I will give it a go. So one obvious example is Euronext, the stock exchange operator. They are trying to consolidate their markets across the Netherlands, Belgium, France, but are running into regulatory issues in that they still have to report to their host regulator in each of these markets. And they recently came out and said, if we could just defer to one, that would make it a lot easier for us. And I think you'd find a lot of, there will always be pushback from the industry. I went to an asset management conference in Brussels 2 weeks ago, where ESMA talked about how they want to consolidate, harmonize supervision of asset managers. They said, ooh, we are in favor of integration, but not in this case. And that is something I observe in the industry a lot, that they always say yes, but. And I think sometimes you have to, use the good examples of institutions that want more integration, and then others, you just have to encourage / force them to do it to get to where we want to be. Another area that I think we can focus on is in areas that aren't regulated yet. I think, crypto assets, anything digital could be a good, I'm not a crypto expert, but I think it's much easier to create new models, more integrated models in areas that don't have an existing framework than it is to go back into the existing framework and then try to, change that.
Now, all the crypto friends out there are going to be horrified to hear that they are to be a blueprint for regulation, but then again, there you have it. All right, okay, so I promised the gentleman over here that they would be next. Please.
My name is Jeff Manners. I'm a semi-retired insurance executive, and I've worked across the Central and East European regions full-time since 1982. I've also worked extensively in the DACH region and in London. I wanted to come back to the question of mindset. I want to know if there's any studies that actually demonstrate what Marek said. My own experience is I've never experienced people as entrepreneurial as the people in Central and Eastern Europe. Every company, I opened 17 companies in the region from 1990 onward. My business model included having every operation run by a local national. I ran circles around my foreign competitors because I had locals. They saw product opportunities that the others couldn't see. 2, I found my client base was largely made up of locals as well who created new companies. I can think in your own country of 2 companies in the insurance sector that are highly innovative and creative. That one of them, INSEE, I don't know if you're aware of it. It's a model that can be copied in the West, but it was a Czech who developed that and discovered that. So my point here is, don't sell your people short. You have great entrepreneurs, great minds, great people, and yes, perhaps what they do need is the funding.
Thank you very much.
Thank you. Congratulations. It's fantastic what you have achieved. But as you can see, you are the American. You came to do the business, and the people work for you. Okay.
Well, okay, so then
that's the good news.
What you're saying is then we need, and what we're trying to discuss, we need then to take the next step to bring this onto the capital markets.
But what I did was I brought the corporation that provided I brought the corporation that put the money behind them, and they didn't even have the brand because the brand at that time meant nothing in those markets. So it was their drive. I had worked with them already from the early 80s. I'd been an underwriter with joint ventures with the state insurance companies. I took the people I saw from the state institutes who I could see who could think outside the box, who were creative and had the drive. To add as well, my most dangerous competitors eventually were other local companies. It wasn't my foreign competitors. It was companies created by locals.
All right.
Maybe to name 2 of the... In this world, we have a lack of positive news, so I will give you 2 positive news we have. The first one is that now all the machinery business is in trouble, with Germany slowing down and with the energy prices. And when as a corporate banker, you have the chance to talk to the owners, and one of the I asked them, what is the future of all this machinery and people being employed here and this business? And most of them see it into turning it into defense production. But what happened is that something that we wouldn't believe 5 years ago that it's even possible to dream of, a Czech company named Colt did an IPO on Prague Stock Exchange to raise the money to buy American competitor. And it all worked out. So you can invest into Colts today. So I think we have first example, yes, it's possible. I mean, you come back to the courage, So the Czechs raised the Czech money on Prague Stock Exchange to buy a huge American competitor. And it worked out. So fantastic, and I think it's showing the way, yeah? That's why I'm optimistic about the future. And the second part is when we talk about the private equity funds, we have the 2 largest private equity funds, and the owners, when they were doing business only in the region of Czech Republic and Slovakia, their own money were sufficient. But now they say, we have European ambitions, we have to raise capital. And both of their funds now are in billions of euro. Yeah, so they raised, in the past 2 years, amazing amount of money locally for the European expansion. So I'm an optimist.
Great. I have to watch the time just a little bit. I want to get to some more questions. Lady in the front here.
Thank you. A great panel. I want to respond to your kind of, dynamic question at the beginning. What are the solutions? Because the problems we have had. So I think we have to think a little bit more about the transition type of solutions. Obviously, we don't have that much of, with exceptions, that much of a risk-taking attitude, perhaps, for many cultural reasons. Then what is the transitional policy until we develop the new generation, a la American and other, government to provide guarantees, risk-sharing schemes that help this type of behavior. The other thing that we can do is to have, if you don't have the capital markets, nothing to integrate, as you, Maximilian, very starkly said. So do what others do, and nothing to worry about, looking at the example of Israel, where there is great startups, and they be financed from Silicon Valley and from New York. There is no shame in this, in my view, to find transitional arrangements that kind of, until you develop your own thing. The third thing that I want to say, that the big opportunity here, and you touched Marek already on the big opportunity here for innovation, not startup, because that's not the scale, but for innovation is the militarization of Europe, which has to come. We are worried about, I'm super worried about being Hungarian, about Russia, the withdrawal of the US military umbrella. Take advantage of the fact that innovation in this setting comes from high-tech military armament. There are countries who have the fiscal space, Germany. So link up to that, develop the value chain, and link up to that for Central Europe, the Czech Republic particularly, but also Hungary, Poland, they can link up to that and look for that kind of opportunity. I think military is the name of the game these days.
I'm afraid we won't disagree with you on the last point. I would like to get your take on, there is no shame, of course there's no shame in having the financing in Silicon Valley, but is that what that's what's happening now. Is that the correct way to go for Europe with venture cap? We're supposed to develop our own venture capital culture here, aren't we? I mean, that's the title of the panel.
I think there is some truth to that, and I alluded to that earlier. There is a lot of capital out there. Assets under management are massive internationally, and absolutely Europe could try to bring more of that towards the region, while at the same time building up your own institutional investor base, building the capital that you need to invest in all the long-term assets that you have, infrastructure, private equity, venture capital, you name it. But it can be at the same time. So I think there is a certain truth to that. You also mentioned the government, what they can do, risk-sharing mechanisms, etc. So I agree with that too. There is a certain role that governments can play in that. Even institutions like my own, we do play that role in certain times. For instance, infrastructure financing. Oftentimes, those are very risky deals. Institutional investors that look for kind of AAA-rated securities may not be comfortable going into these spaces. And in some of these cases, it can make sense to think about a risk-sharing mechanism to take some of the risk away, and through that, crowd in private capital. I think what is important there is that if the public sector comes in, it should always be with the mindset of mobilizing private capital, because otherwise it's displacing the private capital that may be willing to take the risk in and of itself should not happen. So taking that step back and thinking, okay, what is really limiting private capital to come in and what can we do about that? And then if there is a risk-sharing need, maybe that makes sense, especially for a transitory period until that asset class develops in and of itself.
Next questions. I'm going to switch to this side of the aisle here. We have 10 minutes, if you can keep it brief. Thank you very much, sir.
Thanks a lot, Mrs. Rosen, for your excellent moderation.
Oh, hello. I didn't see you there with the light in my eyes. Great to see you, my friend.
Thanks a lot. My question about taxation, because the real reason why financing innovation and startup really works in Eastern Europe is because of the flat tax of 10%, which we have in most of the countries. 400 new millionaires in Bulgaria, 10% flat tax. Here's the answer. And the same in Macedonia and many other countries. And the tax reform really works. In America has now 21% since 2017, and Germany has still 30%. So please, Mrs. Berg, my question to you. Mr. Merz is now the Chancellor. When will we see tax cuts and real reforms coming and Germany being innovative and strong again?
There you go. I should have called on you sooner. There you go.
This is clearly very far outside of my comfort zone as a financial sector expert. But I mean, there is truth to tax. When you think about enabling environment and having integration of legal regulatory frameworks and having a level playing field, taxation is another element of that. If you don't have a taxation level playing field, you have regulatory arbitrage, you have arbitrage in moving to the tax-friendly environments, etc. So of course, you need to have a certain level playing field. But tax reform is not something I'm going to talk about on the German system. It's nearly as contentious as the pension reform I dared to at least venture into earlier. But I mean, there's a truth to that, but it's a very complex discussion.
Two things
to
add to that. That is why we look at what countries can do on their own to do all these reforms, because taxation is not an EU competency. Pension reform is not an EU competency.
Yeah.
Changing insolvency laws isn't something that Brussels can do. That is in the hands of member states, and they need to do their bit to build better capital markets all across Europe.
And maybe coming back to the point of taxation, I think this is the biggest challenge of the capital market from the retail point of view. Like what we personally, and we discussed it during the coffee break, what is making us angry is that there is a different taxation of bond in Spain and in Czech Republic. So if some company is issuing a bond in Spain, why should I go and find out what is the taxation of that bond? Yeah, let's make it flat 15% and you don't have to worry. The same is with owning shares. I own Erste shares in Vienna. I got taxed in Vienna. I can ask after 3 years the Austrian tax office, but when I saw the process, I better go for a beer with friends. So I think maybe we can move it to some simple harmonization. And there was a fantastic example of my colleague saying why we should believe we can harmonize such a complex thing, because the roaming went well. Yeah, the telco. We did something we couldn't believe that it is possible. Now we have the same roaming everywhere in Europe. So if we want to build our own confidence we can do it, we have to come to our past successes. And that is definitely a success.
Okay,
something no one believed it can be harmonized. Yeah?
Okay, all right. Go ahead, sir. A brief question, if you will.
Yes, thank you, Thomas Lachik. I'm a local. I work in the economics department in this house. It has been an excellent panel, really extremely entertaining, informative, enjoyable, really. Thanks a lot for that. I have a brief question for Maximilian in particular, or anyone else who wants to pick up. But I would really be interested in hearing from you what your view is. Where could the CESEE countries learn lessons from countries that you mentioned, like Sweden, Denmark, Netherlands, to kickstart their capital markets? So very concrete policy recommendations. Thank you.
Can I actually stay in this region and talk about what you can learn from each other? Because we have, for example, a tax incentivized savings and investment account in Hungary, the TBSZ, that is working very well, that is effective at converting savers into investors. Poland has a capital markets development strategy. Croatia, relative to GDP, has larger funded pension assets than Germany, France, Italy, and Spain. So there are these examples that other member states can learn from. And if you only take one thing away from my contributions to this panel, it's we don't need to reinvent the wheel. Everything that we need to do has already been done somewhere else in Europe and has been done very successfully. So, just go and look at what Sweden did, look at what Denmark did, Netherlands. Take what works best in your economy and then just do it. We know what we need to do, but we need to do it.
Let me just play devil's advocate, and we have 5 minutes left, and I'm going to say something politically incorrect. So you tell the French that they need to learn from whoever. I mean, is there any other country in the world? Do you think that they will be ready to do that?
I tried.
And I apologize to the French friends in the room. But I mean, I'm just saying, yeah? And by the way, the Austrians are probably not that much better, or the Germans. So how do we overcome that part of the internal resistance, shall we say?
Look, in my line of work, I have to be an optimist. Otherwise, I would be very miserable. And so I try to find the positive examples. And, you know, France, if you mention the word pensions, Paris burns. But actually, they've done something very interesting in 2019. They introduced a private retirement savings account called the PER. And our modeling shows that it is on track in the first 10 years of existence to be more successful than the IRA in the US in terms of assets under management. So there is something that can even be done in Paris, even in France. I mean, you said politically incorrect.
Yeah, I started it. I take full responsibility.
But it is a voluntary product. But it is so attractive that people have started using it.
Yeah, but my point was, you know, we can learn from each other. Theoretically, yes, but how willing are we to do that? That's what I was trying to say. And again, I apologize to the French, but still, yeah. Okay, we have 3 minutes left. Final question. All right, the gentleman here in the front. Final round. Here we go. Thank you very much.
Just because I'm French.
There you go, bravo.
There you go.
And thanks for your stimulating framing. I think what you said has a lot of truth, but even in France, there is some benchmarking going on, and people look at what other countries, especially other European countries, are doing. So I want to very much commend what Maximilian and his colleagues are doing at New Financial. Because I think it's public service in addition to private service, and it's very useful. But on that note, and echoing things that Gunhild said, and also a bit Piroshka, can you clarify your point about you need to develop the market before you integrate it? Because it doesn't make sense on the face of it. You know, you take Alaska, they became a US state in 1959. Did they have to develop their capital market before benefiting from Wall Street? I mean, what do you mean?
That's a very fair point. My concern is that there's still a lot of resistance to the integration of supervision, for example. Germany is a good example, even though, you know, the stance to it is changing a bit. And my worry is that if we barge through the door and say we now need to harmonize everything, we spend a lot of political capital on this discussion that might not lead us anywhere. We saw it, for example, with the Pan-European Personal Pension Product. That was an attempt at doing something Europe-wide, and we spent 7 years on negotiating it, on implementing it, and now it's just not working. And we could have done something much more effective in those 7 years. And so we say, absolutely have this North Star of having one integrated, harmonized capital market. But in the meantime, you know, if... Why make it a precondition? That doesn't make sense. It's not a precondition, but if you have, you know, a super ESMA today, then we still don't have the pools of long-term capital that we need.
That's not a reason not to do the super ESMA today.
Well, the problem is, I think, you know, there's only so much political capital and attention you can spend, and I want Germany to spend it on reforming their pensions and not thinking about how a single supervisor could look like.
You could do both at the same time.
I don't think Germany can.
No comment.
Don't think.
All right. Okay. So then, why don't we try for the final word go to a neutral force, and Marek kind of dig us out of this hole so that I won't be kicked out and I will never be allowed to come back. Final word.
I just wanted to thank you for inviting me. And please. I think a big applause to Monica because she made this panel a fantastic entertaining. So thank you very much.
That's not what I meant. Ladies and gentlemen, that was not what I was looking for. Thank you all the applause goes to my guests and of course to you. It's been an outstanding pleasure to meet you. May I say goodbye with a truly American saying that I firmly believe in: do something, even if it's wrong. Let's go.
Thank you very much for this great panel. I also agree it was highly entertaining. We are ready for Keynote Lecture 2 on breaking barriers to financial access, cross-platform digital payments, and credit markets. But I leave it up to our governor to tell you more about our distinguished keynote speaker and what to expect.
So I hope you had a good lunch break and everybody's fresh and prepared for a great keynote. Let me introduce our keynote speaker, Professor Manju Puri. She is, and many of you know her, a professor at Duke University at the Fukuoka School of Business and a leading expert in corporate finance, financial intermediation, and fintech, actually. Her research spans a broad variety on venture capital, on financial inclusion, on entrepreneurship, on the financing of young companies, startups, scale-ups, and she has published very widely and also in the top journals of the profession, including the Journal of Financial Economics, the American Economic Review, the Review of Financial Studies, the Journal of Financial Economics, and she was also the editor or she is the editor of the Review of Financial Studies, and had, of course, prominent roles and leadership roles in global finance associations. She has also advised governments and regulatory authorities around the world, from the US Congress and Federal Reserve to the Reserve Bank of India, and she will present also unpublished research on India's unified payment interface, UPI, that is, of course, of interest also to the Eurozone, given some intentions to link the two economic regions more closely. I'm very happy that you made the long way from the US to Vienna. Thanks a lot for being here, and join me in welcoming Professor Manju Puri for her keynote address today.
Thank you very much for having me. It's an absolute delight to be here. This has proved to be a very stimulating conference. So this work is based on joint work with Shashwat Alok, Pulak Ghosh, and Nirupama Kulkarni. So let me get straight to it. Right, what is the motivation behind this paper? 1.4 billion people around the world still don't have access to bank accounts. And even if you have a bank account, that does not mean you have access to formal credit markets. Now, this is not just an emerging economy issue. Even in the US, the FDIC, where I was on deputation for 2 years, actually runs a biannual survey of the unbanked and the underbanked. And even in a country like the US, depending on which time horizon you look at, the unbanked is about 5%, and the underbanked is something like 16%. So this is really a global issue. More broadly, very much in the theme of today's conference, one might ask the question, how do you get capital markets to work for everyone? For people who are already in it, for people who are not in it, right? How do you, so we're not talking of welfare or government subsidies or any of that. How do you get private capital markets to work in their own self-interest to service everyone, right? And that's sort of where we're going with this paper. So I've been working on fintech for a while now, almost the last 10 years. And I go for many conferences where this conference is quite unique because we have so many central bankers. But I go to many conferences where we have a blend of policymakers, academicians, and people from industry. And when I do in such fintech conferences, there are always two players present. One is from Google, the second is from India's UPI, right? Now, why? Fintech arguably holds promise for banking the unbanked. Why? So in an earlier paper that I did, we actually looked at, if you simply, like all of us do, you browse the web, you shop for a coffee table, place an order, you exit, you come back. How much information do you think you left behind? It turns out that simple act of browsing the web, placing an order, you leave as much information behind as your credit bureau score in terms of predicting default. And this is a shallow digital footprint. I'm not talking of mining your social media, Facebook, Twitter, etc., where you'd get a ton more information. This is just 10 simple variables, such as, how do you access the web? Is it an iPhone? Research suggests, through the ages, what distinguishes the rich and poor used to be, do you have a BMW? Do you have cable TV? In today's world, do you have an iPhone? Correlates to the top quartile of income earners, right? Then, who's your email provider? Do you have a paid email provider or an antiquated email provider like Hotmail and Yahoo? Your default rate is actually higher with an old free email provider. What time of the day do you shop? When do you think default rate is highest? Morning, noon, or night? People who shop between midnight and 6 a.m. have the highest default rate. Your email, do you have your name in your email? I do. If you do, your default rate is lower. Do you have a number in your email? Do you, when you put in your email the first time round, does it bounce? If it does, your default rate is higher. If you stole that email or you're so drunk you can't type straight, that's what happens, right? If you type everything in lowercase as opposed to the way civilized people are supposed to do and capitalize the first letter, your default rate is higher. So these 10 simple variables, a shallow digital footprint, actually gives you as much predictive power as a credit bureau score. Importantly, for people with thin files, people who do not even have a credit bureau score, it works equally well. And when you put the two together, you actually get a higher area under the curve in terms of predictability. So this gives us hope. I'm on an advisory panel at the BIS, and this is what we discuss. Can fintechs sort of solve a lot of these issues that we have about financial inclusion? But the evidence in developed countries doesn't suggest it does, right? And there is still a cold start problem. And that is, okay, even if the digital footprint happens, how do you generate the digital footprint in the first place? And this is why we turn our focus to a public provision of a digital infrastructure, or India's UPI. So what has happened here is, India, they decided at the top that they would simply build digital rails. And anyone can put an app on this rail. And now it doesn't matter what app you have or I have, we can still remit to each other. Now, this is very different from in the US. In the US, if I want to make a payment, I want to sublet, let's say, an apartment in New York, I had to pay $2,000 as a deposit. So the guy asks me, well, do you have Venmo? I said, no. I said, do you have PayPal? He says, no. So we look at each other. How do we make the payment? Now let's try Zelle. 4 hours later, I finally get Zelle to work on my bank account. And then I'm told there's a $500 limit. Finally, I mail a check, right? That is the state of the payments currently in the US. Now, it's very different in India, where it doesn't matter if you have PayPal or I have Venmo, if you're with the Deutsche Bank or I'm with Bank of America, we can make payments instantaneously. What does that mean? Can you click the flowchart, please? So what this means is, this is sort of how it works. And the way to think about it is, let's suppose you have, the person who mows your lawn, right? Or comes and cleans your house, or a part-time bricklayer who typically you might just pay for cash, and they work for many different people. Who's going to give them a loan, right? No collateral, no proof of income, part-time casual labor. These people are automatically excluded from getting formal financial credit, right? So you have to go to money lenders, you have to go to pawnbrokers. Not good for you. Right? The same thing for street vendors. Think of someone selling masala chai tea on a street, right? Pushing a cart, no collateral. Who's going to give them a loan, right? No one, if you're paying cash. Now what happens is, right? So let's say Kiran, masala chai vendor, is selling tea, and it's €1 per cup of tea. Okay, so now I say, okay, Kiran, masala chai vendor, has an account with Deutsche Bank. I put that in, and I say I would need to pay $1 to her. This goes to the digital rails, right? And the digital rail goes and verifies, okay, Kiran actually does have an account with Deutsche Bank, right? And I can put $1 in it. Then it goes to my account, Bank of America, says, yeah, Manju has $1. I can debit $1, goes and credits Deutsche Bank $1 into Kiran's account, and then pings me saying it's done. So before I can take even a sip from my cup of tea, this is done, it's verified, you have a digital trail. So what does this mean? Now, Kiran Masala Chai Wali doesn't have any collateral, broken down cart, but works very hard, 8 to 8, 7 days a week, makes fantastic tea, right? Sells lots and lots of cups of tea. So she actually generates 2,000 euros in revenue a month. Now as a bank, I can look at this and say, I can see 2,000 euros a month for the last 6 months. I can make a loan of $400. So we go from no one being willing to give her credit to actually being able to make formal credit within the formal system, enabling her to build a credit history. Click back to main, please. So this is what the digital sort of payment structure does. It gives you a real-time, zero-cost, verifiable digital financial history, right? And this kind of structure is called an open payment system, where it doesn't matter what app you have or I have, we can do account-to-account transfer. Now, when the customer owns the data, this then becomes open banking. India has both. They have an open payment system, and who owns the data? It is the customer who owns the data, which means you can make banks and fintechs compete. So my Kiran tea stall person can say, I want a loan of $400 at the push of a button, apply to 3 banks, 14 fintechs. They can come back saying yes, no, interest rate, etc., and she can take a loan. Okay. So when UPI was introduced, right, it made a sea change in the economy. Historically, India has been a high cash usage economy. That has changed. 40% of transactions are now made digitally, right? And importantly, in order to use UPI, you need to have a bank account, right? And so the transactions will then show up in your bank account. And essentially what this is doing is you're changing the cash transactions into a verifiable digital trail, which is now enabling access to credit, both at the intensive margin and the extensive margin. People who never had credit can get it. People who had credit but want more of it can get now more of it, right? And so this is what's happening. So the research question that we ask is, looking at India's UPI system, this open payments, open banking, interoperable cross-payment payments, right, does this actually affect credit markets? Now, in theory, it could go either way. As many of you are central bankers, you know what your banks are going to tell you. They're saying, hey, we ought to be the ones to do it. Fintechs, no, let's not rely on them. Because, and in part, it's because, banks are the incumbents, right? And the moment you introduce competition, their incentive to do stuff like invest in relationship-based lending and all goes down. And so that might reduce the amount of credit available. On the other hand, you're introducing more competition, and that can increase credit. So we're going to ask, does it expand credit access? If so, for whom? Both on the intensive and the extensive margin. So people who never have had credit or are risky or have thin files, do they get credit? What about people who already are getting credit? Are they getting more credit? The answer to all of that is going to be yes. And we're going to ask which financial intermediary is facilitating this. Is it the fintech or banks? We're going to find they operate very differently. They're going to serve very different segments, and we're going to look at the distributional impact. So this is just to give you a preview of results. So, I work with the Central Bank of India, and, anyway, we have access to a whole lot of phenomenal data for the whole of the country, not 5–10%, the whole of India. And so, as a result, we're able to actually say quite a bit, and these are our key results. That once UPI is introduced, there is substantial deepening, right? And so everyone is getting more credit, prime, subprime, people who never had access to credit. Banks and fintechs are responding differently. Banks mainly increase lending to prime borrowers. Fintechs, they're new and hungry. They're increasing credit to everyone across the board. So if we're looking at the thin files, people who never got credit before, they're really being catered to by the fintechs. Now, in order to have a digital trail, there are other things you need. In particular, you need good and cheap internet. So we look at complementarities. We look at the rollout of Geo. So Geo, which was run by Reliance, so they put lots and lots of 4G towers, and they lowered dramatically the cost of internet access. And we'll see how that, actually helps boost credit. We'll also look at previously unbanked people. Now, in India, the Prime Minister's office ran a scheme, the JDY scheme, saying, look, let's bank everyone. So why are people unbanked? Well, the FDIC runs a biannual survey, and when you ask people why are they unbanked, you typically get two answers. One, transaction fees are very high. I put 50 euros in, don't do anything for 2 years, it goes down to zero. Second, a lot of paperwork. Don't always have all the documentation. And so here what they said is, they said, banks, look, it is your responsibility to open these accounts. One, zero fees. Two, if the documentation is not complete, open it anyway. And then, but within 6 months, you need to make sure the documentation is regularized. As a result, 99% of India is now banked. Now, we actually know where these JDY accounts are, and we asked, do you see a differential or a bigger effect for these accounts? And the answer is yes. Now, one of the questions you might have is, you're making all this new credit, risky credit, don't the default rates go through the roof, right? What happens then? And so we examined that. Now, you have to be a little careful how you do this, because obviously, if you make riskier credit, default rates are going to be higher. The right question is, if you control for credit rating, for the same credit risk in the old system and the new system, are the default rates any different? And the answer is no, they are not. Okay, why India? Well, this has been a unique experiment conducted in India, right? And everyone, the World Bank and the BIS, Bill Gates has gone to check it out to see, does this work, and how does it make a difference? And UPI has just boomed. There's on average 10 billion transactions a month. So $20 billion US dollars a month is transacted on UPI. So this is more than 50% of the payments. In India, almost everyone has a smartphone. There's 1 billion smartphones, 738 million smartphone users, and data is consumed like crazy. It is cheaper than bottled water. The average consumer, right, consumes 24 gig of data. When I go and they look at my data plan, they laugh at me. They're saying, you're paying this much for data, right? Everyone there is using data like crazy, right? And so this is just showing you how UPI took off. And you can see it's like a hockey stick, phenomenal growth. So we collect data from a bunch of places. I'm not going to go through this in great detail, but importantly, we have data from TransUnion, which is the credit bureau, for the whole of India, not 5–10%, for the whole of India. So we know, what are the loans being made, the number, the amount, is it prime, is it subprime, who are the lenders, is it fintech, is it banks? And we're going to take advantage of that. And so this is, a picture is 1,000 words. These are the results in a nutshell, right? And this is saying, you already saw how UPI is growing. This is saying a 1% increase in UPI leads to a 0.7% increase in loan accounts. So you saw UPI growing like that, so now you know how credit is growing. It's just a massive, massive increase in credit. Now, we'll do a lot of stuff on identification. How do we figure this out? And so we build on earlier work by Dubai and Puranandan. And we asked, what is the UPI exposure in the area? So suppose I was looking around this bank. When UPI is introduced, some banks adopt early, some late. So that's what we're going to use. So let's suppose around here, all the banks adopt UPI. My exposure measure is 1. If none adopt, it's 0. If half of them adopt, it's 50%, right? And then we're going to do lots of robustness checks. I'm going to skip that so that we have a little more time for discussion. So we're now going to look at the impact on credit. So my left-hand side variable is going to be credit, both the number of loans as well as the number of loans per capita. Later on, I'll aggregate in terms of what does it mean for the total loan amounts. And we'll look at it separately for fintech and banks. And again, look at the picture. These are the coefficient estimates. You know, the vertical dotted line is when it's introduced, and you can see how credit is booming for fintech. Same thing for banks, right? A rising tide lifts all ships. Everyone is giving more credit, right? The pie has simply grown, right? And so initially, the incumbents were worried that, oh, the fintechs are going to eat the bank's lunch, but the pie has just grown. Everyone is lending more. Everyone is getting more. So UPI is a game changer for who, right? And each of these numbers represents a regression, right? And this is the coefficient. So we're going to look at new to credit, people who never had access to credit, subprime and prime, and fintech and banks. The first thing you'll see is all these numbers except one are positive. So what does that mean? Everyone is getting more credit, whether it's prime, subprime, new to credit, and both fintechs and banks are lending. The only place it's 0 is banks for new to credit. So banks are not lending more to people who never had access to credit before. That is falling on the fintechs, right? And so this is just showing you the full regression, right? And you can see the first row, which is the important one, everything is positive and 3 stars, which means highly significant. This is for fintech and banks. You see this for fintech. You see this for banks. The only place it's 0 is in the new to credit. Otherwise, it's big everywhere. We do lots and lots of robustness. I'm going to skip this in the interest of time. Let's look at complementarities. So far, what have we seen? As UPI goes up, lending goes up. Now let's see how complementary is this to having good and cheap internet. So Geo was rolled in, right? And you had this rapid coverage of 4G, right? And so this is how the Geo tower rollout looks like. So you can see massive number of towers being put. And this is what the coverage of internet then looks like. In 2016, spotty 2020, whole of India is covered. Average distance to a tower goes down from 15 kilometers to 2 kilometers. Normally, if you're in 4 or 5 kilometers of a tower, you have very good internet connection, right? And look at the data costs. Boom, down to 7 rupees a gig. That's less than 10 cents for a gig of data, which accounts for why people consume so much data. And so what we see is, that once you introduce, once Geo comes in, you can say, there's more credit across the board to everyone. So it's having not just internet, but cheap internet, right? So people are using 24 gig of data and doing all their transactions. That's what is really making the difference. Banks, it's the same, but again, you see the new to credit, there's no action for banks, though there is in the other categories, right? Now let's look at people who were previously unbanked. These are the JDY accounts, and we can see, again, the first row here, that once UPI is introduced, where you have these high JDY accounts, you're seeing more loans by fintech to these people who never had credit. Again, banks are not really doing that much. Now let's talk about what does this mean in terms of aggregate credit. So what this means is a 1.99 million rupee differential in loan value in high exposure PIN codes. In other words, there's a 22% difference in high exposure versus low exposure areas in credit. That's a big number. Importantly, there are differences in the size of the loans. Banks make big ticket loans. Fintechs make small ticket loans. The average size of a fintech loan is about $200. The average size of the bank loans is 9 or 10 times of that. Now, this makes sense, right? So what are you saying? Fintechs are making $200 loans to the person like my Kiran T-stall person, right? Banks don't do it. Why? It's much more expensive for banks to lend, right? They have the examiners on them. They're told not to take too much risk. They have brick and walls, you know, they have the loan officers. All this take time. Fintechs, they are hungry. They get the digital footprint, and they can give it out. Yeah, cash flow 2,000, loan of 200, boom. It's done with very low transaction costs, right? And so that's what you're seeing. So overall, there's an increase in the supply of credit by both fintechs and banks. Fintechs are doing more of the small ticket loans. Now you might ask, what is the impact on default? So we're going to look at that. And essentially, you want to control for credit rating. So I'm going to control for people who never got credit, subprime, prime. And I'm going to look at before and after, right? With low exposure, old technology, new technology. Is there a difference in the default rate? And it's 0 everywhere, except here for prime. And maybe there's a little over borrowing in prime. But when I put this in a multivariate framework, it vanishes. If anything, you see defaults are marginally, again, very marginally lower for the new to credit. So I would just conservatively say you're not really seeing an impact on default either by fintech or by banks. So let's conclude, right? 850 million people in India either don't have access to formal credit or don't get enough of it. They have thin files. Now, whenever I do this, people say, well, Europe is not India. Maybe, of course not. However, even in a developed country like the US, we reliably know from the FDIC survey that you have huge amounts of unbanked and underbanked population, 5% unbanked, 16% underbanked. And surely Europe is somewhere in between, right? And so what do we find? Using the universe of credit bureau data in India, we find that once you introduce these digital rails, there is an expansion in credit all across the board. However, banks and fintechs respond differently. Banks are doing more of the lending to prime. Fintechs are lending to everyone, right? They're hungry, they're the new guys, right? And so the risky people, the people who never have got access to credit, are really being served by fintech. Now remember, fintech starts at 0, so the growth rate is higher. But if you look at the absolute amount of credit being given by fintech and banks to people who never had credit before, now it's the same, right? Because the growth has all come from fintechs. Not only that, fintech is expanding credit in regions where people were previously unbanked. We find the effects are stronger in regions which have better and cheap internet connectivity. And importantly, we do not see higher default rates, which suggests these are underserved but credit-worthy borrowers. Now, what I've done after dinner yesterday, after talking to many central bankers, you know, one of the things I know is on your mind is what are the implications for the digital euro. So let's talk a little bit about that. What are the implications of, you know, what we have learned on digital footprints for the digital euro? So what do we know? We knew that digital footprints matter. What we're finding is it matters across the board, prime, subprime, new to credit. And from the point of view of, you know, social welfare, maybe the people who are, you know, either didn't have access to credit or thin files. We have a lot of thin file people, right? So you have very little access to credit and now getting better access. And as I said, this is an important first-order issue, even in a developed economy like the US. So what is making the difference? It is the information in the digital trail, right? My casual bricklayer, my gardener, right? The conversion of cash into digital trail now makes that verifiable, and it means banks and fintechs can lend to them. Now, I was at the ECB the week before. The current proposal for the digital euro, as I understand it, you will have both offline and online functionality. The offline is supposed to work like a cash substitute. And because privacy is such a big concern in Europe, the proposal is to scrub the identities, right? which means that both the people making the payments and the people receiving the payments' identity is scrubbed. Now, that is, of course, great for privacy, right? But what does it mean in the context of this research? You can't use it then to get access to credit, right? And that is, going to be important across the board because we know it matters to everyone, and probably more so to, the less affluent part of society, the people who have less credit. And so I think it's worth thinking about, are there ways of solving it? We want to ask what is our objective, and clearly privacy is a big objective. You don't want to mess with that. At the same time, if you're spending billions of dollars, you want to maximize the benefits. And so, again, it's something we should brainstorm and think about. I put up what I think is one potential solution, which I think is viable given the way that I've been heard that it's being dubbed. It's going to take a lot of time and effort to actually scrub the data, right? So people in ECB are saying we're not quite sure how to do it technologically, we're not sure what the cost is going to be, right? But the nature of a digital footprint, when you get it, is the information is there, right? Because someone is paying someone, right? The nature of using a digital trail is the payee needs to show that to the bank. You don't really need to know who the payer is. You just need to show, I'm a casual bricklayer. Yeah, I'm getting employed every day. Maybe it's a different job. I'm a hard worker, and I can show that through that, and it's verifiable. So what could you do? Scrub it by all means, but you can have something like an on-off switch, which means for the payee, for whom it is important, they can put a switch so they can identify, I'm the one getting the money. You don't have to identify the payer, I think, for this to work, right? But now I can give this to a fintech or a bank, and privacy now is at the discretion of the individual. But it's worth it for me because my need for credit is high enough. I don't really care about privacy. So, and what is the privacy? I'm giving it to a bank or a fintech. They don't own the data. They can't give it to someone else. Right? It is the people making the credit who can give it. So this is what, there may be other ways to think about it, but I think as we're debating it, and because so many people here are involved and interested in the digital euro, it is worth knowing all the pros and cons and trying to sort of then make the trade-off. Okay, so this is another paper that I've done, right? What is actually being incorporated in the digital euro? Very, very different approach. And we started this because we were fascinated by the growth of payment firms. So if you look at the last decade, payment firms, they've almost by stealth taken up over so much of the financial market. If you look at the market, and ask who are the big players in financial markets, it used to be banks, insurance companies. The market cap of banks and the market cap of payment firms are almost the same at this point. And they've come out of nowhere, right? It's almost by stealth. We haven't studied them much. And so we were interested in studying them in the context of CBDCs. And so the idea here is we looked at digital euro, right? And the way we did it is the way the BIS does it. They collate all the central bank speeches, and they categorize positive sentiment, negative sentiment, neutral. And over time, the sentiment has become more and more positive, right? Because the digital euro is very likely to go out. So we use that database, which has the sentiment, and we look at what happens in response to positive speeches about the euro. And we look at US payment firms and European payment firms. And guess what happens? US payment firm prices take a beating. European payment firms go up. Why? 10 years ago, when I would go for conferences on CBDCs, the debate would be, should it be retail? Should it be wholesale? Now the debate is very different. We want strategic autonomy. In the current divided world, right, geopolitics dictate that we all be self-sufficient, especially in our payment system. And this is what this evidence is suggesting, right, that it's very consistent with we want strategic autonomy, and now this is perhaps a first-order motivation behind the digital euro. And again, it is important to take all motivations and objectives into account, right? But if you're doing it anyway, maximize the benefits. And so given my research from this paper and other fintech papers, I would say, let's try and maximize also the benefit from digital trail while taking into account all the other considerations and try and sort of balance them out. Thank you.
Thank you, Manju, for a very interesting and insightful keynote. And we have plenty of time for questions. And I have a question in the back. Please, you're the first.
Michael Steiner, University of Graz. This was very impressive, the effectiveness and the effects of fintech and digital streams. Two questions. The first, I mean, of course, it's transparent in the one form or the other. So who might be interested in these data? The DAX office, maybe, which you tried to hide, and now all of a sudden your payment streams become well known. Just imagine you have a payment stream to Epstein. That might decrease your credibility. By the way, you have explained to your wife why you paid Epstein. Secondly, I mean, your data are history up to the present. Startups don't have a long and strong history. They want to have credit for the future. How to evaluate the potential of future payment streams by given history. Startups, there you would have to know the value of the project and not past payment streams.
I think it goes back to, you know, how do banks traditionally make loans? It's this cash flow-based lending, right? So this, I used to be an ex-banker before I became an academician. Cash flow-based lending is the way to go. What is the digital trail? At the very heart of it, it's cash flow-based lending. Now, you can do a lot more, right? You can do the social credit scoring and alternate credit scores. And there I agree, you know, these are not time-tested. So when I did my digital paper, right, you know, time of day you shop, your email bouncing, this is not the criteria by which banks give loans. And I would always have bankers come up to me and say, you know, we can't really use these measures because the examiners are going to, you know, not think that highly of it. And there's a reason, right? We have time-tested methods for bank lending, right, through the centuries. I'm certainly not saying we give that up, right? Cash flow-based lending has been, you know, the hallmark of lending. The digital trail enables you to do a better job of it, not a worse job, right? Now, you might use it in all kinds of other ways that, you know, may or may not be appropriate, depending on what you think of alternate credit scoring. But at the very heart, I think cash flow-based lending is a good thing.
Yes, we have many questions. Andreas Ittner, please, and then the two other gentlemen.
Well, thank you so much, Andreas Ittner, former Vice Governor of the Central Bank. I have two questions. One is about the payback culture. Why is it that so many people who obviously never had to act with loans are able to consider that they have to pay back? First question. Second question, how do you provide for crooks with all the possibilities in the internet with bots who can come up with any kind of email address, make social accounts? How is this possible to ignore this in your...
Absolutely, right? And the second question first, right? If you tell people, you know, this is the way I'm evaluating credit by the email address or time of shutdown, people will manipulate it, right? You'll have bots. We have enough sophisticated people. Right? And so you need to be very vigilant. The digital footprint for alternate credit scoring. So I have students who say, we'll set up a company and I'll do this. I said, be very careful. What works today may not work tomorrow, because people learn. There's what we call the Lucas paradox. Once everyone knows it, it's not going to work because people are going to game it, right? And this is why alternate credit scoring has potential, but you need to be very, very careful. What I am saying the digital trail does well, though, is cash flow-based lending, where you actually have a digital trail that is verifiable, as in the UPI. There's no gaming there, no bot can do it, because it's the UPI sort of generating it. So that was the second. What was your first question?
On the credit culture by people who never had...
How are they getting it? It's because of the digital payments. So think of the casual bricklayer who every day makes maybe 50 euros a day. No bank is going to lend to him, right? Because he can't give you a statement or an employer verification. But once you have the digital, he's a hard worker, right? So some people, the day you pay your paycheck, they drink and don't come back for a week. Other people work, 7 days a week. So this bricklayer is one of them. And you can see that for the last 6 months, works every day, gets 50 euros, a day. You can make a loan of 400 euros. So this is cash flow-based lending.
The gentleman behind Andreas Ittner, I wanted just to add, I think there must be, as a behavioral economist, there must be a difference between paying back and saving beforehand to have collateral, actually.
Yes.
In economic theory, basic theory would tell you it's the same, but it is not the same for many people, perhaps.
It's not the same.
Sorry, yes, please. That was just,
Thank you.
I had to intervene here a bit.
Marko Škreb, former central bank governor in Croatia. Thank you for your extremely interesting lecture. My question may not be directly linked to your extremely interesting presentation, but I cannot resist but ask you the following. What we read is, first of all, thank you for the information of the rapid capitalization of payment firms. This is very interesting. My question to you is, how do you think that the rapid increase in stablecoins, especially in the US, I cannot resist but ask you, blockchain technology, how does it fit into this digital pattern? Because blockchain has different opportunities. Thank you.
I think that's a good question. It's a very broad question, probably for a bigger debate. I'll give you a very short answer, right? So again, it depends on what are we thinking stablecoins is going to do. If it's going to work as a payment system, right? If your payment system is already working brilliantly, as it is in India's UPI, the need for introducing stablecoins as an alternate payment system, or for that matter, even CBDCs, is not high. If that is the objective, right? There can be other objectives, strategic autonomy, whatever. But if the objective is means of payment, if you already have very good payments, as you have in some countries, then you don't need to introduce an alternative, right? But if you don't, right, then you could start talking of those alternatives, and then this also ties in with, broader objectives.
Günther Fehlinger here.
Professor, thanks a lot. This is very important, digital payment. When you now in the afternoon after this conference go to a Vienna restaurant, you will first have to ask if they accept, for example, credit cards. Yeah? That will be the first questions you have, yeah? Because it's still not very common in this touristic supernation, which we are, very successful. But in the mountains, it can often happen that you have no cash then ultimately, and you cannot pay your bills, and that's a common complaint. Do you recommend a policy of obligatory payment systems installed at the point of sales for all outlets in the tourism? And maybe a second small question is also a little bit to the governor, because here we have a debate in Austria as well that there is no cash in the regions, in the periphery, and then the Central Bank of Austria has started to put bankomats itself, not with the commercial banks, but themselves in the regions, in the periphery, in order to make...
started to do what? Sorry?
ATMs.
Oh, ATMs, yeah.
So that's the policy of the Austrian National Bank, which maybe, yes. Okay, good. Thank you very much for that.
Again, so I've been to many different countries by now and to many different central banks, and I talk about payments. And what I found is every country has different issues, right? Because there's a certain structure we're not starting from scratch where you can say, this is the ideal structure, you set it up. There's a certain political economy in place, there's a certain structure in place. There's a certain infrastructure, there are certain cultural norms. You can't ignore all that, right? So you can't say I have, one solution fits all. And so realistically, you have to ask within your constraints. And so this is the conversation I end up having, right? So I have a bunch of people around the table, and they'll say, look, we want to introduce, let's say, digital trailness. But these are the things we come across, right? Sometimes it's privacy, sometimes it's who owns the data, and there's different entrenchment in different countries, right? And then they'll ask me, within this, what is the number one thing that we can do that will help, right? And then we have a discussion, and we find there actually are things that we can do. It may not move it to the absolute first best, but it will help. And they're saying, oh, we could actually do this, this, this. And these things which are low-hanging fruit, we should do, right? We're not going to, overhaul the entire system everywhere, nor should we, right? And there's a reason they're there. But we ought to see, even within the constraints, what is it that we can do, right? And that's where I'm coming from.
We have time for one final question, please, here in the front. Or two fronts at the end. But here, first in the front, please.
Thanks so much, Piros Nagymoácsi from LSE. My question is, would relate to this problem that when you scrap privacy from the digital euro, then you lose one of the objectives of the digital euro introduction, this whole digital tray. I didn't quite get how exactly your proposal would handle it, number one. Number two, if you can give us a little insight of what the ECB colleagues thought about your proposal, since you presented it there.
No, I didn't present this proposal.
Oh, okay.
At the ECB, they were explaining to me how they were doing the digital euro, and I was saying, but you're losing some of these benefits. We're supposed to have a follow-up Zoom call, right? And so meanwhile, I've been thinking after that, because the one thing I heard very strongly at ECB and yesterday at dinner is the privacy concerns are very strong. So I think it is important to meet them, right? If these are your first-order concerns, you should meet them. At the same time, we're spending billions of dollars on the digital euro, right? You want to maximize your benefit. And so, it seems to me we should brainstorm on how do we maximize the benefits. We don't say privacy, we throw out everything else. I think we say we want privacy, but can we do it in a way that will retain some of the other benefits? And so the solution that I proposed is you have privacy, right? Initially, when your trail is created, you automatically will have the payer and the payee, because that is the nature of payment. So you're actually now putting in a lot of work to scrape off the payer and the payee. But it can be retained in the system, right? For the payee's point of view, you don't need to know who the payer is. You just need to show, I'm a part-time bricklayer, I'm actually getting paid in a verifiable way, 50 euros every day, right? If you give the payee saying it is your data, and if you give them a way saying I can show this is all being paid to me, you don't have to show who the payer is. So whose privacy are you violating? No one's. It's the bricklayer is deciding whether to give this information to the bank or fintech. Nobody else. Nobody else sees it, right? So I think you preserve privacy, but now you can maximize the benefit of the digital trend.
Definitely very, very...
Think about it, right? But I think there are a lot of very smart people in the room. I think if we put our heads together, we can figure out a way.
Final question by Franz Nauschnik in the back.
Thank you, Franz Nauschnik, formerly OeNB. My question is also related a bit to this question of stablecoins. The US is pushing the stablecoin market, and for India, probably not a problem, but international payments, remittances and other stuff, they will lead to dollarization if this market develops very strongly. And so would you recommend that also in Europe we consider a European-based stablecoin so as not to let the stablecoin markets to the US?
I don't have a good answer for that. I think as you're already now thinking of a digital euro, I think this question will perhaps nest quite naturally within that, because again, the digital euro can most likely be devised to allow things like that. I don't think you need multiple alternate payment systems. You need one really good payment system. And let's hope the digital Europe becomes that one really good payment system.
We'll work hard. Thanks a lot, Manjupuri. Thanks for being here, and I think we all join in giving you a great hand for your presentation and your keynote.
Yes, thank you. It appears we are almost ready for the grand finale of this conference, the governors' panel on the status quo of capital markets in CESEE. Could I kindly ask all governors and vice governors on this panel to slowly find their way up to the stage? I'll use the time to make a quick admin announcement. You've probably noticed our photographer back there going around and taking your pictures. The pictures will be made available on Flickr, and you can access the photo page via a QR code that is being made available on the screens outside this hall, and the QR code will also be sent out by email, so you can all admire yourselves. Okay, I believe the governors are ready, so please, Martin, tell us more about this panel and your panelists.
So thanks a lot. Welcome to the panel. There's a tradition to have a governors panel, and we have a large panel. Thanks to everybody for being here. It's a great privilege and honor to be the moderator for this panel, and I think there's lots of things to discuss. We have 1 hour and 50 minutes, so I hope you don't you're not angry with me if I sometimes signal you that it's time to end your statement, but let's see how it works. Let me just at the beginning introduce the governors to you. Most of you know them, but for completeness. To the left of me, it's Anka Dragu, the governor of the Bank of Moldova. With a very long experience in economics, finance, and public policy, she has served as the Minister of Finance in Romania. She has been President of the Senate in Romania, and now has been in the role of governor in the bank, in the Central Bank of Moldova for a couple of years. Ahmed Ismaili is the governor of the Central Bank of the Republic of Kosovo. He also has a distinguished career spanning banking, finance, and public service. He has been the representative of Kosovo, on the boards of the IMF and the World Bank, and is lecturing in banking and finance at universities in Kosovo. Thanks for being here. We have Marta Kajtli. She's the first deputy governor of the Polish National Bank, the Narodowy Bank Polski. She's professor at the Warsaw School of Economics, a former diplomat, led the political and economic department at the Polish embassy in South Korea, and serves in many important roles now. And she is also holding the. She's also in the jury of the competition for the best economic journalist I have here. So a very important task. Maris Müller, the governor from the Baltic states with the most German name you can imagine, actually. Now he's governor of the Bank of Estonia, the Eesti Pank. He's a member of the European Central Bank's Governing Council, the first governor here on the list that is also a governor of a euro area country. Of course, Kosovo also has the euro, but is not official member of the eurozone, or the euro area. He has extensive experience at the World Bank, the IFC, and as a financial advisor in Estonia, with a lot of expertise in finance and banking, and a lot of experience in the ECB's Governing Council. Then we have Daniel Palotai. He's a deputy governor of the Hungarian Central National Bank, Magyar Nemzeti Bank. I'm not sure this is pronounced correctly. Almost, sorry. I have to work on my Hungarian, actually, as a neighbor. He's a distinguished finance expert with extensive experience at the IMF, the ECB, and the Hungary's Ministry for National Economy, and a dedicated contributor to academic and professional economic circles. And last but not least, to the right of you, Drajko Slavesk, the governor of the National Bank of the Republic of North Macedonia. He's a former governor for the World Bank and the EBRD of North Macedonia, a key figure in shaping the country's economic policy, also a full professor of course, published author and active contributor to public debates. I'm sorry for the briefness, but I thought we saved some time for a discussion. And I want to just start with the first round of questions. And of course, since the topic of today's conference is capital markets, I would be very much interested in your assessment of the major advances over the last years when it comes to capital market improvements, capital market deepness, and capital market initiatives in your countries, and perhaps also which kind of roles the national banks can play in actually fostering the advancement of capital markets. And if I may start with Anka here, please.
Okay, thank you. Thank you, and congratulations for this panel and for the whole event. We have to be really efficient here, and otherwise would be a very bad signal for our colleagues back home that our governor couldn't stick to the time allocated. So, capital market in Moldova, it's at the very beginning. We know there have been some years since the country became independent, but we are now in a sort of initial stage. We have a project now quite advanced that's stock exchange from Bucharest will invest in Moldova and will set up a new stock exchange. We have two stock exchanges. One is very thin, one is almost closed. So why the third one will be successful? Because they come with know-how, with liquidity. We hope to have dual listings, and so that's a plan. Central Bank is the owner of the Central Securities Depository. So we do contribute in terms of infrastructure, and we supported all these projects to increase the capital market. Over the last couple of years ago, we took over supervision and regulation of insurance sector and also of non-bank financial institutions. And of course, we have banking and monetary policy. So we are pretty a bank with a central bank with many topics on our plates. I personally and my colleagues, we do push to increase the capital market in Moldova, as it is so important for us to increase potential output, to increase the possibilities of financing the real economy, and to move ahead and faster on the convergence path. You know, Moldova became a candidate country, and we are very ambitious to finalize actually negotiations by 2028 and to become a member by the end of this decade. So, yeah.
Thank you. I'll hand over to Ahmed, please.
Thank you. Thank you very much once again for inviting us. Let me first say that we share a similar situation with Moldova. So Kosovo is a small and open economy, which is bank-dominated in principle. We have done lately important steps toward allowing the foundation for the capital markets. With the support of USAID, which was existing, we have drafted a new law on capital markets, aiming to align with European Union regulation. There is an ongoing project with the World Bank on Development Bank, which is a new initiative. And what I know in the region as well, there are some initiatives to either revise the current setup of the Development Bank. From the regulatory and institutional initiatives, so the new law on capital markets in the process, we have already drafted, and the Central Bank was involved on it. The amendment on the existing legislation to allow corporate bonds is undergoing, together with investment funds amendment in the current legislation, which will provide private equity and venture capitals. And as well, from the regulatory point of view, that we are preserving the central bank role as an integrated supervisor of this market. From the market infrastructure point of view, we have a central securities depository system in the central bank, which is serving for now for the government securities. But the idea is to expand it for the capital market needs. And plus, there is it is foreseen on this concept note that we will have an investor compensation scheme, which will mean that we'll have to extend the current deposit insurance fund mandate to cover as well this investor compensation scheme. The central bank in Kosovo is the only authority to supervise the entire financial system. So the mandate is very broad, and of course we'll have to, we will serve as primary supervisor for this market and regulator, and we'll have to build our own capacities to follow the new mandate. We already reorganized the central bank structure to have a dedicated unit to regulate and supervise capital markets, fintechs, and all crypto assets, and all of those new initiatives. And we will continue to have the integrated supervisory role on the central bank. As I said, being bank dominated has served the economy for quite well. The loan to deposit ratio in the country is like 90%. So the banks have been heavily supporting the economy. We have quite strong non-bank financial institution sector, which is very important for us, especially for access to finance and providing to especially micro and SME businesses. For many years, they have managed to have a low NPL, similar to what the rest of banking sector has, 2%. In many years, that was very stable. So we believe that when it comes to proper financing and having other sources of funding, it is the right time now to think about moving to this extra mile. We are discussing with the neighbor countries as well the possibility to have a regional approach when it comes to this initiative, because we are really small, but as well because of the interaction cross-border activities, and having in mind that we are very much committed toward European Union integration would make us more stronger when it comes to the competition. Next week we will have in Kosovo, in Pristina, a session on capital markets, where the governor, the colleagues from North Macedonia will be there as well to discuss how we can really put this in motion. Thank you.
Thanks a lot. The largest country on the table is Poland. Marta, please.
That's right, and our capital market is also the largest in the region, but in terms of the relation to GDP, it's quite small. So it's the market capitalization of the Polish companies on the stock exchange is just 20% to GDP, so not much. So we are very much bank dependent. But we had this graph in the first panel showing bank lending to GDP and also capital market to GDP, and we were just in the corner. And actually it was quite an optimistic slide, because it must have been from a few years ago, and it's even lower. So actually bank lending to GDP in Poland is even lower now, it's like 30%. And market capitalization is 20%. So we are an interesting case, because we are growing, and we are growing fast without basically outside lending for the companies. So our companies, they invest from retained profits mostly. But we have a couple of interesting stories to tell in terms of our pension system reforms, which were meant to stimulate the capital market. So if I have more time later on, I will be very happy to share the stories.
Thank you. Maris, please.
Well, thank you, Martin. I know the time is tight, but let me still thank you first for inviting me to this panel. It's always great to be in Vienna, and it gives me a chance to meet some old friends I wouldn't otherwise maybe see. But about capital markets in Estonia and in the Baltics, so if I think what are the few things that perhaps are sort of new or more interesting developments, then one thing that I thought of, especially after the session that we had before lunch, when the moderator was sort of lamenting that we don't even have Nasdaq in Europe. We actually do. So we have a Nasdaq OMX, which is the stock exchange for the Scandinavian and Baltic countries, so we do have Nasdaq. The problem is that the stock market, though, is relatively small, but we are, I think, in a way, even without much sort of a legislative basis for it, we are quite integrated in terms of the Baltic capital markets and also with the Nordics. It was also mentioned in one of the previous sessions that in Estonia we have a strong venture capital culture. So it goes back to some of the success stories that we have had with some of the technology firms growing up from Estonia, going public, then a first round of investors getting the resources to invest in next businesses. And this sort of the snowball has been rolling, and it also brings in new venture capital investments, and we have sort of our own venture capital industry. When you ask what the central bank is doing in light of all this, then, well, we don't have that much to do with the stock market or venture capital, but we do try to support some companies that also play a role in the capital markets through giving access to the payments and the security settlement infrastructure. So we have a very ambitious, now fastly growing Estonian startup, basically offering cheap brokerage services to customers in different European countries. I think it was important for them that we gave access to target the European Central Bank's payment system and target 2 securities for the settlement, also for our local securities. And something that has as a final point, something that has taken place, at least in Estonia, in the last, I would say, 5 years or so, is really a much stronger culture of retail investing and the real sort of retail investment scene having sprung up with all sorts of different conferences and a lot of focus on education and financial literacy. It doesn't mean that those investors necessarily invest too much in our own domestic market, but there is this sort of culture. They, of course, look at the investments internationally, and it's sort of on the agenda, at least in Estonia.
Thank you. Yeah, culture matters for sure. And that brings me to our the only direct neighbor of Austria here on the table, Hungary. Daniel, please.
Thank you very much, Mr. Governor. Thank you, Martin, for inviting me to this very interesting panel discussion. I represent a small country, maybe not the smallest in this group, but a small country, but with a very active and agile central bank, the Magyar Nemzeti Bank, as I should say. Obviously, capital markets are, or at least should be, important channels for financing in every economy. Unfortunately, I can't say that for Hungary that the capital market would be already an important channel of financing, very similar to regional peers. Financing to the corporate sector is much dominated by banks for various reasons, and maybe we can come back to those factors later in the discussion. But your question was what has happened recently and what the central bank is doing there. We firmly believe that central banks do have a role in fostering capital markets. Capital markets should also be one channel of monetary transmission, so a well-functioning capital market with deep market with liquidity should help achieving price stability goals of the central banks. We started with some important measures already 10 years ago, where we introduced the mortgage funding adequacy ratio, by which, this is a macroprudential tool, by which we require the banks to provide long-term stable financing behind the household mortgages. That should help them, first of all, from a regulatory point of view, to address interest rate and maturity mismatches. But this tool also helped them to issue mortgage-backed securities, bonds, so deepening the capital market. And the central bank also came into this market as a buyer. So central bank participated in this market, providing liquidity. So this market has become from almost non-existent to a sort of a live market segment. This is, I think, one avenue where we gave a boost to the capital market development. More recently, we added one more feature to that, which is the green covered bond market, where we attribute different, more preferential weights to green bond issuances. And also the central bank played a role in launching that market segment. What I could also mention here is that we are a majority shareholder of the Budapest Stock Exchange since 2015. During the this period, the market capitalization of the Budapest Stock Exchange tripled. So that is definitely seen as a positive development from a central bank's point of view. And we are active also in regional cooperation. Just a few months ago in August, we signed a cooperation agreement with regional peers Croatia, Poland, Romania, Slovakia, Slovenia, North Macedonia. I hope I didn't forget anybody. Where we want to exchange more information, be more transparent how capital markets cooperate, provide liquidity, so on and so forth. And finally, I should also mention that our central bank launched in 2019 a bond funding for growth program, by which the central bank helps provide long-term fixed rate and low interest rate financing to the corporate sector, which was very successful in the initial years before the central bank exited from this market in 2021. Maybe I would stop here for the first.
Thank you very much. Draiko.
Thank you, Mr. Governor. I come from a much smaller country than yours, so but we don't despair, because on the list of the United Nations there are 50 countries and territories that are smaller than a country which is less than 2 million and 25,000 square kilometers. And out of these small countries, some of them are quite rich. One of the richest countries in the world, small countries. Mr. Governor, thank you for the invitation. Trying to answer your question, I will also try to address several issues that were raised before lunch in relation to capital markets. Let's not forget that capital markets in transition countries, former socialist countries, centrally planned economies, are brainchild of privatization process, because the process of privatization is part of the transition created initial material to be traded somewhere, and it was expected with the development of capital markets to have a platform for trading in order to execute the process of privatization itself. It was a form of synergy. Why are we talking? Why are capital markets in? I will concentrate on Western Balkans. We know that capital markets, let's say, not well developed. In Macedonia, market capitalization of the stock exchange is 37% of GDP, and let's say the turnover is 1.4 annual turnover, 1.4 of GDP, which is much lower than EU average, which is more than 65%. So coming from the former system, from socialism, our countries, inherited low level of trust among population. Whatever one might think about, let's say, humane relations between people, etc., authoritarian regimes created a low level of trust between people. I don't want to mention, fear of these authoritarian institutions like KGB, Stasi, UDBA in Yugoslavia, etc. But so that's a fact, and this also low level of trust impeded the development of economy, of enterprise development in capital markets from the very beginning. If you add to this, let's say, low level of development of institutions for market economy, which were missing in the former system, like stock exchanges, then contract enforcement, the rule of law, etc., etc. So we have a clear answer why we are found in such situation. Having said this, I was thinking, listening to the others, do we still, do we really need to push for development of, let's say, more rapid development of capital markets in our countries? What's wrong with, we've been teaching our students there are two models now being a little bit Eurocentric of finance, the so-called continental versus Anglo-Saxon, and we know, I mean, the audience knows what I mean, because the banking sector and other financial institutions which are developing have been serving economy quite well. Our countries have higher rates of growth compared to developed countries, etc. As of the, somebody mentioned the role of the tax system, Mr. Fellinger, the flat tax, etc. We have introduced, I was a Minister of Finance for 3 years at that time, and I am to blame for the introduction of a flat tax of 10% in Macedonia, but I don't think that it contributed to the development of capital markets itself. Maybe more important was postponement of payment of capital gain. tax on, let's say, on shares, on dividends, etc. And the role of the pension funds, not to waste time, maybe I will leave it for later. So what can be done? I mean, by the central banks, in addition to what has been mentioned here, of course, we need to, let's say, secure or to provide, which is our mandate, macroeconomic stability, price stability, because that's the environment which fosters trust and growth in the capital markets. Second, of course, which is very important, having in mind the fractured capital markets in all these countries, all initiatives like the one that was mentioned by my Hungarian colleague, the Common Regional Market Action Plan for fostering regional cooperation are also quite useful. And then development of the domestic institutional investor base will also be instrumental in providing development or fostering development of the capital markets. Thank you.
So thanks a lot for this first round. So hang on for a moment. There will, of course, be ample time for questions and answers, but I want to do one round of individual questions, if you agree, to each of you, following up of what you said before we open up for the more general Q&A. And if I may start again with you, Anka. You already mentioned the cooperation between Bucharest and Chisinau in terms of a stock exchange. Can you tell us a bit more about the prospect and what does it mean? Is it really a common stock exchange, or is it different subsidiaries? And what's the prospect for Moldova of these new developments?
That's a new stock exchange. That's a stock exchange also. So it's not like a subsidiary. It's a company that is set up in Moldova, and there are main companies and banks will be shareholders in this new entity. I had a plan also to have the Central Securities Depository being part of it, but we stuck into some technical discussions with some IFIs. So what we want to achieve through this entity, access of Moldovan issuers and in general of citizens to a more liquid market. Because right now, the market in Romania is the second largest after Poland, of course. And it increased a lot over the last years through the listing IPOs and SPOs of some large energy entities. So our intention is to bring some liquidity and access to finance for all companies and investors, individuals and companies from Moldova in this new entity. And we hope to be functional, to have this entity functional mid the next year. As now is in the process of everything being approved. It's also one entity, public entity participating. It's a sort of a state fund property will have like 20% of this new stock exchange. And personally, I'm very optimistic about the new developments. I would like to have more options for financing in Moldova. The fact that the system is heavily dominated by the banks, I don't think it's healthy. As a governor, I would like to see some competition also for the banking sector coming from other segments of the market.
Thanks a lot. I'm sure there will be follow-up questions on that as well. Ahmed, you talked about the regional cooperation a bit, some others did as well. But there's, of course, also the integration in the euro area. And I mean, yours have a very special situation with the euro being the currency in Kosovo. So what do you expect from this closer collaboration, from integration towards the euro area in a stronger way over the next couple of years? Is there potential? Is it important for the capital market in Kosovo?
Yeah, again, thank you very much. Actually, you rightly mentioned we have euros since 2003, and that has brought a lot of positive benefits. starting from the confidence in the market, from exchange rates, from the lower risk profile, simple transactions when it comes from businesses, and have contributed positively to the investments, to remittances, to trade. But of course, the full benefits are still not enjoyed because of the access to market infrastructure of the European Union, about other possibilities when we join forces, especially on the regional cooperation, but as well European integration. We are very much committed to continue this path, but we believe that that's started from strengthening our institutions first, making sure that we have the transparent financial market with a high integrity, and that is a precondition. Then working in regional basis as well is very much important. We see a lot of activity happening in the Western Balkans, 6 Balkan countries, but not still the right, let's say, support or needed support is provided. So new companies which might invest in Albania or Macedonia would be still seen as new from the perspective of access to credit to another country. So there is not yet, let's say, exchange of information that could, support that company in the other country or vice versa. Plus, the idea of having a joint stock exchange or something similar would be, we believe, in support to this regional cooperation first, aiming, of course, European Union integration. There is one example. Kosovo and Albania has one type of exchange in energy, which is called Alpex, which is the place when the energy is traded, because Albania has different sources of the energy, which is hydro, and Kosovo has a power plant. That was a good sign of how these systems can be complementary. So still, Albania has, for example, very low loan to GDP ratio, or loan to deposit ratio, because they have different structure, and we are much more intensive when it comes to financing. So I think there is a lot of opportunities that we work together in the region to create this access to finance, other sources and other alternatives, while we prepare ourselves to benefit from the integration. There is, I think, the next question, but again, we see a much more commitment now from European Commission, from the institution of European Union, including ECB, engagement with us, with Western Balkans, and we feel that some benefits of European integration financially we already can see. SEPA integration is one of them. As well, another important project, which we will speak later, is this rail that the professor mentioned. This instant payment solution is something that we believe that cross-border within us in the region, but with the European Union as well, will help a lot. And that will be like really highway when it comes to the critical infrastructure. So we see now that we are seeing more projected members. Of course, enlargement as a political process is something else, but I think we need practical examples and results which are coming from financial and economic integration. And we as a small country, we feel it because our main trade partner is European Union. We have large diaspora living abroad, mainly European Union countries, including Austria, Germany, Switzerland. So we believe that we can benefit much more. And there are evidences, analyses showing that how much the economy was boosted after European integration and after the progress was made in that regard.
So thanks. Yeah, payment infrastructure, I think, is a very important word, or a very important statement, because that, of course, is something that plays a role in many aspects that we're discussing when it comes to integration and gradual integration. Marta, you already mentioned pensions, and also my predecessor, former Governor Holzmann, mentioned it as perhaps a key aspect to develop capital markets, pension schemes, pension funds. There is some experience in Poland on that and some changes over the last decades. So I would be very much interested to learn more about that.
So we have good lessons and bad lessons from the experience. So we had like 2 important pension reforms, and one was in 1999. When a system of 3 pillars was introduced. So we have this part which is the major part, pay as you go. Then there was this capital leg introduced, or capital pillar introduced, and it was quite big because I think it was around 1/3 of the contribution was paid into this pillar, and then there was voluntary one. So what happened with the capital, so managed by open pension funds, was that it turned out, so the idea was to give boost to the capital market. And first of all, it turned out that they charged a lot. So there was, one problem with really high charges for management of the funds. Secondly, they invested very heavily in government bonds. So they invested in government bonds and they charged for management. So at some point, the reform was reversed, and there was lots of reasons why. But around the year 2014, basically, the part of the capital leg which was invested in government bond was moved to the state, to the agency which manages the pay-as-you-go system, and the capital part was still left to be managed by the open pension funds, but it stopped being required, so it stopped being mandatory. Yeah, the lesson from the 14 years was interesting because basically the lesson is that it takes two to tango. So there was this investment to some extent by the open pension funds, but there are not so many Polish companies interested in listing on the stock exchange. Yeah, so to some extent it was inflated a bit by the fact that we had these pension funds investing in the stock exchange. So that's maybe the not so good lesson from the experience, but then 5 years ago, because we have very low fertility rate and we basically have problem in the future with the replacement ratio, so a new scheme was introduced, which is voluntary, but it was introduced in, I think, a very good way because it was based basically on behavioral nudging incentives. So it's voluntary, but so its default option is that you are in the system, and I think the composition is very good. So you contribute like 2% of your salary to the savings, so it's a capital again leg, and your employer contributes 1.5% of your. So it's like a non-brainer, and you can also withdraw at the end of the year what you have accumulated. So the incentive is there, to stick to the system, but still, I think partially because of the experience from the previous reform and the reform being scrapped, lots of people actually opted out. Yeah, so more than 50% of people opted out, even though, in my opinion, and I think it's the case, it's a non-brainer. But so it's designed so you actually are automatically enrolled again after a few years. So in a few years, everyone will be enrolled again, and hopefully they will already accumulate this very positive experience by others that it's worth to be in the system. So, and it's increasingly, so hopefully it will, that's a good lesson. Fingers crossed, basically.
So very interesting. It shows that if there is experience that is not so positive, it's even more difficult, even if you have a perfect design afterwards, to set things up actually in a way that people accept it. And opting out to more than 50% is quite a lot, given what you know from 401k plans and so on.
Yes, and what I want to add is that people didn't really lose on the scrapping of the reform because they have kept basically what they have saved, but the understanding, so that the public believes that they lost on it, yeah, even though it's not quite the case.
Oh, absolutely. I mean, it's the public beliefs on the returns that they probably somehow internalized. Very interesting. Maris, you already talked about the cooperation among the Baltics. So the question would be, what can the European Union and the attempts to make advancements with the Capital Markets Union learn from the Baltics in terms of cooperation? What's the key features that led to this cooperation? I mean, it's of course proximity and cultural proximity, but is there anything that the European Union can learn beyond that?
Yes, I did mention a couple of things. I can tell you more about cooperation. And as for what the EU can learn, of course, we are very much in favor of more sort of closer cooperation with other markets and other countries in the EU and beyond in any possible manner. But I guess what you can learn is really that you don't necessarily need this big legislative framework to cooperate. And you can do it yourself if you have the right incentives in place. In our case, the fact that the three Baltic countries individually, we're all really small in terms of economies and markets. It really makes sense to be very open, try to find partners, be open in terms of trade, capital flows, and so on. So I think this cooperation between the Baltics and also a bit more widely with the Nordics, for example, or in particular in the case of Estonia, it has really come very naturally. So when you look at the financial sector, for example, we have the biggest banks, some of them being subsidiaries of some Swedish banking groups that really look at the Baltic markets as a single market, really, and manage it as such. We also have, there's a bigger domestic Baltic bank that is really also pan-Baltic, you could say. Speaking of capital markets, we have several investment funds, in particular when it comes to real estate investments, that always look at the Baltic market as a whole, as the home market, and not Estonia if it's an Estonian investment firm. And when I before mentioned the venture capital industry in Estonia, then I think also by nature of their business and the kind of startups they support, it's never a local project. So it's always almost immediately with global ambitions and goes much beyond even the Baltics. So I think the sort of the message is that both from the official side, where we try to cooperate to the extent possible, as also without the requirements or the legislation, if you wish, from the European level, the same is also quite naturally happening also in the private sector. But then, perhaps based on that, it sounds like everything is great, and also the capital markets are working fantastically. But nevertheless, even if we do things jointly in the Baltics, so when it comes to the stock exchange, for example, when I go and open the web page of our stock exchange, I see the list of all Baltic shares listed in all three countries. There's even no distinction. I can go and sort of buy all of them just the same way. But even so, it's too small. So speaking of the sort of capital markets union, really in terms of liquidity, depth of the market, providing really meaningful sources of financing for firms that are growing beyond this initial venture capital or early stages of financing, you really need a deeper and a bigger also stock market, for example. And this is something definitely that we are missing, and I think that applies to well, most countries in the EU, and that's, I think, why we still need to really make an effort to get there.
Yeah, there's a famous quote, I think it was Jean-Claude Juncker, that said, there are those countries in the European Union that know that they are small, and those countries that don't know it yet, but they are also small, actually. So
we know it.
I think everybody here knows, actually. So Daniel, you mentioned that the central bank is associated very closely to the stock exchange. I think that's unique. It's not unique, but it's special. It doesn't have to be with we don't have to talk about the ownership, but do you think that this close collaboration with the stock exchange is something beneficial to develop new instruments, new financial instruments, to actually also create the market infrastructure that is helpful, or is it sometimes detrimental, actually?
Yeah, good question. As I mentioned before, during the central bank's ownership, definitely there was a boost visible in the Hungarian stock market with a significant increase in market capitalization. We are still small in a European comparison. That's why we thought that cooperation within the region can help in this regard, sharing information, practices, standardizing procedures, making them similar and more accessible to international investors could definitely help. Nevertheless, with all this, I believe that these stock markets across Central and Eastern Europe will remain fragmented and in individual market segments. Definitely, one obstacle is here that we have our own currencies, and issuance in foreign currencies is limited to some mainly larger companies who have revenues in foreign currency or partners or foreign owners. And but I wouldn't say it's non-existent, but definitely something which is lagging behind. Central banks obviously can support this with infrastructure, payments, and also capital market infrastructure. This is where we are, we hope we are front runners and advance this. And the central bank is also keen on supporting the EU's Savings and Investments Union, and hope to see more progress on that front.
Thank you. Yeah, perhaps we have time to talk about the Savings Investments Unit later on a bit, but let me go to Traiko. You already mentioned the Common Regional Market Action Plan 2025-2028. Can you tell us a bit more about that and your expectations regarding that action plan?
Central Bank, National Bank of Macedonia is regulator of the banking sector. We have separate regulator for stock exchange, for capital markets. That's Security and Exchange Commission. So our stock exchange, I think they have been established and have been in operation for a quarter of a century now. And in the past, they have been trying to, let's say, to develop this cooperation first with, as far as I know, Croatian stock exchange, but not much, according to my knowledge, has been achieved, has happened. But so within this framework, I think that at the very beginning, as my colleague from Hungary has mentioned, exchange of information will be the major, let's say, contribution. I can't see, I'm not an expert in the field, but I can't see in a foreseeable future any integrated stock exchange that will cover the Western Balkans or the broader area, because you know, the countries do trade between themselves, but they have different systems, different currencies. So it will be difficult, but maybe this cooperation will go into the right direction.
So thanks a lot. I would have many more questions actually, but it's probably time to open up before and see whether you have questions to the audience. Unique opportunity to ask questions to several governors of the region. I see already one raised hand and the second raised hand. Perfect, thank you.
Thank you. Sunčica from Central European University. I have a question about the point that Mr. Ismaili mentioned about remittances. I think that overall they contribute to capital markets. However, they can also create unintended consequences like impact on labor force participation and also appreciation of the real exchange rate. So I was wondering if there are any policies or measures that countries can use in order to mitigate potential unintended consequences. Thank you.
Thank you. I think we collect a bit and then we'll actually try to answer all the questions. Günther Fellinger is here in the front.
Mr. Governor, thanks a lot. Yeah, my question is about the euro in general, because Mr. Buzek, my political mentor, he has been as a stability pact coordinator actively involved in having the euro for Kosovo and Montenegro, and this has worked much better. My question is about the generosity and the policy of the European Central Bank. Would it not be much better, for example, North Macedonia, Professor Slavetsky has said it, they have a currency pack already. Could we not also have a similar situation like with Macedonia, with Kosovo and Montenegro, to allow them to adopt the euro prior to accession, basically now? Because that would be also the best policy for Moldova, because congratulations for the currency pack, which you have implemented, I think, at the beginning of the year to the euro. This is very good. And now the question is, why to have the lei, why to have the dinar at the moment? It would be much better to have trust in a currency, then the capital market can develop much faster when the whole euro area is backing basically this capital market. And my last question to Estonia, you famously made the Slava Ukraine to euro coin, I think in 2022. 2022. And the question is about the reconstruction of Ukraine. Now they have this currency at 51 to the hryvnia. The currency of the Ukraine has dropped significantly. We will invest now hundreds of billions in the reconstruction, in the victory of Ukraine. Why not help them to euroize, same as in Kosovo after the war, euroize Ukraine immediately and have a firm fundament of the euro for the reconstruction of Ukraine, and Estonia taking the lead. Thank you.
Thank you. Any further questions? I don't see any at the moment. Let me just add one more question, and then I don't know who wants to start answering the questions. About joint stock exchanges. I think there was once an idea in the capital markets union, the banking union, to actually promote this idea, but it in the end turned out that the market was quicker than the political ideas. So some of these stock exchanges have been actually consolidated. There's corporations, but the political idea was turned down out of course, identity issues. Every country wants to have its own stock exchange, but we've talked about the size of our countries. So do you think there's a need to actually push more for cooperation and consolidation here? I don't know who wants to start. We have 3 questions. One was on remittances, one was 4. Actually, one was on Euroization for the Western Balkans, one was on reconstruction of Ukraine, and one was on these stock exchanges. Please, Michael.
The young lady in the back mentioned the remittances. Of course, in addition to, let's say, Kosovo, Macedonia is a recipient of remittances because of our diaspora in Western Europe. So I don't think that they can cause real appreciation because, you know, it's, let's say, it's positive for the balance of payments, you know, it's income recorded in the, let's say, current account. And, you know, part of this remittances go for covering the cost of imports of the country because, you know, we're a small open economy, import oriented, and, you know, when these families receive this money from abroad, they spend it on goods which are mostly coming from import, so it balances itself. So not a real problem, but you know, it's very good to have this inflow of remittances. And in the whole framework of discussions that we have had about payment systems, etc., all these improvements like entering the SEPA, then TIPS, instant payment system for the countries are aimed for reduction of the fees that you know, the senders have been subjected to until recently, sending money through you know, like Western Union and other institutions like that. So, and on the issue of introduction of euro, let's not forget that Montenegro first and Kosovo are special cases. We know how you know, these countries became independent, and they unilaterally introduced the euro. The European Central Bank does not support that. You know, they are neutral, but you know, they do not stand behind, let's say, this use of the euro that Kosovo and Montenegro do have. So for Macedonia directly, we don't see any need at present. You mentioned, Mr. Fellinger, that we have had and still have de facto fixed exchange rate with unchanged parity since July 1997. But you know, if you look at some highly developed countries like you know, Scandinavian countries who like Sweden, who have not yet introduced euro, some countries that have been members of the European Union since 2004 and still keep their currency. I think that my country, North Macedonia, benefits from having its own currency, which provides for certain flexibility in order to, let's say, address the external shocks and crises. And it will need some preparation after the, let's say, eventual full entry into the EU to introduce the euro. So we'll not rush to do that.
Ahmed please.
Yes, just thank you very much for the question. First, to complement a little bit what Mr. Slaviski mentioned, but as well to disagree a little bit on last sentence. First, on remittances, as we told you, we are still dependent as a country. We have large diaspora, still very much connected to the country. So for us, it counts for approximately 15% of GDP remittances. If we count only as let's say as a fund, but if we consider them as foreign direct investors, it goes up to 30% of our GDP. So for us, it's very much important. And the relation was more on payment system infrastructure. So based on some studies, we were paying like 6% in average compared to like optimum 2%. So a lot of, costs plus timing, a lot of, let's say, procedures involved. So this instant payment solution, TIPS clone, which we are developing with Bank of Italy, which is the provider of the European Union payment system, will help us a lot to first as a local payment solution, but as well for cross-border. And we believe that it will boost trade. So it has a lot of sense for businesses, but as well for individuals. How we can use more productively the remittances is one question. In the past, actually before 3-4 years, Kosovo had a pilot called Diaspora Bond. So the idea was if we can mobilize in more productive way, and that time I was part of Treasury, State Treasury, so I was involved on this, and that was quite a good test. For euro and the benefit of euro, I think there is no need to mention that we benefited a lot. And for the fact that we are not a member of Eurozone, it's something else, but ECB is not against this. I can tell you we signed an agreement with ECB just before 3 months for protection of euro. Integrity of euro is important. And we signed an agreement that we will have access to the data, will provide data when it comes to the counterfeited issues. So we believe that that is our future. As we have it, we have to really consider. And then we asked as well, together with Montenegro, a possibility to join Digital Euro project as well, of course, in later stages. But as we have a physical version of it, it's going to be pity if we will not utilize the chance to provide this. And that's, for now, for us, it's very important that we follow this integration. At the moment that we will connect our payment system with TIPS clone, this new infrastructure, which is going to be the same for 5 Balkan countries, which is the first time in history that we join forces together, and we agreed on one solution. I think this is something very important. And plus, from geopolitical point of view and third-party risk, it's very important who is now providing those services, because this is critical infrastructure. It is really important, and here we are doing, I think, a great job, and ECB was supportive of this idea. They gave consent to Bank of Italy, Banca d'Italia, to provide that, and I think this is going to be a case to be replicated later on different, even including capital markets infrastructure. Thank you.
Thank you. Maris, please.
Yes, so there was a question also to me about using euro outside the euro area and in the context of Ukraine in particular. I have to say I find it much easier to comment on this other point about the special design €2 coin that we issued. So that was, I think, a great idea. We had a special issue €2 coin saying Slava Ukraini, and that you can, I hope it circulates well in every euro area country, and we were able to thank you. We were also able to support Ukraine in the way that we had those special designed cards that we sold to public, and the revenues went to support Ukraine. But when it comes to using euro in countries outside the EU or the euro area, then I think, as Governor Slaveski already mentioned, it's not obvious that it's always optimal for every country and in every case. I haven't heard about Ukrainians really being interested in that. And I guess for a bigger economy that may have a different economic cycle over the long term, it may create also challenges and tie the hands perhaps too much. So I think it's an intriguing idea, but yeah, it's from the ECB side or from a euro area country side, it's kind of difficult to promote it ourselves.
Absolutely. I think the convergence criteria are there for a certain reason. If the convergence is not there, for whatever reason it is, it becomes difficult, of course, to have the same currency. And the theory of optimal currency areas tell a lot about it. We have two questions here, and former governor of Croatia, please.
Just maybe a compromise solution, which already exists with regards to the ECB's support for countries which already euroized in part as part of the peace agreement that was sponsored by the EU, right? But still respecting the convergence criteria as a precondition is what the ECB already is doing, but maybe it can be more formalized in these countries, is currency swaps when it's needed. Because that's the really the critical thing, and that would be very helpful. Of course, the ECB was very, enlightenedly provided this already a little bit global financial crisis, but more importantly during the pandemic. Not repo, that's also not bad, but swap, and in a predictable manner for these countries. And then you don't have to leapfrog, legally, which may be very difficult and questionable, and that may be what ECB Governing Council members can perhaps contemplate.
Thank you very much. We have a question here. Yeah.
Thank you so much. I understand the panel was primarily about capital markets, but when I entered the fascinating world of central banking, that was in the last millennia, believe it or not, end of the 90s. And at that time, central banks had one primary goal, that was price stability. So having a distinguished panel, including you, Governor Koher, my question to you is, how worried are you about future inflation in the medium term? Thank you.
That's a very good question. I don't know who wants to start to answer that question. Actually, no, we don't want to leave it unanswered. But perhaps that would be a great opportunity for a last round, so that everybody can actually answer two questions. If I may add one question to your question, actually, the first one would be about price stability in the countries. There are only two euro area representatives here. One more that has the euro. So price stability in those countries that are represented here. And the second one would be if there's one measure to foster capital markets within the region, within your country, what would be the single measure that you would actually propose or support or actually discuss within your countries or within the region? If I may now turn around the order, I'll start with Governor Slaveski. Trajko, please.
Okay, as the question from the colleague from the from former governor of Central Bank of Croatia. Speaking of inflation, we remember, I just turned 65. I remember, times of great moderation, 30 years, when some countries have been heavily trying to, let's say, to provoke inflation, like Japan, etc., and somehow it came as a consequence of measures of the central banks after the financial crisis and with the pandemics, etc. So for the region, when I say region, Western Balkan countries, and it may apply to other countries, we think that the expectations have been stabilized and are being anchored. And the medium term, even our projections projections of the central bank are, that for the next year it will be somewhere between 2 and 3%, and for Macedonia, in the medium term, we will strive to achieve 2%, around 2% the inflation rate, which will be in line with the inflation rate in the Eurozone. Why is this important for a country that has, as I said, de facto fixed exchange rate? How is there any mystery how we kept this de facto fixed exchange rate for more than a quarter of a century? No mystery. We didn't experience inflation differential compared to the Eurozone, and we avoided real appreciation. Unfortunately, for the last a couple of years after pandemic, starting from 2022, 2023, for a couple of years we experienced double inflation rate than the Eurozone, which worried us and me personally quite a lot, which legitimizes more aggressive measures in fighting inflation, like let's say being very careful with the policy rate, introducing macroprudential measures, etc. So that was on inflation. One single measure. Let's stick to macroeconomic stability. I can't think at this moment anything more let's say, which will foster development of capital markets. Thank you.
Very importantly, thank you. Governor Palotai, Daniel.
Thank you. In Hungary, headline inflation is now coming back into the tolerance band of the central bank, around the 3% medium-term target. Will be in the lower part of the band in the next couple of months, in the beginning of next year. But thereafter, we need to be vigilant that it stays there. We maintain a tight monetary policy stance with a good reason. Nevertheless, I should have mentioned we have a 3% inflation target as opposed to 2% in many other countries, and the euro area, of course, with a good reason. Catching up is continuing, real convergence is continuing, which means there is the Balassa-Samuelson type real appreciation with the inflation differentials. And this is also a good reason why we keep our own currency, so that we allow the exchange rate to adjust and avoid that real interest rates go very low or negative. Some of our countries made painful experiences in the last 2 decades with the real appreciation and negative real interest rates and overheating and real estate bubbles. So that's why beyond looking at the nominal convergence criteria, real convergence is at least that important before one would think about introducing the single currency. I would very much agree with the call from the speakers on the swap lines and the importance of swap lines in providing stability. And I hope the ECB is listening to this conference and taking notes. I think this is something where we could improve safety nets across the whole European Union. And to give you a very, very short answer to the one measure how central banks can help, I would quote from the OeNB: Sicherheit durch Stabilität. Thank you.
Perfect, Chairman. Thanks a lot. Governor Müller, Madis, please.
Well, first of all, price stability, of course, continues to be the main objective for us. Well, just 2 words about Estonia, although I'm not sure you're interested about that in particular, but we do have the highest inflation rate now in the euro area at close to 5%, but this is really due to domestic reasons and some administrative price increases and indirect taxes. But speaking of the euro area now, well, inflation now being very close to 2%, also to the best of our knowledge, looking forward a couple of years, both what the markets are expecting and what we are expecting ourselves, it really seems that it is likely that we will have inflation close enough to 2% also in the foreseeable future, and the sort of the policy rate also being right now in the place where it's consistent with the economic cycle and this outlook for the inflation. Then having said that, of course, we always have to remain vigilant because you don't know what will happen. And this is really the main lesson, I think, for the last couple of years. We have had so many shocks to the global and European economy that the results are throwing away all the macroeconomic projections that we used to have up until that point. So we had the energy crisis, the pandemic, now the war, all of it having an impact also on prices and very frequently having an inflationary impact. So if you're asking if there's any reason now still to be sort of paying attention or being vigilant, then of course there always is.
Thank you. Governor Keightley. Marta, please.
Yes, I will start with price stability. So our inflation at the moment is 2.8, which is very comfortably within our target. Our target is 2.5 plus minus 1 percentage point. And going forward, it's looking very good. So our inflation peaked in 2023 at 18.4. So it was really high and was on the back of all the shocks. But now we are in a very good situation. Our growth is very solid as well. So this year it's around 3.5%, and we have grown more than 17% since the pre-pandemic time, yeah, so at the end of 2019. So solid growth, inflation under control is what we want, and our rates are higher than the ECB rates because we are at 4.25, so it clearly shows that we need slightly higher rates. The capital market, again, I think I will say what I said before, that we actually have to look at the company side more than, because we have done already quite a lot to stimulate the capital market from the other side, and I think it's the work with companies. And when you serve, we have a big panel, we survey companies, and when we ask them about investment, because it's also an issue for us, even though we are growing very fast, we have quite low investment rate. So that's our concern normally. So we stopped worrying after years of strong growth and low investment rate. But at the back of our heads there is always this question. And what they say is that they don't have very long planning horizon. Yeah. So I think the answer, because we are at 80% of the in terms of GDP per capita in real terms compared to the average of EU. So we are close. Yeah. And the question is, and I think the growth is partially based on very high human capital. But the question is, what happens next? And I think, and it has already been said here before, that probably a good strategy in terms of some sort of industrial policy would also be an answer to that.
Thank you very much. Governor Ismaili, Ahmed.
Yeah, thank you very much for the question. Actually, let me just say that, of course, our main mandate, financial stability, remains, and including the price stability. But we have not to forget that as the world is changing and the new risks are arising from different reasons, including digitalization, geopolitics, innovation, etc., the mandate of the central banks has evolved. And now the financial stability can be, a challenge from different risks, including the one that we mentioned today. So how we can keep financial stability together with financial literacy, together with consumer protection, all of this in a way could affect, especially new technologies. So this is something that is connected nowadays very much with our primary mandate, financial stability. When it comes to price stability, as Euro-ized economy, we have limited tools. But I can tell you that for Kosovo case, we have our inflation is basically imported mainly. 2/3 of the inflation is coming from the import, because our structure of the economy is in that way that as we import, we are exposed to the external shocks. And but we have our instruments, macroprudential tools, which we started to use since last 2 years, and we believe that we have a quite good overview on the instruments in hand. Of course, the midterm is very much going to be determined from those external factors which are unfortunately out of our control, especially those geopolitical consideration that has had implications on different segments of the world economy. And being part of Europe and interacting very much with that, of course, we will be exposed to those. So we consider to be, we continue to be focused and careful about and proactive and the measures that we need to take to make sure that we operate on the safe zone. Thank you.
Thank you. Governor Drago.
Inflation.
Please.
Inflation, so back to business. Moldova has suffered 2 episodes of very high inflation since the beginning of the war, as we were the country 100% dependent of Russian natural gas. And we did not expect that this would be weaponized in this way. So in October 22, we had the inflation rate of 34.6%. It went down, but at the beginning of this year, we had again almost 10% inflation after the second and final cut of connections with Russian gas. Now we are approaching the corridor. We have the target of 5% plus minus 1 percentage points. And we are getting into this corridor by the end of the year and next year. So we see inflation going smoothly down. And as Governor Slaveski said, macro remains very important for the capital market also. I would say that not only macro, but I think trust in our institutions is very important for having the capital market growing and developing, and the support of, we can also support this sector indirectly. We look at our companies and helping them. We introduced instant payments and we're very successful. We are now part of SEPA. So we are interconnecting our depository with the depository in the region. 3 weeks ago, we had Commissioner Albuquerque in Chisinau, and we were talking about this interconnectivity needed at the level of Europe. And they said, okay, so it's good for us, for Moldova, that we're at the beginning of this project. Please hurry up. You're talking this morning about the banking union, about capital market union. So please, EU, hurry up. We want to catch up with you and to be there.
Thank you. If I may add just one thing, we're always talking about vigilance, and it seems like an empty phrase, but it's not an empty phrase, I think, nowadays. That's important to add, because there is risks, geopolitical and geo-economic risks that are at a level that we haven't experienced for a long time, but there are also structural changes when it comes to the labor market, when it comes to energy transition, that actually create perhaps inflationary, perhaps disinflationary effects, and so it's times to be vigilant and to just watch what's going on. But at the moment, I think I think we agree here, Maris. At the moment, we seem to be in a good place what monetary policy concerns, and let's see what the projections show. We are almost perfectly in time. So I'm very thankful to your discipline. It's a large panel, but everybody was very disciplined. Thanks a lot for that. But it was also very enlightening. I learned a lot. So thanks for being here. Please give a large hand to the panel here.